in China, you had a memory chip maker, which is CXMT, and I think we highlighted this yesterday, started 5 times higher on its listing. I mean, the issue was subscribed some 122, 123 times, but this happened yesterday. They have a semiconductor sort of index. It's called the Star Board in China. And most of these listings, I mean, look at the last 4 or 5 listings, they've all listed at a 300, 400% premium to their IPO price. So this was no different. Actually, this was the biggest ever. This, by the way, makes this company the biggest market cap mainland listed Chinese company. I mean, this particular listing. The other one, of course, is what's happened with ASML. ASML makes chip making equipment, and that was down 8.5%. I mean, as far as, AI and chips and all of that goes, right? I mean, chip making equipment in that sense is the last bastion of technology. ASML is the leader, is the world leader by far. There were reports that a Chinese state-backed firm has begun producing chip making machines. The stock was down 8.5% in Europe. It's a European company. So that's something to keep in mind as well. Now, even as the main chip stocks were all selling off in the US, as I said, the SOX was down 2.5%. Software outperformed in a big way. Now, yesterday the IT index was up about 2.5%. So it's debatable what follows what. But bulk of IT investors who are, at least giving this a look, are all of the view that let's just wait for these companies, Accentures and the Cognizants of the world in the US. They're closer to the customer. They know what's happening and all of that, right? And essentially the same business model as IT services companies here. Let's see them turn. And that will be a signal here. So Accenture, Cognizant, EPAM, Globant, Gartner, they were all up between 3 and 5% last night. So keep an eye on IT companies today. Now, in terms of large cap earnings, Microsoft and Meta will report numbers tomorrow post-close. Apple and Amazon report on Thursday. So I think lots of earnings. And of course, between all of this, we'll also have the Fed decision tomorrow, which will be Thursday morning for us, as we highlighted yesterday. I'll just leave you with levels. The resistance for the Nifty is 24,230. It's the falling trend line. But the bigger one is 24,500. It's the, the touch points from the last 2 highs extended to about 24,500. So first level to cross, 24,230. Supports come in at 23,830. Roughly 23,800 from where the markets bounced, and about 23,600, which was the low, almost the low that we got to last week. So those are levels. GIFT Nifty will come up, give you a quick sense of how we're likely to start. It's about 70 points lower, pulling back, taking some away after yesterday's 200-point rally that we saw. Nigel has walked across to the wall with the F&O positioning, the cues, the stats. Nigel, take it away.
Well, on a normal trading session, if the Nifty opened up with these sort of cues, 80 to around 100 points down, you would have fancied your chances to buy the dip. However, today is the monthly expiry, so things will be far more volatile than normal. Now, we have a couple of positive triggers this morning. Crude, it's very well behaved. It's down close to $15 from the top. That's encouraging to see. And after one of the weakest starts in decades, the monsoon has revived. The cumulative deficit has narrowed to around 15% from around 40% at the end of June. So that's encouraging as well. You want the monsoon to pick up because that's what pushes those inflation worries a little bit behind. That's important to track. Let's hopefully that deficit just narrows from here on. The rupee yesterday, that was a bright spot. It showed some strength yesterday, but the FIs, they remain sellers. Though the institutions, that the FI and the DAIs together, they were net buyers in trade yesterday. But the FI is selling, well, from around 3,000 to around 3,500 crores. That came down to around 1,700 crores or thereabouts. So the rupee can show some signs of stability. Crude oil prices are down. Hopefully the monsoon picks up as well. Our hope is that going by the earnings season as well, which hasn't been so bad, the FI has gradually come back into our markets. At least for the time being, in yesterday's trading session, they covered some short, close to around 3,500 contracts were covered on the short side. And getting into the monthly expiry there, well, the short positioning is holding at around 91%. Rollover picture more or less in line, both on the Nifty as well as on the Nifty Bank. What's encouraging to see is over the last few trading sessions, the FIs have continued to write puts. And yesterday was no different. Some of the calls that were written earlier, they unwound. While there was good amount of put addition on the short side, telling you that the writers are back at play on the put side. And maybe, in fact, the recent low at around this 23,600 odd mark could hold out. So let's pull up a couple of options though. Massive writing is what we saw at around this 23,900 put. So there was a good amount of openness built up, close to around 90 lakh shares get added there. However, on the upside, that 24,050 mark, well, out there as well, the call was very, very active. which brings us to the levels. So going by the options data, going by the technical levels as well. The 20 DMA, that will become near-term resistance mark of around 24,100. Then you're looking at 24,500, and then moving to around the 200 DMA. For the time being, that will be the first level of resistance that you're looking at. On the downside, though, the 23,800 mark just for today will be the key support zone going by the options data and going by the kind of data we've seen on the put side. The Nifty Bank yesterday showed signs that it wants to go ahead and take out that 20 DMA. However, there was some selling that came in from the top. So after hitting a high of around 57,350, it did pull back a little bit. Resistance marks come up for you, both on the 200 as well as on the 20 DMA. So that's going to be important to watch because that's the one that's actually been in fine form. And if it can get past these technical levels, then it gives the Nifty good amount of room to gradually pull back towards the 24,500 odd mark. But keep an eye out on the last start of trade. Volatility will pick up owing to the monthly expiry.
Well, indeed. And let's get back to the swing factor. And that's been crude, pretty well behaved. On Friday, we were closer to 100, and now we're down to levels of sub 90, similar to yesterday where we closed off. So here's the latest from West Asia. U.S. President Donald Trump says Washington is having very friendly talks with Iran, but he suggests he's not prepared for prolonged negotiations. Listen in.
And we're talking right now. They wanted to talk. Their people said, please don't shoot last night, the night before, 2 nights. Don't do it. We're having good talks. So we'll see what happens. I think there's a good chance that something could happen. And if it does, good. If it doesn't, we go back to doing what we were doing 2 days ago.
Okay, let's just quickly take stock of the Asian markets before we get things going and get our guest in. There is a rout, a complete rout. The Korean market, South Korea, the circuit breaker was triggered. It's down nearly 8.5%. The Taiwanese market's down 4%. The Japanese market's down nearly 5%. Individual names like a Samsung is sold off 10%, SK Hynix 7.5%. And also now what analysts are pointing out is how tightly correlated US and South Korea, Taiwan is. So if you really want diversification outside of the US markets, you're not getting it in South Korea or Taiwan because the correlation between the two, has reduced. I mean, the correlation between the two has gone up so much. So it just heightens the risk in the event that AI spending slows down. The GIFT Nifty will come up for you on your screen. Yesterday, it was a good start to the trading week. From lows of 23,600 on Friday, we got to 24,000. This morning, though, it could be a little soft to begin with. We have our expert now joining in, William Lee, Chief Economist, Managing Director at Global Economic Advisors, now joining in. William, this point about the tight correlation between South Korea, Taiwan, and US, and therefore, if you really want diversification, would investors look to India, or India is not that exciting and hot?
Well, if you really want diversification, you have to step out of the one sector that's tying all these markets together, which is the AI semiconductor world. And unfortunately, Asia is very tied into that one sector. I think, for example, if you were to look at a diverse market like you have in the United States, pharmaceutical like Lilly is making new highs because everyone is anticipating the new GLP-1 drug to be put on the marketplace. For addressing a lot of the health problems that we have in the United States and the rest of the world. So for diversification, I think you certainly have to be thinking broadly in terms of sectors and products. But I think I want to remind everybody what Warren Buffett talked about diversification. He said it's diversification, right? You just worsen the portfolio performance because you take away from what you think is your best idea by putting it into a basket of ideas. And so I would say to most investors out there, for your base money, sure, diversify your portfolio by the market. But for your more speculative and truly the ones where you want to make your home runs, you really have to bet on and invest in your best guess as to where money will be used most efficiently. And right now, the AI trade still captures most of that imagination.
Yeah, no, absolutely. It does in all ways, right? Up and down. Kospi is down. I think circuit down once again in that sense. Did you see that news? ASML down 8% in Europe. This is.
I was fascinated by that because the news that sparked that sell-off was a company in China that may be producing a machine to compete with ASML. Now, let me ask you something. If you are going to get surgery and you really had the choice of the best surgeon in the world or someone who just got out of residency, who would you choose, right? clearly you would get the best surgeon in the world if you can. And if you can't get that surgeon, and the only other surgeon in the world was the resident that came out of China, yeah, you go for it. But I think most companies have better choices than that. So I would say this company may be a challenge to ASML in the future. And I don't put it past the Chinese to do it very quickly, because they certainly learn the tricks and acquire an amazing amount of intellectual property in a very fast amount of time. I would still say that they are still on the horizon rather than an immediate threat. But I think that in terms that's a good lesson for the AI trade. It's become less of a macro issue as to how will it improve productivity of the economy and possibly be disinflationary, to becoming a very micro issue. Which companies will be able to actually make products that will enhance the bottom line for different companies? And that's where you said earlier, a lot of the software companies are making gains because it's at the application level where they apply the AI technology, where they apply the new productivity enhancing tools and use it for companies like Lilly, where they're trying to develop the next generation of not just GLP-1s, but new cancer cures. And I think that's where the application level is where the search for best ideas will be enhanced by AI, which is why I say AI will be at the fulcrum of all of the profits in the future. But I think that the actual investments will have to be made on a much more diverse and applications level.
Let me ask you this. Have you seen the best of market valuations for AI companies?
Yes, yes.
You think so?
And I think that we have seen the best in terms of valuations, because our imaginations are still quite limited right now as to where the application will be. But I think the higher valuations on the next phase will be where Jensen Huang is investing, which is across the board on what he thinks are the best ideas for applications of his NVIDIA technology. And I think that's where we should keep our eyes on the ball in terms of where are the applications coming from. Is it going to be the open models? Is it going to be the closed models? Is it going to be all of them? But who will be using them? So I have a lot of trust in companies like, for example, Palantir, who actually goes to individual companies and say, let me help you use your data more effectively, right? Those are the kind of great ideas that will be making the most of the AI technologies.
And these concerns or criticism about AI circular deals, and that's what's underpinning the AI boom that we're seeing. Are you worried about that?
Very much so. I think what scares me is that it used to be that if the financing were done out of cash flow and it was an equity investment, equity investors are the kind of investors where they swing for the fences. They're the ones who are willing to take the bet to say it's all or nothing. But if you go into debt financing, in the mergers and acquisition era of the 1980s, Professor Jensen at Harvard said pushing companies up in terms of debt burdens, their debt ratios, it's putting the managers against the wall, trying to make them most efficient because they have to pay off the debt or else they go bust. And so what you have there then is incentivizing companies to take less risky bets, to try to develop the most reliable technology that they have on hand. And that to me is worrisome, because we are still at the phase in the AI cycle where we need to swing for the fences. 9 out of 10 of the good ideas that we think are good ideas will fail. But boy, that one winner is going to take it all. And so I think the use of equity investment incentivizes exactly that kind of research. But the use of debt financing scares the hell out of me, because that means we're going for mediocrity. Now, a lot to be clear, a lot of the debt financing is being used for infrastructure and a lot of the well-proven technologies and data center construction, that kind of stuff. That's legitimate. But in terms of financing advances in the frontier, I think we should really look to companies looking for equity investments, because those are the guys swinging for the fences.
All right, thank you very much for that. This week we will have numbers from Amazon, Apple, Meta and Microsoft. And remember, Alphabet last week, when they raised their capex guidance by $15 million, the stock got punished. And for the first time in its public history, the stock also turned free cash flow negative. So the second half of the week is going to be very, very important for big tech capex guidance spending. Thank you very much, William, for joining in. Let's tell our viewers the interactions lined up on the show today. Coming up 8:35, the management of Tilak Nagar Industries will We'll talk about the June quarter numbers. 9 a.m. Vikash Singh of ICICI Securities will talk about the defense sector earnings. 9:20 Rahul Arora of Ashika Institutional Equities will be a market master for the day. 9:30 the management of Coforge will talk about Q1 numbers. Following that, Tata Power will chat with us at 9:40. 9:50 we'll bring you the management of Hudco to focus on the FY27 outlook. And towards the end of the show, Lata will chat with Chetan Iyer about the strong capex cycle in Asia and the impact on India.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. For the time being, I'll run you through the list. HDFC Bank, BEL, Tata Power, Home First Finance, Coforge. They'll all be reacting to positive news flow. On the flip side, you have Coal India, Indus Towers, Tata Chemicals, Godfrey Phillips will be reacting to negative news flow, while a mixed reaction is what we're working with for Adani Energy. Stay tuned. We get into further detail on the other side.
Welcome back. You're watching Bazaar Morning Call. It's a Tuesday morning. It's time now to talk stocks. Our entire research team is standing by with CNBC TV 18's list of top stocks for the day. But Ritu, let me begin with you. Post-market hours yesterday, there was something out on HDFC Bank. Fill us in with the news.
Well, Rima, that internal review into the Maharashtra State Development Corporation on MSRDC deposit case has been concluded, and the board has found that the employees' conduct amounted only to, and I quote-unquote, business overreach and not in any way any malified action or any kind of personal enrichment or misconduct. But in an unprecedented move, the board has now imposed a 1 lakh rupee penalty and issued warning letters to 3 of its senior-most executives, including the current CEO Sashidhar Jagdishan, the CFO Srinivasan Vaidyanathan, and the retail asset head Arvind Bohra. The focus, of course, now shifts to what happens to the CEO's reappointment. Now, there are sources are indicating that the board views viewed this entire issue as a procedural one-off error of judgment. So that is unlikely to derail Sashidhar Jagdishan's reappointment application. The NRC is expected to meet soon to consider this extension, after which, of course, the proposal gets sent to RBI, and RBI is going to evaluate that based on the board's recommendation, and will unlikely, from our sources are indicating, it is unlikely to see the issue as a huge negative for Sashidhar Jagdishan's reappointment. Now, timelines are very important. The issue pertains to the years 2017, when Aditya Puri was CEO, Sashidhar was CFO, and 2021, by when Sashidhar had taken over as CEO. Now, our sources here again, clarify that the board's action is limited to the current management only because of the limited legal leeway that was available to execute penalties on former employees. Now, RBI will also independently look at, they could impose a penalty on the bank if they find any regulatory violation.
Got it. All right. Thanks a lot for that, Ritu. Let's hop across to Ria. Ria, tell us about BEL.
Well, yes, we have seen a good quarter this time around for BEL, even though the quarter one is seasonally the weakest quarter for them. But even though this is the weakest quarter for them, revenue, net profit and EBITDA have all been above estimates. In fact, revenue has gone up by nearly 25% versus estimates of just 15% growth. And this has largely been driven by a strong execution that we've seen in this quarter. EBITDA and net profit also going up by roughly 12 and 8% above the estimates that the street was working with. Margins, however, have contracted by nearly 300 basis points to nearly 25% this time around versus estimates of just a 150 basis point margin contraction. And remember, these margins have normalized compared to elevated year-on-year and QoQ margin levels that we saw. And in fact, the higher material cost this time around has also led to some margin compression. This time around, we've seen material costs going up to nearly 55% of sales versus nearly 47% compared to Q1 of last year. But the management in the earnings call has highlighted that the quarter one margin pressure that they saw this time around was largely due to a change in the product mix and not due to any additional cost pressures. Now, apart from this, the order book has come in at nearly 72,258 crores, slightly lower than what we saw at the end of FY26, but strong nonetheless. And for the full year of FY27, the management has retained its guidance of 15% revenue growth, EBITDA margins at 28%, and order inflows of over 55,000 crores, including the QRSAM order. So overall, good set for BEL. Stock expected to open in the green today.
Got it. All right. Thanks a lot for that, Ria. Well, I'm going with red for Coal India, but probably the stock recovers from the day's low. Let's, run you through the numbers. See, basically, numbers have been regrouped, since you cannot compare it with the poll, because the company has added the collected cess to revenues. They have done this for the second quarter as well. And they have adjusted in other expenditures. So that's why we're not comparing it with the poll. However, we're looking at the EBITDA post-stripping activity adjustment. And those margins have compressed to around 22% from around 26%. So that's a miss on the operational front. And the EBITDA miss was due to the higher operating cost and lower than expected e-auction volumes to some brokerages. However, the higher other income and the higher reversal of overburden removal, that's what supported the PAT. That's why the PAT hasn't seen that bigger degrowth in comparison to the kind of degrowth you've seen on the EBITDA number. The problem basically is Coal India has not been able to pass on the impact of higher input costs via higher, selling prices. And this in an environment, global prices have been very, very good. And that's a bit of a disappointment. However, what will support the stock is, again, they've given dividend of around 5.5 rupees. Jefferies, they have a buy rating. They're seeing valuations at around 8.7 times are attractive. So that's why you'll see some interest coming in at lower levels. But these numbers go down as a bit of a miss. Tell us more about Indus Stars, though.
Well, it's an okay set of numbers. The company's top line came in line with expectations, going up by 4.5% quarter-on-quarter, year-on-year. Margins have declined sequentially on account of two reasons. One, the provisions from doubtful assets linked to Vodafone Idea increased on a quarter-on-quarter basis. 23.3 crore is what it stands at, and higher power costs. And because of this and lower other income, the company's profits declined by 2.5%. So I'm going to go with red on account of that. The margin declined, the profit declined sequentially, and also the fact that tower additions were lower in Q1 at 3,100 versus 4,900 in the prior quarter. So that's Indus Stars for you. Vivek now joins in with Tata Power.
Tata Power delivered a good set of numbers as far as Q1 was concerned. When you're comparing it to our coal, across most of the parameters, it was a bit of a beat. The coal business and the solar cell and module business aided the profitability this time around. Revenues higher by 5.5% on a year-on-year basis. Even though the EBITDA was down, it was higher than what the street was anticipating. Margins dipped close to 200 basis points. Profitability higher by 11%. Now, what is the key triggers as far as profitability was concerned? Solar cell and module EBITDA went up more than 2 times on a year-on-year basis, better realization, and the company also saw external sales to third party this time around. Profit from JV and associates, mainly the contribution coming in from the Indonesian coal mines, was very strong, up 86% on a year-on-year basis. And, what is the marked difference from earlier years? There's been very strong capex in Q1 this time around, over 5,000 crore worth of capex that the company saw in Q1. The key things that the company said in the media call last evening, FY27 will be better than FY26. Mundra, Gujarat has already signed the supplementary PPA. 3 more states will sign supplementary PPA by the end of August, and Maharashtra is expected to sign it by September. So Mundra too will start contributing positively come September.
Okay, thank you very much for that. I'm going to watch for Coforge, and it's a strong set of numbers. Now, when you look at the reported numbers, they include Encora Holdings consolidation for the first time ever. This was completed on 23rd of April, so you've got about a 2-month contribution, 2.5 months. So therefore, you look at it quarter-on-quarter, year-on-year are not comparable. So reported numbers look like this: 21% growth on a quarter-on-quarter basis, but Profits are down 15% on account of some exceptional items, more than about 50 crore rupees. Now, you strip out the acquisition to see how the company is done. Well, the organic revenue growth, constant currency, was about 1.1%, ahead of street expectations of flat growth. What the company had guided in the prior quarter is that they are planning to exit their low-margin India business, and some data center divestment took place. So therefore, Q1 was expected to be soft on account of this hit, this exit from low-margin India business. So the company has also said that while the organic revenue growth in the current quarter stands at 1.1%, if you exclude the exited business, it stands at 5.2%. So that's important. So that's on the revenue. Secondly, on the margin front, consolidated margins, including the Encora acquisition, stood at 16%. This is ahead of the 15.5% guidance that the company had given, and you strip out the acquisition, it's at 16.7%. And the company, the conference call is currently underway, but in the press release, Sudhir Singh, always bullish as ever, he says that with a record visibility, strong demand, and a rapidly expanding pipeline of AI-led opportunities, FY27 is shaping up to be an exceptional performance year for the firm. So, going to go with green for Coforge. But Sonal now joins in to tell us about Tata Chemicals.
Tata Chemicals reported a weak set. Their revenues were up 14.5%. EBITDA was down 14.5%. Margins declined by 300 basis points to come in at 13%. And there was a loss again of 17 crore rupees. This compares with the profit same time last year. It's again the supply chain issues and the pricing that the company is facing. And in their commentary also, they say that global soda ash demand is expected to remain broadly flat in the near term, weighed down by weak macroeconomic conditions and also excess capacity that we are seeing in the market. They added that global pricing is also expected to remain subdued, and several domestic markets will continue to have stable prices. Overall costs have gone higher because of geopolitical issues, and hence going with red because the weakness for this particular stock continues.
Got it. All right. Thanks a lot for that, Sonal. Let's wind this down then with Ananya on Home First Finance. Ananya?
So for Home First, they delivered an impressive quarter again, with AUM rising 26% year-on-year, sequentially 7% up, while disbursements rose 31%, now reflecting healthy demand despite lower repayments rates here. Now profitability also remained robust, with net interest income up 38% and profit after tax rising 35%. Now margins also remained resilient, with spread or NIM staying stable at 5.3%. Now despite a seasonally weak quarter, asset quality continued to improve, with GNPA easing to 1.8% and NPA declining to 1.36%, while credit costs remain contained at 39 basis points. Here, another company also maintained a very strong capital position at 47%. Management remains confident of delivering a growth of around 25%. So all in all, good quarter for them.
Got it. Vivek, what about Adani Energy?
Well, Adani Energy, a fundraise has been launched via the QIP route. The company is looking to raise close to 3,500 crore rupees. The indicative issue price, it has a 5% discount to yesterday's close at 1,615 rupees a share, implying a little over 1.7% dilution of the current total outstanding equity. Why is the company raising funds? Number one, for capex plans to set up transmission systems. Number two, for debt repayment, and also for a proposed acquisition of 100% equity shares of Intasmart Private Limited. So again, Adani Energy expect to open mildly in the red, but what we understand from our sources is that the demand has been quite robust.
All right, Vivek, thank you very much for that. Important to know that there's an important story which we will address in just a bit. But let's get the top 10 out of the way. Godfrey Phillips is the next one. Stocks done well last 2 days. Mangalam, take it away.
Well, the stock's done well, but unfortunately, results haven't. Whichever way you cut it, it's a weak set that has come in. 19% revenue decline that the company's reported, just shy of 1,200 crores. The EBITDA has actually declined by 46%. So 337 crores has turned into 181 crores. And the margins have come off sharply as well, from 23% down to 15%. And the net profit from around 350 crores has gone down 44% to about 200 crores as well. Volumes have declined 2% and 3% quarter on quarter. The management says this is sign of resilience for them, but the company hasn't taken entire price hikes. In fact, they've adopted a balanced pricing strategy to ensure customer impact is phased. So going forward, if the company goes ahead and takes bigger price hikes, then maybe the impact on volumes could be a lot larger. Add to all of this, in the last 5 trading sessions, ever since Philip Morris said that the India business displayed resilience, the stock had actually rallied about 8%. So put all these things into perspective, it may come in for a bit of a sell-off today.
Okay.
Mangalam, thanks very much for that. That's Godfrey Phillips with Perspective. Let's get the commodity action out of the way as well. Oils, of course, cooled off a lot. Manisha Mani.
Morning, absolutely, and it continues to see a further decline as well. So just about holding $87 a barrel right now as the U.S. says that they're having good talks with Iran with a chance of a deal over the conflict. But the U.S. also says that the strikes would resume if the negotiations fail to deliver. In the meanwhile, you also are looking at the strength in U.S. dollar index. The markets are also watching out for the U.S. Fed meeting on where that reaction perhaps could come in from as well. The gold and silver prices in the meanwhile have seen some declines yet again. You have gold prices trading just below 4,100, silver prices trading below $60 an ounce as well. The only area that actually is looking at some gains has been the base metal prices. So copper back around that 1-month highs, zinc very close to 4-year highs in the Asian markets right now.
Got it. All right. Thanks a lot for that, Manisha. For the time being, we slip into a short break. On the other side, Mayuresh Joshi is waiting for some fundamental stock talk.
Okay, welcome back. GIFT Nifty will come up on your screen. Take a quick look at it and then we'll move on. 50 points lower was about a 60, 70 odd point cut when we started at 8. The other big story, and Eternal was up some 6% yesterday, and Swiggy also saw some relief. And then that relief perhaps is also coming from what's happening with other player, which is trying to IPO, which is Zepto. And there is a valuation mismatch. We got you the story on closing bell yesterday. Let's revisit this one. Rachna, take it away.
That's right. Zepto's much-awaited IPO has now hit a pricing deadlock. Sources tell us that the issue is now likely to be downsized and pushed to August, while the original timeline was July, mid-July in fact, with the company and India's top mutual funds far apart on the valuation number. Here's what we're learning. Zepto has cut its ask to $4 to $5 billion, well below its peak of $7 billion from the CalPERS-led round last year in October. But large domestic funds and insurers want 30 to 40% below even that. Bids are coming in at 3.5 to 4 billion pre-money valuation. The result would be the fresh issue may shrink by about 20%, roughly about $650 to $700 million from the original ask of $1 billion. So here's why the 20% bid would matter even more. Because under SEBI norms, a size change beyond 20% would force a refiling of the prospectus completely. So withdraw and refile at a lower size is now a live possibility, is what our sources are indicating. Now, why are funds holding back? Zepto benchmarks itself against Eternal and Swiggy. But fund managers reject that comparison since Zepto has no food delivery business. Swiggy itself trades 35% below its IPO price, and the prospectus of Zepto flags its own concerns, from the ED's FEMA summons to founders to a first ever monthly user decline in March that they saw. Now, the numbers cut both ways. FY26 revenue doubled to 22,624 crore rupees, but losses widened as well to almost 6,000 crore rupees. Now, talks are expected to conclude this week, but whichever way this would go, this is the clearest test yet of where public markets are pricing a loss-making quick commerce company.
All right. Well, thanks very much, Rachna, for that. So that is, the Zepto conversation, which is going back and forth. Mayuresh Joshi is with us, Director Research at MarketSmith India. Mayuresh, at some price, I mean, buyers will be there, right? Perhaps it's going to be lower than what they thought, what the management thought they'd get at some point in time. What does it mean, if anything, for the other players? I mean, the one name on which, people who like the space are really gung-ho on is Eternal. Stocks back at almost 300.
Morning, Prashant. So I think if you probably dissect, obviously, how Eternal earnings have been, how Swiggy has been performing, and the initials that we are probably getting in terms of how Zepto's financials have probably played out, Eternal probably seems to be the strongest place among the three at this juncture, both in terms of expectations of the food delivery and the quick commerce business. Margins expected to stabilize to a large extent. The management commentary itself was very encouraging when they probably said that competition probably, even if it comes through, I think the worst in terms of how the margin performance will already get played out. And the cash balance is obviously going higher and higher as we speak. And let's not forget, I think that's all happening in spite of the aggressive rollout in terms of the dark store expansions that they've probably done. So to a certain extent, I think the two factors that still remain as headwinds is how competition will play out for the space as a whole over the next few months and quarters, with expectations of Amazon and Reliance Retail probably entering this space. And the second element in terms of if competition does come through, does this cap the margins to a large extent? So even your gross order value keeps on going higher. If your margins are restricted to a large extent, the bottom line growth will not be that significant as one really expects. And therefore, I think there are a lot of ifs and buts as we see in this space. But within the space itself, I think Eternal is a little bit strongly placed compared to its company.
And the timing is also going to be important because in September, probably before Diwali or till 30th September, we're going to see NSE and Jio IPOs also come through. So that's going to soak up a lot of demand. And if you push it beyond September, then the company may have to refile, the updated financial numbers before going to the public market. So they will have to sort out this valuation issue if they have to come out before September, and it gets very crowded. Mayuri, we'll just come back to you. We've got a management waiting by to chat with us. Tilaknagar Industries reported a strong revenue growth in Q1, but that was led by the acquisition of the Imperial Blue. However, profit was impacted on account of higher depreciation, finance costs, and exceptional losses. To discuss the numbers, we're joined by Amit Dhanukar, Chairman and Managing Director of Tilaknagar Industries. Thank you very much, Amit, for joining in. In May post Q4 for FY27, you spoke about a high single to a low double-digit volume growth and revenue growth above about 200 to 250 basis points over and above the volume growth. Does that hold after the Q1 performance?
Yes, Rima, good morning to all the viewers. I think that definitely holds. I think we expect that a volume growth for this year should be in the low double-digit figure, with the revenue growth around 200 basis points above that.
Okay. And this is organic or this is including Imperial Blue?
So now when we report numbers, Rima, I mean, we report them as consolidated numbers. Even for the recently concluded quarter one, the numbers have been totally consolidated. The business is now integrated. We are operating as one entity.
Okay. Amit, hi. Morning. Prashant here. Just give us the FY29 number then. Because if you annualize the 1,000 crores in revenues for the quarter, I mean, you're already, it's a big jump. So then what is 29, for which I think you provided the aspirational margins, etc. What would the numbers look like? Give us that. I mean, we'll not hold you to it, a top line and bottom line.
No, Prashant. So, let's keep in mind that a large acquisition and a large integration is behind us now. So I believe that the company is now pointed in the right direction. we expect volume growth, CAGR volume growth to be in low double digit with the revenue growth exceeding that. I think the EBITDA margin for quarter four, the exit EBITDA margin for quarter four was 15.5%. Of course, we've had a bit of a correction in quarter one on account of the inflationary pressures, which have, everyone has been dealt with. But going forward, we do expect the margins to move significantly, move up in the upper teens, in the range of maybe 16 to 18% is the guidance which we are providing for FY29.
Yeah, no, we have the guidance. It's all there in the presentation, but we're just trying to get a sense of what the absolute numbers may look like. I mean, if you want to give it as a band, because I know mechanical numbers we can do, and they will be mechanical. But from yours, from your perspective, what should if you want to give a range, that's great, but it'll help both top line and on the EBITDA will help.
I think for FY29, we can look in the vicinity of 1,000 crores. I think that would be the range.
Okay. All right. Hi, Amit. Good to see you, Ben. A couple of quick questions then. You're reporting this exceptional number because of the integration. Last quarter, this quarter. Coming quarters, we'll see it? Or is it done now?
So, Nigel, we will see it. Of course, it will be much reduced because I think quarter four was exceptional because we were in the process of transitioning out from the arrangements to our own arrangements. So you'll see a decline in quarter one versus quarter four. And in quarter two also, you'll see a further decline. And by the end of this financial year, we would be over with it.
Okay, got it. All right. By the end of this year, you'll be over with it, right? But this exceptional will gradually decline. Now, I'm just, you're giving us that FY29 guidance of 1,000 crores, but the street will be wondering, what about the drinks in the near term? So let's try to pull that number out of you. You're doing a quarterly run rate of around 150 crores. Traditionally, things gradually improve and hopefully input costs cool off, in the second half of the year. So on an exit run rate, should we be looking at a vicinity of around 180 crores of a quarterly EBITDA number, 180 to 200 crores, which would mean that for FY27 itself, the EBITDA number could be in the vicinity of around 650 to around 680 crores? Would that be mathematically, that's what I'm putting up. Would that be the aspiration?
Yes, Nigel, I think that would certainly be the aspiration for quarter one. Our EBITDA has been 150 crores. And let's keep in mind that, there was almost 150 basis points of impact on account of the inflationary pressures. And we'll also keep in mind that quarter one is usually the softer quarter for the entire year, given that it's heavy beer season. I think the spirits business is slightly lower in quarter one. So I think that's a very reasonable estimate. 650
to 680 crores of EBITDA, that's the aspiration. What about the debt number? Will it gradually start reducing from here on? If you could give us an outlook on that front, that's one question. The other one I just wanted to ask you about, what about the price hike? You have a lot of exposure to Telangana, if I'm not mistaken. And since input costs have gone up, you all would be lobbying for a price hike, right? Should we be expecting something in the coming quarter? So on both those two, debt and price hike.
So, Nigel, the two questions. So I think the first one is with regard to the debt position. So our net debt as on quarter one is 2,100 crores. I don't expect any significant change for the next quarter. So at the end of H1, we should be approximately in that same vicinity. But by the end of this year, I think we see clear visibility that the net debt should be around 1,700 crores. And that's with the assumption that, there's no improvement in the Telangana receivable position. I think we are all aware that the outstandings in Telangana are significant, and our company being a large player in Telangana, we have significant exposure there as well.
What is the number? What is the receivables from Telangana, and what about the price hike?
So price hike, it's been 3 years since we received the price hike in Telangana. So we are in active discussions with the government for the price hike. And we are quite confident that we should have the price hike in quarter two. As far as the overdue receivable for our company in Telangana is concerned, it's about 550 crores. So it's quite significant. So if there's improvement over there, we'll see a much sharper reduction in the net debt figure.
Got it. It's all Imperial Blue, right? In terms of growth drivers, etc. So X of Imperial Blue, should we even talk about that? That portfolio actually saw a bit of a decline. Any thoughts on that? What's the plan? Because there is weakness there.
So I think the X of Imperial Blue also business has grown, Prashant, in Q1 versus Q4. So that business, of course, is growing as well. But that business would probably grow in the upper single digit, whereas Imperial Blue will be in low double digit. Hence, we're giving the guidance for a low double digit on a consolidated basis.
And your market share? Has that gone up? And what does it stand at? Yeah.
So market share for Imperial Blue, Rima, it has improved in Q1. I think a lot of efforts which we have taken in the past in terms of integration and the various activations, it has improved by around 150 basis points. And let's keep in mind that this is highly competitive and active segment, so we will try and do our best.
And
what's the number? What does it stand at for Imperial Blue? The market.
Market share in the segment should be around 30%.
30%. All right. Very quickly, what if there is that hope that Bihar could open up at some part of this year? Did you all ever have any exposure to Bihar? And if it opens up, do you see it as having an impact? Because now you have Imperial Blue as well as the brandy.
So on the business without Imperial Blue, Nigel, we didn't have any exposure to Bihar earlier on. So we were not really impacted by the prohibition. But Imperial Blue was a very strong brand in Bihar with volumes in excess of 1 million cases that exit. So if it does open up, it could be potentially green shoot for us. So we have to just wait and watch how this space plays out. I mean, we've been hearing noises in terms of Bihar taking a view on in terms of lifting of prohibition, but we haven't really seen anything on the ground, and it could be something in the medium to long term.
All right, Amit, a little early in the morning to say cheers, but thanks a lot for joining in. We're going to, track these aspiration numbers of around 650, 680 crores for this fiscal and around 1,000 crores, as you told us earlier, for 2029. All the best, and we look forward to chatting up soon.
Thank you.
Time to slip in a short break. Mayuresh Joshi is waiting by, so he'll give us his fundamental view. Also, our technical experts will join in. Sudarshan and Mitesh will join in. Welcome back. Well, it's that part of the show when Hormuz joins us to tell us about some big movers yesterday and some of them that were backed by delivery. Hey, Hormuz, morning.
Morning, Nigel. And of course, you can't keep HDFC Bank out of the news, right? Even yesterday, the price action was not much, but still remained the top rated stock on the Nifty 500. But if you see the trading volumes as well, they were comparatively lower compared to the usual averages that you see, particularly for HDFC Bank. For IDFC Bank, it was in line with the averages. But for Infosys, for ICICI Bank as well, the turnover was slightly lower than its 20-day average. You go specific stocks, well, Laurus Labs was one such name yesterday that did very well. The stock was up 7%, biggest single day gain since April of last year. The stock is up 9% in the last 2 sessions. The premiums on the 1700 call option for the August series doubled in value yesterday. 80 lakh shares were traded yesterday. This is the second highest volumes in more than a year for Laurus Labs. The 20-day average is around 25 lakh shares. A third of those were marked for delivery. So 25 lakh shares, in fact, were marked for delivery yesterday. The 20-day average is around 13.5 lakh shares. Among the top 10 Nifty 500 stocks traded on Monday, and the stock is at a record high, is up 55% so far this year, is Laurus Labs. Concor was the other one. The management spoke to CNBC TV 18 yesterday, and they raised their guidance here first. They mentioned it was the biggest single-day gain for the stock since June of 2024, snapped a 4-day losing streak. In fact, in 7 out of the last 10 trading sessions, the stock has ended lower, has Concor. Premiums on the 500 call option for the next series was up 170% yesterday, and yesterday's session was only the second instance in 2026 where more than 1 crore shares were traded in a single session for Concor. 1.3 crore shares were traded. The 20-day average is 23 lakh shares. A third of those were marked for delivery as well. So 42 lakh shares for delivery, almost 4x the 20-day average. But still, the stock is down around 15% from its 52-week high levels, and courtesy of yesterday's move has trimmed its losses year to date down to just 2%. And lastly, Cartrade Tech was one. The company reports numbers tomorrow, and the top Nifty 500 gainer yesterday, the biggest single-day gain since October of last year. Volumes were the highest in over a month. The trading volumes were 6x the 20-day average. 20% of those shares were marked for delivery. The delivery volumes too were 3x their 20-day average. And as a result of yesterday's 12% up move, the stock has turned positive on a year-to-date basis.
Got it. All right. Thanks a lot for that, Hormuz. Well, Mayuresh Joshi is back with us. Mayuresh, the last 2 stocks that Hormuz spoke about, Concor and Cartrade. Do you have any view out there? Concor, I recall, when the stock was 950, 1,000 rupees, there was plenty of interest. The government looked to divest it. And then the story just went wrong because volumes went down, realizations went down as well because of competitive intensity out there. What's your view? Because yesterday the management speaking to us here on CNBC TV 18 sounded extremely positive. And Cartrade, those AI fears took the stock to 1,800 rupees earlier this year. It's now at nearly 3,000 rupees. So if you have a view on either of these names.
Morning, Nigel. So again, I think for Concor in particular, I think we'll love to wait for the quarter again because the large part of their business volumes are dependent on the EXIM trade. So I think it dominates a large part of their business mix. And therefore, I think how does this shape up in the coming few months and quarters is going to be extremely critical in terms of its operating performance. Obviously, I think in terms of realizations for TEU, the EXIM realizations are relatively better compared to the domestic realizations as well. But the domestic triggers are there as well. I think once the Western dedicated freight corridor becomes fully functional, I think the kind of capex that Concor has probably done, both in terms of the railway lines, in terms of their double stack carriages that they've probably done, and the expectations in terms of better volume growth, actually taking domestic volumes a tad bit higher and compensating for the offset in international volumes is something to be seen. And therefore, would love to wait for one more quarter of Concor to probably just justify how this is probably getting played out. For Cartrade, again, I think the revenue growth has been reasonable on a comparable 3 to 5 year basis, but the EBITDA and the PAT growth has been stellar. Obviously, I think all the 3 platforms that they work out on, and OLX in particular, has delivered very, very strongly for Cartrade in the preceding few quarters. The remarketing part has also done well. And their core business, the margins have held up pretty well. And therefore, if you probably look at a comparative basis on FY26, the EBITDA margins actually went significantly higher in the mid-30s, around 33, 34%, combining all these 3 businesses put together. And they're obviously having a healthy cash balance of 1,200 odd crores. So I think if the performance continues, the momentum in the stock might very well be there.
So many of these names. Cartrade. By the way, another name which did very well yesterday was the recent listing, Caliber Mining. I think yesterday was day 2 of listing. It'll come up, I think, over 10% and very large volumes as well on Caliber Mining. It's a small market cap company, but there was a lot of interest in the IPO and finally ending about 8% higher. The other one, of course, is a much larger company which made it to the market is SBI Funds, 10 rupees away from the IPO price still, right? And, we're starting to get some views that maybe it's looking a little, it's been on the radar. I mean, you liked it at the IPO, you wanted to get more, you couldn't, and, it's available at the IPO price now. So again, I mean, something to keep an eye out on. But look at Bluestone, which has gone up like a rocket in the last 1 month. Last week was absolutely crazy with Bluestone on the upside, and it continued it on Monday. That move. Loris was another one. Huge move once again. It started slow, by the way, in reaction to numbers. Numbers came through on Friday, but ended about 7% at the day's highest point. There was a K Fintech, which went up very, very sharply. So much, which did quite well. We'll take a break. Mayuresh is with us. We'll also run you through some trading strategies in a bit. Vikash Singh of ICICI Securities also with us on defense, metals and more in terms of what they're doing in the first quarter. Stay tuned.
Welcome back. Well, Sudarshan Sukhani as well as Mitesh Thakkar join us to help us out. But what's the view on the index? Mitesh, you go first. GIFT 50 suggesting we pull back a little bit because Asian markets have got a very jittery. I looked at the Kospi that was down, the Nikkei as well is under some pressure. But Indian market setup looks pretty okay. Crude has cooled off. So that's really the big driver for us. What's your view? Buy the dip or not?
Yeah. Good morning, Nigel. So, I yesterday highlighted that the Nifty to get more strength needs to get past 24,000, 24,050 zone. We haven't done that, but it's a market which is still not showing a big directional move. So my sense is that the movement which happened a few days back when we started breaking below 24,000, I think was just a shift of the range of the downside. Now the new range is 23,600 to about 24,050. Given that kind of a scenario, I think 50-60 point gap down may not invite an immediate buying on the index. But if you get a slightly deeper cut, if the Nifty was to get closer to about 23,900 880 zones, which is about 100 point lower from yesterday's close, then I think I would be trying to look at long trade on the Nifty.
Got it. All right. Sudarshan, what about you? What's your view?
Good morning. Well, the Nifty held on to the lows yesterday, and that's good news, which means that the 23,800 traditional original support is still holding. There was a one-day excursion outside, but yesterday it came inside. We are still in that trading range, it means. Within the trading range, we are at the lower end. So I would suggest that buying is possible with a stop at 23,800. It is quite possible that the buy may fizzle out and the market may decide to fall again. But then we have to take that risk. There is a trading range and a deep compression. I'm not worried about Asian markets because we did not go up when the semis pushed them up every day. So we are unlikely to come down because of them. So the trade is look for a minor dip, go long, keep a stop at 23,800. Understand today's Nifty expiry, weekly and monthly. So use August options.
What about stocks, Sudarshan?
Well, I have 3 buys and a sell. CAMS is a buy with a stop under 770. Pidilite Industries is a buy after a long time with a stop under 1580. Max Health is a buy with a stop under 1095, and Voltas is a sell with a stop above 1340.
And Mitesh, your stock calls?
I have two buys and two sells.
On the buying side is HUL with a stop at about 2154 for a target of 2215. Godfrey Philip for the last 2 days has started, some kind of an reversal on the upside. So if you get it on a mild pullback, say around 2195, 2190, buy with a stop at 2160 for a first target of 2250. On the sell side is Indus Tower with a stop at 393.5 for targets of 375. And the final sell call is Bank of India. Sell with a stop at 142 for targets of 130.
Got it. All right. Thanks a lot for that, Mitesh. Well, let's turn the spotlight then on defense and discuss a little bit about metals as well. Vikas Singh, Vice President at ICICI Securities, joins us on the show. Hi, Vikas. Good morning. Thanks a lot for joining in, Vikas. The number that came out overnight was BEL. How do you read those numbers and what's your view on the stock?
Yeah, thank you, Nigel. So number was a mix, basically. While the top line execution was very good, the company missed on the margins, basically, at this point of time, roughly about 25%. So it's a kind, I would say it's a mixed number, but our view on the stock stays positive. We think there are a couple of levers like URSAM orders, they are into an AMCA race as well as the stock price is quite cheap compared to its previous levels. So we are actually have an ad rating on the stock.
All right. So if there's any weakness, you'll be looking to get in, right? In BEL.
That's correct.
Got it. What about Zen Technologies? The story seems to be going wrong. The stock re-rated big time. It went up, I think, 10, 15 times, in 5 years. And from there, actually, consistently you're seeing some kind of disappointment. Now, this is the second quarter when we're seeing some disappointment. However, the management is confident about the path ahead from here on. What is your view? Will you buy into this weakness as well?
No, currently we had a hold rating on the stock. We probably would not initiate a fresh ad at this point of time. See, for Zen, the order book execution largely depends on the addition of the order book. Addition of order book had been pretty slow for the company in the last year as well. And they have roughly about 12 to 15 months of execution timeline. So in order to meet their guidance of FY27-28, we need to see the order book addition in the next 6 months. So we'll approach a wait and watch mode in that.
I think on Zen, you'll have also, Zen Tech, you've downgraded the stock just today post the Q1 numbers. Earlier, you had an ad rating and now it's a hold rating. The target price remains unchanged at 1610, which is 35 times forward valuation multiple. So in your current assessment, do you think the company meets the guidance that they've shared, 4,000 crore of a top line between FY27 and FY28, or they're unlikely to miss it? They're likely to miss it.
So we are building a lower estimate because current order book is just 14 billion. In order to meet 40 billion, their order book should be somewhere around 20 to 25 billion. So that's why we downgraded with the target price unchanged. We would like to see the order book addition first before taking any further step.
And is it that, and what is the reason behind the company not being able to win those orders? What is the core problem when it comes to Zen Tech over the last couple of quarters?
It's not like that the company is not winning those orders. Basically, the order awarding had been slow last year. Post Operation Sindoor, all of us thought that there would be a flurry of new orders, which was kind of a slow at this point of time. You need to understand that the fabric of warfare has been changed. So the requirement for the government is also changing, considering the recent couple of wars at the abroad as well. So the focus is now more on the missiles, interceptors, etc.
So if the tendering pipeline itself is slowed down, is Zen Tech the only casualty of this? Is this the only stock which is impacted, or are we going to see the slow order book accretion across other stocks, listed names? And if yes, which ones?
No, so just to correct you, basically, we said that the last year the order booking had been slow. However, if you look at the AONs which has been signed, it is in excess of 7 trillion in the last 15 months, X of Rafale. So we expect FY27 and FY28 to be a good order booking years for defense company, while the execution comes at a later stage.
Okay, all right. Got that. And from, the defense pack, which is your top buy?
So currently, we are still preferring Solar and HAL. If you remember, last time we were bullish on these two names, they have performed well. Still, we prefer Solar and HAL at this point of time.
Solar, yeah. Solar, or what is the target price on these two? HAL, I think I remember you all were bullish at, I think, sub 4,000 levels as well when the street got a little bit nervous, and from there the stock has rebounded a little bit. So target prices on both these two, HAL and Solar?
So HAL 5,300 and Solar is roughly about near about 2,000.
20,000.
22,000.
22,000. Got it. All right. Let's talk a little bit about metals, Vikas. I believe, Coal India is on the restricted list, so we'll keep that aside. But let's focus on ferrous names. We have a couple of numbers. JSPL, JSW Steel as well as SAIL have come out so far. What is your reading? This is expected to be a soft quarter. But post the recent pullback, what do you like?
So, yeah, it was expected to be a softer quarter, but if you look at the three companies which have posted results, their numbers was actually better than what market was expecting. So, obviously, but the stock price have corrected. We are of the view that the long product price correction is largely over. We think there is some scope for a flat price correction as well. Rupee, we would watch out for rupee as well. Any appreciation in rupee would be slightly negative for ferrous players as well in terms of realization content. We would like to wait a month more before initiating any fresh buy on the stocks, largely on the fact that monsoon is still going on and monsoon traditionally is a weaker quarter in terms of realizations. So probably closer to September, we will think of adding few names. Currently, we like we like flat steel guys more than the long guys.
Okay.
All right, Vikas, we'll leave it there. Thank you very much for joining us. Good speaking with you. Defense, metals in focus. It's always great catching up. I think, the pre-open has ended. Maybe just take a quick look at where things are at before we go any further. It's a slow, flat start. Not every day can be boom, boom or go. We've had many of those last week with downticks. Yesterday was a big uptick, and today is kind of flat. Coforge is settled about 3% higher. And this is interesting because there was a call at little after 8 this morning. So the reaction, I'm assuming the 2.25% reaction higher on Coforge is reflective of course, what was said on the call. We'll have the management join us in a bit from now. Just, take a quick look at some of the other reactions as well. If you can put the stock stacks up with regards to the top 10 names that we had discussed and where many of these are opening. So HDFC Bank is starting about 1% lower. Of course, there's news from yesterday, but there's also what Ritu put out this morning, which was the fact that the board's not, it doesn't really dim the chances for Shashi Jagdishan and his bid for a third term for the top job at HDFC Bank. BEL is down a little bit. Tata Power is up about 1.25% at this point. There is Home First, which is up 1. Coforge, as I already mentioned, is up. Coal India is starting about 1% lower. The others, Indus Tower and Tata Chem, actually nothing. We've had so many large starts, gap ups and gap downs over the last few days. Today, at least, from what we've seen reported since yesterday, there's nothing very large in that sense coming through. Maybe just look at Eternal, right? Is it at 300? Is it managed to, or is it kind of sort of, flattish after yesterday's big move? Eternal is not doing very much at about 296 or so at this stage. Aeroflex was, the other one, right? It's done very well, the stock over the last 2 years, and numbers are good. Stock was up 10%. I think is up about 5 now. The pre-open has ended. Mitesh and Sudarshan are back with us. Mitesh, 9-10 calls?
Yeah. I'll go with the buy on HUL and look at targets of around 22.15 to about 22.20.
Okay, HUL. Sudarshan, what about you?
It's Pidilite. Buy Pidilite Industries with a stop under 1580.
Pidilite is Sudarshan's call and HUL is Mitesh's call. Gentlemen, we'll speak again soon. Thanks very much. Tata Power, we just want to put the spotlight back on it again. Again, a management you will see here on the program a little later. Vivek has got this one. Vivek, take it away.
Well, that's right. Management will join us a little later on the show. I'll be keen to ask them, what exactly are the opportunities they're seeing as far as parallel licensing as well as discoms are concerned. That'll be something that the street will look forward to. Remember, the analyst call is only at 11 a.m. In terms of the numbers, good set of numbers, marginally above what the street was anticipating. The solar cell and module business clearly ramping up, and the company did see significant amount of third-party sales as well. So this time around, across the board, a beat as far as revenue, EBITDA and PAT was concerned. Solar cell and EBITDA jumped up almost 2 times on a year-on-year basis at 626 crore. Better realizations as well as higher external sales aided the mix over there. Profit from JV and associates stood at close to 240 crore, which jumped up almost 86% on a year-on-year basis, indicating that profit from Indonesia was quite robust in the quarter gone by. After a while, you saw strong capex come about in Q1, over 5,000 crore of capex. The company also held a media call last evening where they said that Mundra operations with supplementary PPA efforts are on and on track. They said that Gujarat has already signed the SPPA. Rajasthan, Haryana and Punjab will sign SPPAs by August 2026. Thereafter, Maharashtra is expected to sign it by September 2026. So these are all very important updates, especially as far as Tata Power is concerned. And a clear line coming in from the management saying that FY27 will be better than FY26.
Thank you very much for that. And I'm just, trying to get some details about the Coforge conference call. But what the management seems to be suggesting is that Q2 large deal signings could be very, very strong. Recently, the company had flagged off a couple of weeks back a $230 million odd win, and plus there are some framework agreements. So what the management is basically saying is that Q1 has been strong on revenues. The company's top line has gone up by 21%. You strip out the Encora acquisition, the revenue growth is at 1.1%. And this is despite the company consciously exiting some low margin business. So that was a call the company had already taken, intimated to the market. So if you actually even exclude that, they're saying the organic revenue growth was in excess of 5%. So at a time when companies are struggling with flat kind of a revenue growth, 2%, 5% organic revenue growth is very strong. Also, margin performance has been better than street expectations. Consolidated margins at 16%, and this is tracking ahead of the 15.5% guidance shared by the company. Deal wins have been strong, and as I said, the company is talking about Q2 deal signings also being one of the best ever. So that, sets the company up well for FY27. In Sudhir Singh, the CEO's own words, it could be an exceptional year for the company. The management will also be joining in at 9:30 a.m. exclusively on CNBC TV 18 to talk about the Q1 numbers. But generally, I would watch for IT this morning, Prashant, because the Nifty IT index, the low it hit was on 1st of July, the 52-week low. Since then, it's moved up nearly 15%. The rout in the AI-related stocks is only extending itself. Kospi is now down 11%. And there has sort of been that inverse correlation when those are not doing well, IT is doing well, and Infosys ADR was also up 5.5%. So it wasn't just the Cognizant and the Accentures, even Infi ADR was up 5.5%. So it looks like the momentum could continue in IT.
Well, looks like it, and we'll see. We don't have to wait very long. First rates, I think the pre-open, the Nifty IT is already up about 1.25%. Otherwise, it's kind of flattish, right? 25 lower on the Nifty, 4 or 5 odd points lower on the Sensex at this stage. What do we have? The first rates as they come up on our screens. We'll give it a quick look, at least at a headline level. Look at the Nifty heat map, the 50 stock index, and then move on from there. So it is unchanged almost, right? Blinking red and green in terms of the start that we have right now. So I think 12 point, 7 point change. Just settling down. Nifty bang, nothing very much. About 0.25% lower, 150 odd points. Sensex is down about 80 points or so. Mid cap index is up 30 points, but again flat. The small cap index also coming up with, I guess, slightly more flattish trends. It leads to the word go. Nothing at all, nothing. The Nifty heat map gives you a quick sense of where things are at. There's a large order for L&T. It's a large order for a very, very large order book. So, you'll have to see that in context. 15,000 crore order for L&T. Infosys, TCS, Tech, Mahindra are the top gainers on the board right now. There is HCL Tech also, and Wipro. So, actually, all the Nifty IT, large cap IT stocks are jumping up. And you throw in a Cipla there as well, which is doing well. And on the downside, you've got BEL, I guess, reacting to numbers, Coal India reacting to numbers. NTPC, of course, also reported numbers. Power Grid and Reliance is slightly lower at this point in time. So, I mean, IT perhaps is the only standout kind of sector at the word go. Otherwise, I mean, there's not very much else. Stock-wise, what the IT index is doing is enough to keep the Nifty in the green so far. Rima.
Well, it's not just large cap IT names. Coforge has moved up nearly 4%. So that's extending its gains. Infosys, Persistent, Hexaware Technologies, Tech Mahindra, LTM, Oracle Financial Services. Across the board, mid-cap IT names are very, very active. Orion Pro is the other one. On the flip side, on the back of disappointing numbers, has tanked close to about 8%. So IT is clearly leading from the front. But outside of that, if you look at the gainers list, it's quite slim. You've got a few metal names like JSW Steel in the green. HUL holding up ahead of the numbers. Nestle is seeing some buying. On the way down, Reliance Industries has opened soft. HDFC Bank continues to grind lower. ICICI Bank in the red. Power names like NTPC, Power Grid weak. And ONGC lost 4% yesterday. Another 0.7% slide in NTPC. But absolutely flat opening. I think it's all single stock action, especially where their numbers.
Well, that's right. As we did that market check, in fact, the markets have moved into the green. So that's good news. In a backdrop, but the Asian markets are seeing a sharp sell-off. India actually is a spot of green today. So that's pretty good. Individual stocks that are doing well. Aeroflex Industries, stock flying away. The numbers look quite good, and we'll have the management later on in the day as well. So that stock up and about. RR Cabel, the FMEG business turns positive. The core business as well is growing very, very well. So that stock is up close to around 6%. Balaji Mines, well, that stock as well is opened up with solid gains, as is the case with Capri Global as well. Just take a look at that stock. It's moved very, very well. I think in the last 6 or 8 months, it's moved from around 180 rupees to around 250 rupees. So Capri Global is the other stock that's holding the green. In fact, now it's seeing some profit taking from the top. Sagar Cement, valuation attractive. They've shown some improvement in terms of EBITDA per ton, but the street wants to know about profitability. And how can they sustain that? That explains why the stock continues to linger down. It's down close to around 5%, 6% now as we speak. Sterlite Technologies, after a big run, that one is down close to around 5% with no exit. You had Godrej, you had Godfrey Phillips, beg your pardon. The margins got compressed out there. Some on the street were expecting actually this company to deliver positive numbers. It's come as a rude shock. That stock, in fact, is down. And JK Paper is a stock that's actually opened up in the green. Remember, we had a couple of other paper companies like an Imami Paper that came out with a set of numbers. The street had a sneak peek into those numbers. And JK Paper as well, I think the stock is up close to around 2% in reaction to its numbers. So a good start to trade, one would say, in this sort of, in this sort of a backdrop where the Asian markets are under pressure.
Yeah, no, absolutely. And I think, lots happening, right? We will take stock of more names as we look at market opening. 33 odd points, by the way, on the Nifty. So that's where we're at. Maybe just look at what Asia is doing, right? Look at Coforge. Oh boy, 6% on Coforge. I think perhaps it's also the fact that, it depends on starting points. But if you look at the very near term, the IT index is up a lot. Coforge is not, it's a bit of a catch up on Coforge as well. Coming into the results over the last 1 week, while the IT index did well, Coforge was up, but up about 2.5% or so. So, of course, the numbers are strong, and we will discuss that with the management a little later. But I think it's a bit of a catch up here on Coforge as well. The IT index is up about 2.6%. It was interrupted. The rally in the IT sector was interrupted, of course, by the broader market turned down because of oil shooting up to past 100, and then, of course, the Infi results, etc. But we're kind of sort of back on track, bouncing off the lows that we'd hit recently. Lodha is the other one, right? At the bottom of the screen, it's up 4%. We had the management with us yesterday, and stocks up 25% in the last 1 month. I'm assuming make that 30% with today's move. And of course, from the lows of April, it's basically up 90%. So that's Lodha in a focus for you. Rahul Arora is with us from Ashika Stockbroking. Rahul, great to have you with us here. Thanks for joining in. Good morning. Let's just start with, you guys are initiating coverage across the board, with different sectors, different companies. Coverage on IT yet, Rahul, or will that be the last one?
So when we look at return on capital employed, Prashant, for companies, we have to look at return on capital employed for analysts as well. But I think that's on a lighter note. But yeah, I think, if you look at most of the IT companies, Prashant, I think they have declared, of course, Infosys revised its guidance on the lower side, on the upper end. But I think even now, if you look at most Indian IT companies, they're trading at anywhere between 13 to 16, 17 times on a 1 year forward. The sense that we have when we talk to companies, Prashant, is that we don't think that growth is going to be in high single digits if you look at a FY26 to 28 CAGR. And this would apply to sales, EBITDA, as well as on PAT. So that, I think, is the big concern. And a lot of investors are wondering whether they should even be paying 14, 15 time kind of multiples for companies that are growing at 5, 6%. Obviously, you have very high free cash flow and dividend yields. You have good return on equity, good cash flows. But the question is, is that the real reason you want to buy a business, buybacks and stuff like that? You want to buy it for growth. And the point you were making just a few minutes back, Prashant, I think mid-cap IT companies have shown a little more gumption than the larger ones, whether it's a Coforge or a Persistent or models like KPIT, Tata Elxsi, Tata Technologies that are trying to do something different, as opposed to the conventional large cap IT companies. So my sense is that you're going to have a situation where the mid-cap IT companies are probably going to grow at least 3 times higher the rate, or maybe even 4 times higher the rate than your large-cap IT companies. And if you are to be exposed to IT right now, the trade is certainly going to be in the mid-cap IT companies. Not that valuations are cheap over there. I think for most of the mid-cap IT companies, of course, they've come off from the highs of, say, 45 times of Persistent used to trade at one point. But I think even today, if you look at 1 year forwards on most IT companies, they're trading at between 25 to 30 times on a 1 year forward. So it's not cheap, but at least on a relative basis compared to the large caps, because they're showing good usage of capital and, the ability to buy growth in capabilities that they don't possess, I think the trade is going to be there. From a positioning standpoint, Prashant, I still think it's a sector to be underweight on by quite some distance.
Rahul, hi, morning. Your consumer names are reporting very strong EPS growth. So the top line growth has been healthy, but you add the bottom line, you're looking at 20, 30, 40% kind of a growth for some companies like Nestle. Are you bullish from here?
So definitely, Rima, I think you've picked up the spot that we like the most, which is packaged foods. I think Nestle was a blowout, and it was not just the growth, Rima. The fact that growth came in with that 250 basis point margin expansion. I think the challenge for something like a Nestle, Rima, is that it's already trading north of 60 times. So typically, most sell sides tend to give a 15 to 20% kind of upside on a stock for a buy recommendation, which means we'll have to value the stock at close to 70 times or north of that. That is not entirely comfortable, even for a company with the kind of return ratios north of 100% that Nestle has and the kind of growth that it has. Tata Consumer looks like an interesting one, though. I think you had a situation where you got results that have grown by 11-12%. If you look at Sampann and the new food businesses, Capital, they're all growing at between 35 to 50%, and the valuations are at about 45, 46 times on FY28, so not too demanding. Britannia is another one where valuations have come down dramatically at 41, 42 times. So I think in the consumer staples, if you're looking at it from a 2-year standpoint, I think the best place to probably would be packaged foods. Obviously, you've had a good tailwind in rural, and that tailwind may actually persist going into next year, Rima, because you have a situation where India has 7 state elections in calendar year 2027. Uttar Pradesh and Gujarat are 2 very prominent ones. So you may have a situation, where you do have some amount of dolouts that are given to the masses, and this mass level consumption may sustain. But I think if you're looking at marrying growth with valuations, I think packaged foods is probably the best place to be. And after that, I think if you're looking at pure staples, I think Gillette is another name that looks interesting. Trading at about 38 times trailing for maybe a 12-13% kind of growth. In a worst case, if it does 10% growth as well, you're looking at something like 31-32 times on FY28 for a company growing at 11-12%. So we'd be happy to play that. But I think on a relative basis, we would still prefer consumer discretionary and platform plays as opposed to traditional consumer staple companies where the growth rates will be much higher than some of the names that we've discussed.
Talking about platform plays and quick commerce, any view on Zepto and reports? Even CNBC has picked up from sources about the cut in valuations. Sort of a come.
Yeah, so I think, Rima, it's a toss of the coin whether it goes through or not, and I wouldn't want to get into the merits of the demerits or whether it will go through. But I was reading an article on Money Control the other day where the promoters started the valuations at $7-8 billion, and I think it's come down to about $3 billion post money. Now the issue is not so much for Eternal. I think the bigger issue will be for Swiggy, and that's probably a special situation trade, if you will, because I think if the Zepto IPO doesn't go through, there is a good chance that Swiggy heads up to about 325, 350 in a very quick period of time. Because if you look at the valuations of Swiggy, you're practically getting Instamart free of cost. Blinkit's doing its own thing. I think if you look at Blinkit, it's probably doing about 2,500 crores adjusted, 2,500 crores adjusted EBITDA. If that number continues to grow by about 20-25%, and you ascribe a 40 times multiple to it, you have a situation where just out of the 3 lakh crores of Eternal, nearly half of that is probably just coming from Blinkit, which could be a subsequent delisting if they want to at some point in future. So I don't think the issue is with Eternal. The problem with Zepto, Rima, that I think is they're doing about 1,500 crores worth of quarterly losses. So that's about 6,000 crores on an annualized basis. And they're heavily into deep discounting. So they have about 48 million customers right now. But if they get into a situation where they have to choose profitability, assuming the IPO goes through, and they have to cut back on the discounts, this is going to have an impact on their cash flows. And because they will have to compete with the erstwhile players, they will have to expand their dark stores. So my belief is if this valuation goes through at say $3 billion post money or even lower, they may need to return to the market in about 18 to 24 months, which is not something that I think investors would like. So I think the bigger play on whether Zepto goes through or not is more for Swiggy, because I think Eternal is doing a fantastic job, and I think it'll probably continue to grow its NOVs, in the quick commerce, basis by quick commerce space by 50 to 80%. On the food delivery side by 20 to 30%. So we have no concerns there, but I think the direct play will be on something like, a Swiggy. Personally, if you ask me, would I invest in Zepto after having seen the run that Swiggy has got? I would probably say, it could probably be avoided. And if you must play that space, you could probably be playing Eternal through it.
All right. Hi, Rahul. Good to see you. And I was just reading an article about Rapido's only, that's making some inroads into the Karnataka market, but it's burning a lot of cash. So people are not very optimistic of it scaling up and going to, a couple of percentage points of the market as well. They believe that they'll find it very, very hard. So we take that point. If you want to play it, you play the big boy, which is Eternal, as you're saying. Got it. Let's talk about HDFC Bank. What's happening out there, Rahul? View on that one. Is the dust settling? Or do you think it's still very, very tricky times? You'd rather stay away from that one. Valuation-wise, it's giving support, but that's been the case for the last 18 to 24 months.
There must be at least 500 up to 1,000 fund managers who are asking the exact same question, Nigel, because I think it's one of the highest rated stocks. Practically every mutual fund, insurance company, AIF or PMS. But obviously, these news points at the margin don't help the stock, Nigel. I think if you strip out the subsidiary valuations, HDFC Bank standalone with the merger is trading at about 1.7 times on our FY28 numbers. It's a 14.5% ROE bank, ROAs of about 1.7, 1.8, I think inching up to about 2. NPAs are under control. It's got the best cost to income ratio in the industry. So I think this bank can still continue to grow by about 13 to 15% over the next couple of years. For the size of the balance sheet that it has, I think that and SBI will continue to grow in that range. So it's a no-brainer on valuations. I think the one disconcerting thing, Nigel, was that they did not announce anything on the CEO on the result day. And a lot of the market felt that it was probably a given that he would get at least a 1 to 2 year extension. And that seemed to be the chatter, but that didn't happen. My sense is, Nigel, given where valuations are and the technical ownership of the stock, if there is some clarity on the CEO in the short term, there is a very good chance that the stock would return about 20-25%, because in my lifetime, I have never seen HDFC Bank X or subsidiaries trade at these valuations. I do understand that there are other banks like Axis, ICICI Bank, even mid-cap banks like Crude and City Union Bank that are trading at higher ROEs than what the erstwhile HDFC Bank is. But then you have to look at the size and the kind of entire integration that they've gone through. So according to me, I think the CEO announcement would be a trigger. I can tell you a lot of fund managers that we talk to are sitting very patiently and waiting for that announcement. It's a very high, like I said, owned stock. But my sense is if there is some clarity on the CEO announcement, if you're marrying growth with valuations, this could still be a stock that could return you 20-25%. We saw that in the case of KVB. We see, when good results come and there is some clarity or a good CEO announcement, you saw that in the case of Axis Bank, 18% growth that came through and the stock re-rated. So if you don't have it in your portfolio, you're underweight. That's the challenge. So I would keep the faith. I would believe in it. And I still think that there is a good chance that this stock will probably return you 20% over the next 1 year or sooner, maybe.
Rahul, out of time, but thank you very much for joining in. If you want to listen in to our next conversations, it's Coforge, and that's completely fired up in trade. Very strong set of Q1 numbers with Encora and even without. And the company in the conference call is talking about a very large deal win. Number that we could see in the upcoming quarter. Sudhir Singh, CEO, Executive Director of Coforge, is now joining in. Sudhir, we were listening into the call and you spoke about how the demand tailwind in the current tech landscape is structural, strong. FY27 is going to be an exceptional growth year for the company despite the significant AI-driven flux. So what is it we should expect? Organic revenue growth of 15% for this year with an improvement in margins?
I think what you should expect is very robust growth from Coforge in what is a demand environment that is under stress and in flux. What I emphasized was that Q1 has been an exceptional quarter, and that exceptional quarter sets us up for an exceptional growth year. In all likelihood, making us for the third year running the firm that sets the growth benchmark for the industry, and at the same time also emerges as one of the, if not the highest margin mid-cap in FY27 itself. So it's been an exceptional quarter, and our conviction that quarter one's going to lead to an exceptional year is at this point really high.
Sudhir, hi, good morning. What did you say on the investor call? It's 8% higher. What is
All I said, Prashant, was that there are clear structural tailwinds around legacy modernization, around creating AI-ready data foundations, around creating cloud infra for scalable compute, model hosting, and MLOps, and that the world isn't just a mesh where AI-led efficiency issues are deflationary with no tailwinds in play. There are clear tailwinds. Firms that pivot with intent, firms that pivot with speed will continue to reflect the kind of performance that we have, even in the current quarter. If you take out the impact of the portfolio that we had actively announced last quarter, we are culling. We've grown 5.2% CC sequentially, and we've said that in quarter 2, 1 month of which is gone, we expect that robust growth to continue. And of course, hopefully not just continue, but accelerate quarter 3, quarter 4 onwards.
So for the full year, constant currency growth should be, you should be 10% plus?
The YOY growth for the firm on a reported basis is more than 33%, including Encora. The CC sequential growth in quarter 1 was reported terms 1.2%, but excluding the impact of the India business, government business that we culled, it's 5.2% CC sequential.
And Sudhir, Q2 growth will be similar to this 5.2% growth we've seen in Q1. And are all the planned exits on account of the India business ramp down behind the company?
All planned exits are behind us. We announced it in advance so that there were no surprises. And Q2 is going to be a robust growth quarter for us, as are Q3 and Q4 likely to be.
Okay, so Q2, Q3, Q4 robust, which sets you up for an exceptional year. What about margins? In Q1, your consolidated margins came in at 16%, and this is slightly ahead of the 15.5% you spoke about in the prior quarter. Do you think you can hold 16% margins for the full year on a consolidated basis?
We definitely can, and that's the intent. When we started the year last quarter, we said that we would significantly increase our EBIT. On a standalone basis, we said that we would deliver between around 16.5% and consolidated basis of 15.5% EBIT. In quarter 1, against that guidance of 15.5% for the year, we've already hit 16% reported EBIT on a consolidated basis and 16.7% on what was the standalone Coforge basis. So at this point in time, I think margins, we think, against the guidance are already in the bag.
So you are raising your consolidated margin guidance from 15.5% to 16% for this year?
We're not raising it at this stage, but what we did say in the investor call is that we do expect at least 15.5%, which was our guidance, but we suspect that that number can inch up, possibly go up as the year progresses.
Right. Got that. So just last time we spoke, right? We spoke a bit about outcome-based pricing, and you said, well, more and more, you are moving towards that. You're already moving towards that. Has the journey continued? And is it possible to quantify how much of the business operates on that model now?
Absolutely, Prashant. 6 to 7% of our revenue on an ongoing run basis is now outcome-based. It's got multiple flavors, as you can imagine. Some of it is linked purely to business outcomes. Some of it is revenue that's coming in using the Coforge mod squads, which are the hybrid human agent pods that we use on a subscription or a license basis.
So, if this is this from a pricing perspective, I mean, the size of business and that kind of thing, right? I mean, I'm assuming it does it add or take away? Where will you be, say, by the end of this year, by the end of FY28? The 6 to 7%, what you said, outcome-based pricing, where will you be by FY28, say?
Difficult to put a hard peg in the ground on that one, but that number is likely to keep inching up. I don't think it's going to change overnight or jump a few cycles overnight. It will go up, but as you can see, over the last 1 year, that number's moved almost from 0% to 6%, and our margins have climbed appreciably. So it's not a number that's coming in at the expense of margins.
Any part of your portfolio, Sudhir, facing AI deflation? And if yes, how much?
There are certain portfolios that are facing deflation. There are others that are getting structural tailwinds because of some of the things I talked about: legacy mod, data foundation creation, scalable compute, cloud infrastructure creation. Net, it's a tailwind. There are elements, understandably, AI-led, efficiency-related deflation that we bake in. But the net number between the headwinds and the tailwinds for us at Coforge is clearly, as you can make out from our results, a tailwind.
Got that. Encora is now fully integrated and you've assumed complete control from day one. What are the expected revenue and cost synergies that you hope to realize in FY27 and FY28? If you could break that up.
Sure. As is our model, we don't take a long time, too long to do the integration or to actually come out with the hard synergy numbers. We shared in the investor call earlier today, 40% G&A cost out has been done. The folks who we wanted, we did not see as part of the merged entity, are no longer with us. 40% G&A costs have already been taken out on the Encora side. I want you to know that last quarter, the Coforge standalone G&A was 6.6%. The Encora standalone was 10%. The merged entity is now operating at around 6.5, 6.6%. So that is done, dusted, and behind us.
Okay, got that. I just want to quickly, Coforge, I'm assuming, works with all the big models, right? I mean, Anthropic and OpenAI, etc. Sudhir?
We do.
So it's model agnostic in that sense. So my question is, this entire thing about cost of tokens, how does that play out for IT services companies? I mean, like you, who are helping, business transformation, integrating workflows, et cetera, with increasing use of AI. There were surveys done in the US which said that many are using Chinese models, right? Because the cost of tokens with the American models is very, very high. So that's a big story globally. How does that translate into, IT services companies and the revenues that you will make off these projects?
North America and Europe-based customers who we're working with, Prashant, are at least the ones that we are working with are not using Chinese models. North America and Europe-based enterprise customers are increasingly looking at open source intelligence. So they're looking at the Nemotron from NVIDIA. They're looking at the Llama from Meta. They are not looking, however, at the lower cost Chinese models at the current point in time. The shift that we are seeing is firms increasingly looking at open source intelligence, increasingly trying to move some of the data processing onto these models, or where they're using other frontier models, trying to make sure that the data processing is happening within their environment.
So are there any implications of that? Because they will save on costs, I'm assuming, right? As they do this and have more control, etc., as they move to open source models. But for you as a service provider to these enterprises, what does it mean?
We're agnostic, and these enterprises also will not necessarily save cost. Trying to put a model inside, assigning weights to it, does establish significant costs around governance, around security. So that piece is still playing out. And this space, as you and I both know, is evolving almost on a weekly basis. From our vantage, we do like to, as far as possible, make sure that we either put boundaries around the token costs that are assigned to us, and we put in step function changes in the contracts that we sign to make sure that it's not unbounded from our context.
What's the average size of the cost of tokens in these contracts, which is just out of curiosity? May not have a bearing, but what's the number, Sudhir?
No hard numbers to it. No hard numbers to it, Prashant. It's very contextual. So, for instance, if it's one of the 130 agents that we have out there, we have a good sense in terms of what the likely token consumption is going to be. In other cases, we do encourage our clients where we're not sure of the tokenomics to directly contract with the model provider. We incidentally at Coforge do have an offering that we call tokenomics, where we go to enterprises and help them assess and put boundaries around token cost.
One quick question, Sudhir. You've said Q2 large deal signings could be the highest in your history. What are we expecting?
Well, we're expecting deals higher than we've ever signed, and the highest that we've ever signed in a quarter so far has been, I believe, 6. We'd like to cross that number in Q2.
Okay, and overall in TCV, could you already come close to that $1 billion mark, since you already have a $230 million that you won recently?
We'd like to. We've already, in the current quarter, called out a deal at about $250 million in Q2, the quarter that we're in now, and that we've already consummated. But difficult to put a number on it at this stage. That's one deal at $250 million, but obviously an outlier in terms of size. We'd like to come as close to $1 billion as possible, but I suspect time will tell.
All right, Sudhir, always a pleasure having you on the channel. Thanks a lot for joining. And I'll tell you what, with today's move, Coforge, as the stock price has turned positive year to date, which has been a big outperformance if you compare the stock price of Coforge with the IT index as well. That's still struggling year to date. All the best. And we'll hold you to some of these numbers. We catch up at the end of the coming quarter as well.
Sure.
Time to slip into a short break. Up next, we connect with the management of Tata Power to discuss the Q1 numbers and the road ahead. Stay tuned. Welcome back. Let's get straight to our next management, Tata Power. That's the one on our radar. They reported actually a pretty good set of numbers. Its coal business, along with the solar cell and module business, drives performance. To discuss the results, growth ahead, as well as how are trends emerging, we're joined by Mr. Praveer Sinha, the CEO and MD of Tata Power. Hi, Mr. Sinha. Good morning. Always a pleasure, sir, to have you on the show. Well, let's start off with a couple of basic points first. How are the demand trends shaping up on a subdued FY26 base? What are you penciling in terms of growth for FY27? And how are the trends in Q2?
Good morning. Such a pleasure to be on your show. I think the power demand this year has gone up. In May, we saw an increase of nearly 11%, and in June, more than 9%, 9.8% actually. So there is a huge demand of power, and especially with the rains missing the timeline. I do believe that the whole year we will have a good demand of power. The good news is that all over the country, capacity adds have taken place, and that is able to meet the peak requirement and also the sustained requirement, which we are seeing is in the more in 260 to 270 gigawatts. So I think it's good news for us. All our operations, generation, transmission, distribution are doing it very good, and including our renewable portfolio. So good place to be in the sector at this time of the business. Yeah.
Okay, got it. All right. Do you want to put a number to that though, in terms of what kind of demand growth you're working with?
We are definitely looking in the 6 to 7% for the whole year.
Got it. All right. And now the Mundra issues are largely resolved. Gujarat's on board. When will the rest of the states sign the SPPAs?
So we are in very advanced stage of discussions with the other four states. Three of them, actually, the cabinet notes are getting ready, and hopefully within August, we should be able to uh, conclude on them. And we expect the fourth one to happen in September. So I think everyone is on board. Everyone wants to go ahead, and they are already taking power under Section 11, but with the tariff under SPPA. So they have already availing the benefit of the SPPA.
Mr. Sinha, hi, good morning. Could you talk to us a little bit about what's happening with the UP Discom privatization process, sir? Is there still interest? Has interest fizzled out? Where is the process at?
So I would say it's not fizzled out, but it is stalled at present. UP goes into elections next year in February, March, and I think they will hold this till the elections are over. And I do expect that UP will go off the block. Also, there is a lot of interest which is being shown by a few of the other states, including on the parallel licensing, and Government of India is very keen to take it forward. So I do expect that in next 6 months, many of the states will go for parallel licensing as well as some of the other distribution reforms of PPP and other arrangements. So this will be a good opportunity for us going forward.
Okay. So maybe after UP elections, the Discom there perhaps, comes up. So it's kind of stalled for now, as you said. Parallel licensing, Goa and Karnataka, there are reports from both states, and you said perhaps others will take this up as well. Could you give us a sense whether this is earnings accretive, sir?
So basically, in parallel licensing, you don't create a infrastructure for distribution once again, excepting in those places where the infrastructure is not available. So there is no duplication of infrastructure. It's, I would say, more better utilization of the infrastructure that takes place. And competition always brings better results for the consumer. So from a consumer perspective, it is very good. From even the existing Discom, because the network is utilized more, their earning potential increases. And for the state government also, the losses which are there in the state discoms, that gets reduced tremendously. So it's a win-win for everyone. And I do hope that some of the states where we are in discussion will happen. Also, the regulatory mandate as well as the policy mandate through the policy interventions from Government of India should also happen. And we do expect that this will bring much competition and freshness in the distribution sector, which is much needed.
Sir, morning, Rima here. Your solar revenues up 53%, margins at 25%. Is that sustainable?
Yeah, absolutely. In fact, that's the model that we are working on. And I do expect that the subsequent quarters, you will see much better result now that all these are operating at very good performance level.
And you have plans to scale to 10 gigawatt cell and module ingot integration. What has been spent so far? What is the total capacity that's commissioned and the timeline to ramp it up?
So we have the 4.3 gigawatt cell and module plant, which is operating at very good capacity. And we have seen in the last quarter, for the first time, it crossed in one quarter 1 gigawatt of manufacturing of module. We expect this pace to continue because now the plant is fully ramped up and is working at the highest efficiency levels. We don't have plans to add the cell and module capacity because there is already overcapacity in the country. We are definitely setting up a wafer and ingot plant in 2 stages of 5 gigawatt each. The work will start in October and we will commission the plant by January of 28.
And sir, your overall capex number, I think last time you'd spoken about 25,000 crore of capex for the company in FY27. How much has been spent so far, and does this number hold?
So in the first quarter, we spent 5,300 crores. This record first quarter spent. This demonstrates that many of our projects which we are implementing this year are having very good traction. We do expect that this will continue going forward. Of course, the second quarter is little muted because of the rains, But the third and fourth quarter, we will be able to catch up and do the 25,000. So you will see a lot of capacity addition, 2.5 gigawatt of large utility scale renewable projects will come up. Apart from that, the transmission lines and the distribution business and the Mumbai transmission will happen. So we are very confident of achieving these numbers.
Sir, and on the Mundra, you spoke about how 3 states you're likely to sign on by August and perhaps the 4th one by September. So once this, cost pass-through framework kicks in with all these other additional states, what would the profitability of Mundra look like?
So we will be in virtually quids on this because the arrangement is that the coal is a pass-through, and all the other costs will be on actual basis, so that it is cost reflective. So it's not that we'll make profit on that, but we'll not make loss also in Mundra.
Mr. Sinha, sorry, just a out of the box question on plans to, as far as should I say, the nuclear opportunity, right? The bill has been passed. Is the group thinking of it in a serious way? We've had this chat before. I mean, long back. Anything moving there?
Yeah, I think we have been in very advanced discussions with both Department of Atomic Energy as well as NPCIL. And we are waiting for the rules to come in which the licensing conditions and licensing requirements and also how the fuel tie-up will take place. Meanwhile, our discussions are going with NPCIL in terms of the type of technology support they will provide. Typically, they have the 220 megawatt units and also the 700 megawatt unit. Also, we are in discussions with the Department of Atomic Energy in terms of what will be the long-term sourcing of uranium and other fuels that we require. So I think there's very good discussion. We have already started the process of acquisition of land in 3 places. The geotechnical studies are going on, and possibly in next 6 months, the studies will get over, and we'll possibly be ready at that time to start going for the various approvals which are required to set up this plant.
I see. And you would you would look at 220 or the 750 capacity one, sir?
So we are looking for both the 220 units. Typically, they are set up in pairs, so 2 of 220.
Okay.
We are also looking at 2 of 700. But again, availability of water, availability of fuel, those will be the determining factor.
But all the liability issues, etc., those are all sorted out now, right?
That is part of the bill, and that will also get reflected in the rules that will be notified.
Got it. Any capital expenditure, anything you're thinking of? Because these are large, long gestation projects, right? And capex heavy. And what would be the intention to invest here?
So right now, we have not got into the details of it. We already have a huge capex plan of 1 lakh crore in the next 5 years. So I think this will be over and above that. Once we have better clarity, whether it is the 220 or 700, we'll be able to come back with the details of the capex plan.
Okay, maybe next 6 months, as you said, we'll have clarity. Thank you very much, Mr. Sinha. Appreciate you joining us. Good speaking with you here on CNBC TV 18. Thank you.
Thank you. Thank you very much.
All right, HUDCO is the next management of the program. The company's posted a good set of numbers for the quarter. Record sanctions, disbursements, resilient asset quality has driven performance. We have the management, Sanjay Kulchetra, Chairman and MD at HUDCO, joining us now. Mr. Kulchetra, thank you very much, sir. Good morning. Thank you for being here, as always, on CNBC TV 18. You know, right off the bat, first, if we can tackle loan book growth, sir, for the full year, FY27, what should we expect, sir, after the strong showing that we've seen in the first quarter?
So we had last 2 years back, we had came with the guidelines that by FY26, our loan book will be around 1.5, and we had crossed that point. And for FY30, we have a target that we will be achieving around 3 lakh crores. But going the way and the opportunities which are available in the urban sector and the role of the HUDCO in creation of the urban ecosystem, I am very sure that next year we need to review these numbers. For this financial year, I am sure that we will be around 2 lakh crores kind of loan book. The way our commitments is there for the loans, the way the projects are in progress, and the way we are planning our lending operations.
Loan book will be 2 lakh crores, is what you're saying?
Around that point, yeah.
By the end of this financial year, FY27. Okay, got it. Just a quick word on the yields that you will make on this. The yields came off, right? Some 30-35 basis points in the quarter. Have they bottomed out, or there is more pressure?
It's not a kind of bottom out, but you can understand the way we are increasing our loan book. Yes, there is a pressure on the yields, but I am very sure in a quarter or so, they will be stabilized, and across the market, the pressures are coming because we are doing the business which is required as a standard business, which will remain as a sustainable business, bankable business, and the viable business. So yes, of course, to find out the good business, to good projects, good entities, there will be some pressure on the yield, but I can tell the market that we will not go below the spread of 2%, and presently also it is around 1.83%, and with the policies of the RBI swap and other windows which are available with HUDCO, I am very sure that we will be maintaining the 2% of the spread by the end of this financial year, and our NIMs will be above 3%. So it's a temporary phase because we are catering to the needs of the market.
So basically, sir, for good quality, assets, the yield on the loans is coming down, but you're able to maintain your spreads by borrowing cheaply. Is that correct? So what is your borrowing cost estimate? What is your borrowing cost as the year progresses? We've seen a decline currently. How much more can you bring it down, and what would be the mechanism?
So it's a continual effort to cut down the cost of funds, and a lot of opportunities are available. Recently, RBI swap window is available, and we are taking full advantage of that, and we are taking the dollar-denominated loan. So the parting of the hedging cost and the responsibility will be there with the RBI. So we are taking that advantage, and presently we had tied up around $2 billion USD already. So it will be utilized for repayment of our costlier loans and the disbursement of our loans, and definitely this will create the value in the company, and it will also cut down our cost of funds. At the same time, we are cutting down the internal cost of the company's operations also, be it the compliance cost or be it the SQLA. So on every front we are working. Thirdly, we are resolving our assets. We want that it should be a net NPA zero company. Presently, we are around 0.48, and we want to come to zero. So there will be positive income from these assets. And lastly, we are monetizing our assets, whatever available with the HUDCO. And it will also create some income towards that. So it is not only the interest income. We are making a bouquet of the incomes to create that kind of value for the ecosystem.
All right. Hi, Mr. Kurusheshwar, and good to have you on the show, sir. How do you see the book evolve, though? Urban infrastructure, I think, has moved up to around 75% of the mix. So how do you see that move? And affordable housing is gradually decreasing. So what's the ideal mix you're looking at?
So I will come to your question after my answer. I will start with the PMAY 1 was very successful, and the state has taken a lot of funds from HUDCO. HUDCO was partnering the counterpart requirement of the states. So fortunately, states don't want a counterpart this time. Some of the states has taken. But that is not a point of worry. But the way our core infrastructure has developed in last 10 years, like it's Amrit or Swachh Bharat or Metro or RRTS, or the vision for creation of the new cities, all these things are coming as a big opportunity for the HUDCO. And I think that is the main role and responsibility of the companies like HUDCO to create a value in the urban ecosystem. Not only it's a loan, it's an outcome-based kind of loan that we are working upon. So definitely, I cannot come out with any figure on the housing or affordable housing or urban infrastructure, but we will be remaining more than 75% into the urban infrastructure because it's a requirement. It's a regulatory requirement of the RBI.
So you spoke about how you're trying to bring down the costs internally as well. To what extent have you used cost optimization to bring down costs? What's been the extent of saving?
So I cannot tell you in terms of the dollar or rupees, but yes, we had cut down our processes. It's a total paperless office now. Then we are cutting down on our regulatory requirement cost also through the IT interventions wherever it is required. We have started taking the help of AI in our appraisal notes also. There are few things that we are doing like leveraging the technologies, leveraging the human manpower. So then how to create value in the SQL, and then the internal monetization of assets, resolution of the assets which are bad. Of course, these are very not significant, but yes, they are also creating value within the company.
And you also said that how your net NPA is right now 0.4%, but the goal is to bring it down to 0. And I can see that you've not added any new NPA accounts in Q1. Will that continue? And what is the recovery we should expect?
It is not Q1. I think from last 15 quarters, there is no NPA. It is only the result of our highly diligent kind of mechanism in appraisal of the projects and the monitoring of these projects. At the same time, I am very sure that these kind of trend will continue. And regarding the targets, because a lot of projects out of 1,600 odd crores, some projects, most of our projects under our NCLT. So I cannot comment on the timelines, but yes, they are in the advanced phase of the resolution.
All right, Mr. Kulchitra, thank you very much, sir.
Thank you.
Good speaking with you. Good luck. Appreciate you coming on here on CNBC TV 18 as always. You know, the markets, I think, taken a bit of a turn for the worse. We're up just 6 points. Market breadth is slightly negative. You got about 1,800 stocks lower and about 1,000 stocks which are higher at this stage. Look at CG Power. You know, CG Power is down 5%. Numbers, of course, were a bit of a miss. It kind of held on, came off a little bit on that day and the day after, but not very much. But today, of course, the full reaction, in essence, coming through. And so much more. I mean, car trade, but to be fair, just profit booking on car trade after just yesterday had a massive move. Viatec Vabag is the other one, which is down 5.25%. Many of these are big movers, right? Godfrey Phillips, as we were saying earlier in the morning, reported numbers, but stock had run up from $2,000 to about $22.50. So it's coming off after the results, which have not, which have disappointed. Hitachi is down about 2.6%. These are, of course, well-traded names. There is Cenuris Pharma. Again, stocks down about 5.25%. Big volumes on this one at this stage. MTAR Tech continues to sell off. It had a bit of a brief reprieve, right? From 5,500, after falling one way to 5,500, it came up to about 6,000 plus, but back at about 5,500 once again. HUL numbers. Stock is seeing a sharp dip as we speak, and the results are coming through. So let's have the HUL earnings up on the screen. I think there is volume growth numbers, which we already have. And we have a profit number of about 2,673 crores, which would be about 100. I mean, I think a miss, and that's the reason why the stock is reacting. There you go. 2,673 crores is the profit. The poll showed us that the profit should have been about 2,800 crores plus, and I think the volume number should be coming up shortly as well. Volume growth numbers from Lever, always important to track. So stocks are down about 3.6 odd percent, and revenues and margins and other things will follow. Mangalam should be with us, helping us in a bit with some of these numbers as we look at it. So let's just stay with this, maybe get a reaction from an analyst as well. But this is essentially the one number that we're sticking with. I think Mangalam is with us. I think we've got revenues at about 17,350 odd crores or so. EBITDA at about 3,950 odd crores as well. So lots of those numbers we will put out. But Mangalam is with us. We can go across to him. Mangalam, take it away.
Well, you know, it so appears that maybe there could be an element of a one-off in the bottom line because the revenue as well as the EBITDA are largely in line with street expectations. So the EBITDA at around 3950 crores. We were expecting a number of almost 3981 crores. So that's pretty much in line. Revenue, if anything, is a shade better than street expectations. 17341 crores compares with our poll of 17235 crores, which implies that the revenue growth for the company has been closer to around, an 8.5%. The volume growth that has come in, that's at 5%. This is slightly shy of street expectations of 6 to 7%, but really no worries as far as the reported revenue and the EBITDA is concerned. We'll probably look at details and try and find out whether there is an exceptional element which has caused the net profit to be slightly lower than street expectations, because revenue at 17,341 crores is a growth of over 8%, which is actually one of the highest growths that we've seen for Unilever in the last many quarters. Margins as well at 23%. The street was expecting a number of 23.1%. No real problems out there. Even the volume growth at 5% is a slight miss versus expectations, but nothing to suggest, the kind of deep gash that we're seeing on HUL, the stock price right now. Maybe the street was anticipating a big beat coming in, given the sort of numbers that we've seen from the likes of, Dabur, Godrej Consumer and Marico in their pre-quarterly update, and the street was betting big on the staples pack doing well, but turns out that a slight miss because at elevated expectations has the stock lower. But if you just look at these numbers in isolation, the revenue growth is fairly strong. Volumes at 5%, marginally below street expectations of 6 to 7%. And we have margins at 23% as well, which is pretty much in line.
I think we have, Mangalam, stay with us. Sandeep Abhange, research analyst, consumer and mid-caps at LKP Securities is with us. Thanks for joining in, Sandeep. First reactions on the lever numbers?
Yeah, I believe results are quite in line, and it was as expected in terms of the volume growth as well as in the revenue growth as well. So it is one of the highest revenue growth in the past few quarters, and we believe that this is expected to sustain for the next few quarters with the kind of results that are expected for almost all across all the staple companies. And the main surprise has come in on the margin side. Margins are also are looking quite stable at 23% approximately. So I believe overall these are inline results, and I expect this kind of volume growth to continue for a few more quarters.
Sandeep, but is the volume growth lower than what some of the other peers, comparable peers, have reported? Would that be a concern? Because the stock is still sliding, down 4.5%.
Yeah. So if you see HUL, it has been giving volume growth of close to 2 to 3%. So that was the highest volume growth which they had reported in some of the past few quarters. And considering that, 5% volume growth is quite is better as compared to their own historical numbers are concerned. But as compared to other companies, of course, the product profiles and the categories are quite different. So I believe if you compare it with HUL's own historical performance, this has been a better performance, and it is likely to get sustained over the few quarters as well, considering its size and the overall product categories in which they are presented.
Mangalam, you want to make a point?
Yep, there are a few more details that we have as well, and the internals aren't particularly bad, Prashant. The home care business has actually grown at 14%. The street was working with a number of 12 to 16%. We've had 12% growth coming in for their beauty and wellness segment as well, and there is 7% growth which has come in foods and refreshments. This again, as against expectations of 7 to 8%. The only miss in terms of revenue growth has been personal care, which has grown at 4%. Here the expectations were 6 to 8%. But 3 quarters of their business doing a lot better than expected. In fact, if not in line with expectations, and one leading to a slight miss has caused the volumes to grow at 5% versus 6 to 7% that the street was anticipating. Cannot equate the stock price move right now to just the reported numbers, which are pretty much in line with street expectations. Just a marginal miss on the volumes that have come by.
Yeah.
Okay. I remember, Mangalam, but a couple of quarters back, the company had lowered their margin guidance to focus on volumes because they wanted that volume-led growth. So in that context, a 5% volume growth, as Sandeep was saying, it's better than the company's own historical track record of volume growth, but it's still missing the mark.
Well, you have to be, cognizant of the base as well. Last quarter, the volumes grew by 6%, but that was on a base of flattish volume growth, if not negative volume growth. And this time around, the volume growth is 5% on a base of 4%. So on a compounded basis, mid-single digit volume growth is not particularly bad. Add to that, you have the price growth coming in as well. And with all of this kind of uncertainty that we're seeing in raw material prices, the company's gone ahead and maintained their margin guidance. So all these factors means that they are better positioned now than before. Despite the volatility that we've seen in the raw material prices, they've maintained their margin guidance. Volumes on a 2-year CAGR basis, much better in the first quarter than what it was in the fourth quarter. And the company maintaining their margin guidance only tells you that, they are chasing volumes even after the uncertainty that we're seeing in raw material prices with price hikes coming in. So that's near high single digit, overall sales growth led by price growth.
Okay, thank you very much for that. And on demand, the company is saying FY27 to be better than FY26. And as Mangalam said, the company is holding on to its margin guidance. We will get into a break. We'll come back with more stock-specific action. Stay tuned. Welcome back. Orion Pro Solutions is tanking post the numbers. The company's revenue growth on a year-on-year basis is only 6%. This is 2 consecutive quarters when the revenue growth is mid-single digits, and this was a company which was growing 20, 25, 30% prior to that. So there's been a sharp slowdown, and the company is saying we are watchful of the geopolitical environment which could continue to delay execution in the Middle East market. Because of a softer revenue, even margins at 17.2% is the lowest that we've seen at least in the last 2 or 3 years. So there is that margin miss, and the stock today is correcting. We will get into a break. On the other side is our special segment. It's the economy. Lata will connect with Chetan Iyer of Morgan Stanley on the strong capex cycle in Asia and its impact on India.
Welcome to It's the Economy. One standout takeaway from the current earnings season is the excellent showing by Indian banks, especially on credit growth, or what they call advances growth. India's bank credit growth is 18.6% as of June 30th, which is the fastest in 2 years. But a Morgan Stanley report points out that this is not an India-specific achievement. Bank credit growth in all of Asia, ex-China, is growing at the fastest pace in 18 years because of a massive capex cycle in many Asian countries. So is India's growth getting boosted by Asia? And what is the outlook for both India and Asia in terms of credit growth and its spillovers? I have with me the author of the Morgan Stanley report, Chetan Ahia, the company's chief Asia economist. Well-known face here. Good morning, Chetan. Thank you very much indeed for joining us. This comes as a bit of a surprise. One knew that there is a capex cycle because of the AI-related expenses, but strongest in 18 years, is that the record in Asia?
Yeah, that's right, Lata. So the last we had seen this kind of credit growth in the region, excluding China, was in the 2000 period. That was, we think, is a very similar cycle to what we are looking out for in this cycle. So in 2000s, we had a capex and exports-driven cycle in Asia, and we have something similar that is ongoing in the whole region. And India specifically has also got this domestic factors supporting the capex cycle, particularly the onshoring of industrial supply chain related investments. But that's kind of the main driver for this the cycle, is that the capex cycle is the biggest driver. And then the attended point that we are highlighting in the report is that the corporate sector loan growth is much faster than the household loan growth. Yes, the household loan growth has also come back and it's improving at the margin, but it's the industrial sector which is really leading this way on credit growth recharge in Asia.
Okay. Well, is it fair to say that India's credit growth and general GDP growth is getting some positive spillover from Asia? Because, you know, if I looked at after reading your report, I looked at the May-June export numbers. You know, a substantial, strong growth is coming from engineering goods. It's not necessarily from the traditional ones. So do you think the Asian growth is having some kind of a positive rub-off?
Yes, absolutely. And so it's not just Asian growth. I mean, the capex cycle is a global story. So we have a global capex cycle that is underway. And one of my favorite indicators to track that is capital goods imports. This is a high frequency data point which we have correlated well with the GDP component of capex. And that's actually very strong across the world. So US is growing at 33%. Asia is growing at around 30%, and Europe is growing at 21%. This is the capital goods imports in dollar terms on a year-on-year basis. And this is then therefore reflected in global trade and helping Asia's exports as well as India's exports. Now, there is, of course, there's some component of capex when I mentioned US and Europe. There's also Asia ex-India, which is doing capex, and that also helps India's exports. But it's really US, which is the biggest component of this global capex driver.
Okay. Well, take us through this. You know, I must tell you that I also felt that there is something about the Indian data, micro and macro, which reminds me of the 2004 to 2008 period, which during which time also I have interviewed you. For instance, you know, the bank earnings. It is not just that the credit growth is much stronger than it was in the previous few years. Even the amount of defaults has fallen, which means everyone is able to pay back the money. I've never seen such low NPAs in the Indian sector. It is even better than in the 2004 period. So do you think that it feels like the 2004 period yet again in India? Is that a fair comparison?
That's right. And Lata, if you just remember at that time, banks' balance sheets were in a great shape because they had done a lot of provisioning.
Yeah.
And then in the real economy, the corporate sector balance sheet was also in a great shape because they had not really leveraged. And this is the same thing. We look at this actually, again, not just in India, Asia, but also world across. So corporate debt to GDP is lower than pre-COVID levels in Asia, Europe, and US. So the private sector balance sheets are in a great shape, and that's also reflected in the banks' balance sheets, which are also in a good shape. So we are seeing this sort of like a new capex cycle, which can be easily funded by the banking system and capital markets. So yes, it pretty much feels like in India also like the way it was in 2004.
Okay. I actually did a lot of digital videos arguing that this looks so much like a 7% plus GDP growth economy because of some of the micro factors and macro factors that remind me of the 2004 period. Yet, RBI is sitting at 6.6 for 6.7 for the full year and 6.6 for the quarter just gone by, April, May, June. Do you think we are all underestimating that this is very clearly a 7 to 7.5 growth economy?
Yeah, so we are saying there are upside risks to our estimates. And by the way, Lata, our India economist is also forecasting 6.7%. So we are in the same camp as almost as RBI's numbers. And then we are highlighting the upside risk because of the way the data is panning out. But the reason for this is effectively the oil shock that we had all witnessed. And yes, it's come down back again, but it's still hovering around, 85 plus. So that's the reason why the numbers are somewhat softer. But if you take this shock out, then going forward, once we are clear on the oil issue, growth should come back to 7% plus.
Okay. Well, Goldman Sachs and Citi have come to 6.9. I don't know if it is because of my cajoling, but no one still has the courage to put that 7 number. But I'm going very strongly with a 7 plus. Let us see what we get on August 29.
But you are making impliedly an assumption that oil prices will not be an issue. Well, if that turns out to be the case, you will be right. Okay. And our upside risk call will come right as well.
No, my point is, in spite of the oil issue, in April, May, June, India's exports grew by 16%. I can't remember a time when the quarterly export growth was so strong, and much of it is engineering exports. Some of it is, I agree, petroleum product exports, where the price hike has gone on. But that growth, as well as credit growth, for instance, PMI, even consumption, most of the FMCG companies, barring Hindustan Unilever, which just reported, are reporting close to double-digit volume growth. So anyway, that's it. This is not my view. I want more your view. I want to know, the one skepticism that my colleague Rima, who was just listening to the conversation, told me, is this all AI driven, at least in Asia? And if this AI were to falter, like we now see the stock market casting some aspersions on the AI cycle, will this wither away, and by when? Or will this falter, this capex growth?
Yeah, so firstly, Lata, it's still a question mark whether AI capex will be significantly affected because of what the markets are telling us. Okay. Our house view is that AI capex will still continue to be strong. But let's say that AI capex does get impacted as the markets are worried about right now. We still don't think it takes away the Asia capex supercycle story for us. To explain to you in greater detail, Asia's AI capex is just about $130 billion in 2026. Semiconductor companies' capex is $250 billion. Ooh. So taken together, even if I am including semiconductor companies' capex into this AI capex bucket, it would be $380 billion. Now, on the other hand, just the energy capex alone in Asia will be $900 billion. Oh. Even in terms of change that we are forecasting, we're expecting this AI plus semiconductor capex to go next year from $380 billion to $450 billion. Whereas energy capex will go from $900 billion to $1 trillion. So even in terms of delta, energy is going to be more than AI. So as Asia is concerned, we think that AI is a part of the story. It is not the whole of the story. And therefore, this cycle has more legs. Also, one other component that we are highlighting, which is a big driver to capex in Asia, is the onshoring of industrial supply chain. If you just take the case of India, we think India's manufacturing sector is at an inflection point. the government has taken a lot of measures, and we have onshored a lot of capacities, a lot of new projects are getting announced. All that is going to translate into big-time capex. And again, this is not just India; it's also happening in rest of Asia. For different reasons. People are onshoring because of business continuity, what we saw during COVID. People are onshoring capex because there was a constraint that China had imposed on rare earth magnets. People are onshoring because of the Middle East conflict, and then now they don't want to be dependent on imported oil and gas. So there are different reasons why people want to onshore industrial capacity. But this is happening in a big way, and it's a big driver. So this is not connected to AI alone.
Okay. Actually, I have many more questions for you, Chetan. Unfortunately, out of time. I'm going to take a half an hour time with you next time so we can have a more comprehensive discussion. Thank you very much for joining us and giving us a slightly more rounded picture of the current growth numbers and credit growth numbers that we are seeing in India as well. It's not an isolated phenomenon. It's part of a global capex and definitely an Asian credit growth cycle. So we should expect it to sustain. Wrap up on Bazaar on that note. Chartbuster is after.
Elevated crude prices keeps global equities on tenterhooks. US chip names extend declines into a third session. Despite the global rout, Indian IT opens on a high as Street weigh a slim but lingering chance of a rate hike from the Fed. Heavyweights TCS, Infosys and Tech Mahindra gain.
Hindustan Unilever loses ground after disappointing Q1 results. The domestic volume growth of around 5% misses estimates of around 6 to 7%, while a 900+ crore tax hit dents profitability, which comes in lower by 3%. The shares of the FMCG heavyweight are under pressure in early trade.
Shares of Coal India skid on the back of a weak showing in April to June quarter. High operating costs and lower than expected e-auction volumes trigger an EBITDA miss. Jefferies sees earnings improvement with 6% CAGR over FY26 to FY29 and retains a buy.
Coforge delivers a strong growth, reporting a 21% sequential growth in dollar revenue terms. Combined EBIT margins come in at around 16%, tops its FY27 guidance of around 15.5%. Speaking of CNBC TV 18, CEO Sudhir Singh says that the company remains confident of sustaining growth despite a challenging environment. The stock jumps up in early trade.
Godfrey Phillips slips after a weak set of numbers. Volumes contract both YOY and on a quarter-on-quarter basis, while net profits drops 44%. Management says it will pursue a balanced pricing strategy to limit the impact on consumers going forward.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me today is Sonal. Hey, Sonal, good to have you on the show. Well, markets are more or less flattish, but plenty of action in the broader markets.
A lot of action, and we are already towards the end of July. We are talking about a fresh new series from tomorrow. Yeah. It's going to be a volatile last one out of trade, considering that it is going to be the last day of July series. And of course, we've seen a lot of action come by as well. There was a wee bit of recovery at around 10:15, but then we have been quite flat since the word go. Let's now talk about market technicals then, and welcome Dharmesh Shah for a technical check on the markets. Dharmesh, good morning. Thank you so much for joining us. Well, what do you suggest in terms of market levels that one should keep an eye out on? Are you expecting the last 1 hour to be very volatile?
Yeah, so good morning, Sonal. Absolutely, I think so. Today being an expiry day, so we are expecting more for volatility in the market. But yes, in the downside, we believe again 23,800, 23,900 will act as an immediate support for the Nifty in the near term. As far as medium term view is concerned, if you look at the market from the medium term perspective, for last 5 weeks, we have been trading in this range of 23,600 to 24,500. But interesting point to highlight is that the Nifty seems to be finding the support at the 61% retracement of this entire rally, supported by the trendline support. It looks like, I think so, market looks for much higher targets in the days to come. Strong base formation in this range of 23,800 to 24,300 should initially see a breakout on the higher side, and we should be looking for a target of 24,600 to 24,800 in the month of August. So it's something a buy on dip should be the strategy going forward, but 23,600 to 700 remains to be the very strong support, and on the higher side we expect Nifty to head towards 24,600 in the days to come.
Okay, all right. What about individual stocks in Dharmesh?
As far as the stocks are concerned, we remain to be positive for the banking BFSI overall, where again PNB remains to be our topic. If you look at the PNB from the medium term perspective, the weekly chart seems to be forming a strong base formation in this range of 99 to 115. Finally, it looks like, I think so, PNB is on the verge of breakout with strong sets of volumes. Looks for a target of around 120, keeping a stop loss of 106. Apart from PNB, on the microfinance side, we remain to be constructive, positive for Ujjivan, small finance bank. Again, strong sets of numbers. Again, on the also technically also, if you look, I think so, a chart seems to be forming a cup and handle breakout, and it's supported by strong sets of volumes. Also from the multi-year breakout from 2019 till date, I think so, stock has been trading in this range of 71 to 40, finally on the verge of breakout. So multi-year breakout indicating a structural change happening for Ujjivan. The short-term perspective, we expect the stock to head towards 81, giving a stop loss of 67. So PNB and Ujjivan remains to be our top pick.
Okay, take that point, Dharmesh. Thank you so much for joining us. So those are some technical bets that we have for you. But we'll also focus now on our special segment where we'll get you a few ideas for profit from Money Control Pro. Lekha Badlani Jumnani of moneycontrol.com joins us now to talk about a stock that she's tracking closely. Lekha.
Yes, thanks. So my stock pick is Vijay Diagnostics, one of India's highest quality diagnostics companies that has demonstrated that profitable growth and expansion can go hand in hand. Now, this was evident in its Q4 FY26 performance, where revenue grew 27% YOY, while EBITDA increased 39%, resulting in EBITDA margin of close to 44%. More importantly, growth was largely volume-led, with test volumes increasing 18%, highlighting strong patient additions rather than aggressive price hikes. What gives us greater confidence in this company is its execution. Now, Vijaya has successfully expanded into newer markets such as Pune and Gurugram while maintaining industry-leading margins. Newly commissioned centers have achieved break-even within just 2 quarters, demonstrating its ability to replicate its operating model outside its core market and generating operating leverage much faster than the industry. Now, looking ahead, management plans to accelerate expansion through new hub-and-spoke centers while investing in AI-enabled diagnostics, lab automation, and genomics. Now, the long-term industry outlook also remains compelling. Rising healthcare awareness, increasing adoption of preventive testing, a growing burden of chronic diseases, and the continued shift from unorganized to organized diagnostics provide a long runway for growth. We believe Vijaya is well positioned to deliver sustained earnings compounding. At 28x FY28 estimated EV/EBITDA, the valuation is reasonable to own a high-quality business with long-term structural growth drivers.
For that, Lekha, well, time to slip into a short break. On the other side, we have the management of RR Kabel that's waiting to discuss their strong first quarter showing and guide us on the way ahead. Stay tuned. Welcome back. You're tuned in Chartbusters. You're on CNBC TV 18. Well, from the broader markets, we've got a couple of bright results. And one such company is RR Kabel. They reported a strong showing with the revenue surging more than 50%, led by robust growth in the cables and wires business. Joining us now to discuss the past quarter is Mr. Rajesh Kabra, the joint MD of the company. Hi, Mr. Kabra. Good morning, and thanks a lot for joining in. Well, give us a few details. Your volume growth actually has been very, very strong. And if I look at it in terms of revenues as well, you're outgrowing your larger peers. What are you doing so right to see this sort of growth that is outbeating the larger peers? And what is the growth we should look at going ahead in volume terms for this year?
Good morning. Firstly, it's a pleasure to be here as always. I think the last quarter for RR Kabel has been one, that has, while it's been full of turbulence, but one driven by a very strong execution. Our volumetric growth last quarter was around 17%. And what we hope to achieve in the year on a volumetric basis is around a 16 to 18% growth rate going forward.
Okay.
And our cables business has outperformed the wires business this quarter, which has driven a large part of the volumetric growth.
All right. And your mix right now is still in favor of wires, right? Is it 65-35 or 70-30, something like that?
It's about 70-30, 70% wires and 30% cables.
Okay. Mr. Kabra, you spoke about the volume growth that you're looking at. What about EBITDA margins? Because on raw material costs, you did indicate in your conference call that costs were up by around 30% if we compare it to the same time last quarter. How much higher are costs currently, and what happens to your guidance of FY28 margins of around 10.5%? Do you maintain that? Are you doing that by raising your prices? What makes you confident on that number as well?
So, we're in a business which has a pass-through mechanism. So any price hike or any price cut down, we are able to pass it on to the customers within 15 odd days. Given the current margin expansion that, we have stated in Mission Rise, we, at this point in time, we look at achieving 10.5% EBIT margin on the wires and cables business for FY28, and we feel fairly confident about that.
Okay, so if you're confident about meeting the numbers and you are able to pass on the price hikes to customers as well, is it impacting demand in any way? What are the demand trends looking like currently? And because of elevated raw material prices, is there any impact on inventory? Are you seeing destocking, stocking? What's the update on the channel right now?
Okay, so on the channel at this point in time, whenever commodity prices sort of soften a bit, there is a slight bit of destocking which happens, and we saw that towards the second half of June. But at this point, the demand is fairly robust. At the same time, we must understand that wires and cables has a very large end customer set, and it is a product which is a C-class item, or a 3 to 4% or maximum 5% BOQ cost in any project or component that it goes into. So any rise in commodity prices will not really impact demand structurally in a downward direction.
Okay, all right. So you're saying the cables and wires business, EBIT margin will be 10.5%, right?
Correct. Next year, FY28, yes.
And FMEG business continues to remain in the black?
Yeah, so we have, last quarter we've broken even. We want to next year move into profitability and hope to achieve a full year break even for this financial year.
And in terms of scalability, what kind of revenues can you do?
So on FMEG, we are looking around 20% revenue growth this financial year.
Got it. In this margin number, there would be some inventory gains. Could you help us out with that? And in the coming quarter, will there be any inventory gain or loss?
See, inventory gains and losses both are part of regular business cycle. So the way we see any business in our industry is that you have some months which give an inventory loss and some months which give an inventory gain. So this is, for us, is a part of business as usual, and that's how we look at it. At this point in time, last quarter, we've not seen any inventory gain that is added to the bottom line of the company. And going forward, it will be a part of your usual BAU.
Okay. Mr. Kabra, about the export strategy, you have been focusing there. Can you give us a sense of what the number is right now, exports as a percentage of revenues? How do you plan to scale it up? And is it more margin accretive than the domestic business?
So at this point in time, our export business is about 31% contributor to the entire wire and cable business. What we feel is that, going forward, we want both our business, domestic and export business, both sort of be treated individually to grow, at their own pace. We feel that the mix between domestic and exports will be, domestic will range between 70 to 75%, and exports will continue to range between 25 to 30%. On the margin front, domestic today does drag down the margin a slight bit, but at the same time, we feel that it's a great hedge, and we want to build a business with a global presence. So we're okay with that. And as our export business is more wire focused, we are now adding cables to the export front, and as we add capacities, that mix will continue to increase, and that is far more margin accretive to the export.
How much more? How many basis points is the export business more accretive in terms of margins?
No, at this point, because we're a wire-heavy export business, it sort of drags down the margins. But as the cable piece increases in the export portfolio, we expect the margins to get uplifted on the export side.
Okay. All right, Mr. Kabra, thank you so much for joining us today with your time and the insights on what the business would look like going forward. That's the word coming in from RR Kabel. The stock is doing well, up 3.5%. Strong performance in their cables and wires business. Though the stock has come off from the highs of the day. It was up around 7% when we started trade. It is up 4% as we speak. With that, we'll do one thing. We'll slip into a short break. On the other side, Manisha Gupta will focus on the commodity space. We'll get you that update. Stay tuned. Welcome back. Well, the Nifty is up 33 points. There's swift recovery from the lows of the day, led by some of these IT names. So keep an eye out on what's happening with the Nifty IT. Nifty is at the day's high, above that 24,000 mark. But let's talk about the commodity markets now and go across to Manisha, who's focusing on metals. Manisha, what do you have for us?
Well, I'm looking at zinc prices because we are very close to those 4-year highs. $3,600 a ton has been taken yet again, and that has happened in the last couple of months various times. But we haven't been able to cross that 4-year highs, and that's exactly what the markets are looking at right now. If you look at the prices overall, we have gained up by 15.5% in this year till time, and the prices also are up nearly 28% on an year-on-year basis. And with these kind of gains, zinc actually has outperformed the overall metal as a segment. There are various reasons on why the zinc prices have been gaining up. It has to do with the fire at a sulfuric acid unit in South Korea and zinc smelter. That is the latest trigger that is keeping the prices on the higher side. But apart from that as well, it has been about Glencore's Kazanok in Kazakhstan, which continues to run at a reduced capacity. You also have Nexa smelter in Peru, which is gradually restarting operations after a fire, but the capacity utilization is still quite on the lower side. And then it also has been about uncertainty over the output at Boliden's Garpenberg mine. So when you're looking at various smelters, mines, there are issues continuing in case of zinc production there, and that has been a concern. It also has to do with the closure of Toho Zinc's Anaka operations in Japan. The markets also are looking at lower treatment charges, as it were, in this current year, carrying on from the previous year as well. That is keeping the smelter profit margins much on the lower side. The manufacturing data that we've seen come in from China, from European Union, from US are all pointing towards resilient industrial activity. This actually has been a supportive factor for across metals therein. But let me also take you through numbers in sense of production, consumption, and the kind of deficit that we are looking at for a second straight year in 2026. So demand, while as you can see, has been increasing, the deficit slightly on the lower side, but this is going to be a second straight year that global zinc markets are trading with a deficit therein. The consumption growth is kind of concentrated in developing Asian nations, and that is what the street is looking at. When you look at the Indian zinc market, the expectation is that we are looking at nearly 6 to 7% of an annual growth. So within Asia, India clearly seems to be a bright spot when it comes to zinc demand.
Got it. All right. Thanks a lot for that, Manisha. All that glitters is zinc for the time being. Thanks a lot for that. Well, let's focus on HDFC Bank. That big boy is in focus. CNBC TV has learned that the bank views the employee conduct in the MSRDC case as business overreach, while sources indicate that the issue is unlikely to hinder the CEO's appointment. Ritu joins us with all those exclusive details. Ritu?
Well, despite HDFC Bank taking the unprecedented step of penalizing a sitting CEO in the Maharashtra State Road Development Corporation or MSRDC deposit case, we've learned from top sources that the episode is unlikely to stand in the way of Sashidhar Jagdishan's reappointment as the CEO. Now, sources tell us the bank's board viewed the issue clearly as a procedural lapse, a one-off error of judgment rather than any misconduct. So now the Nomination and Remuneration Committee is expected to meet soon to consider Jagdishan's reappointment, after which, of course, the proposal goes to RBI. And our sources there also indicate the regulator is unlikely to view this entire episode as a major negative when they evaluate that extension application. Now, this, of course, comes after HDFC Bank concluded its internal review into the MSRDC deposit arrangement, with the board concluding the employee's conduct amounted to business overreach, clearly saying there was no malified action, no personal enrichment, and no improper motive. But even so, citing a potential divergence from RBI directions, the board did issue warning letters and a 1 lakh rupee monetary penalty to 3 senior employees, which apart from the CEO includes CFO Srinivasan Vaidyanathan and the Group Head of Retail Assets Arvind Vohra. Now, the timeline is very critical here because the review covers deposit mobilization arrangements in 2017 and 2021. Remember, it was Aditya Puri who was the CEO in 2017, while Sashidhar Jagdishan was the CFO. But by the time of the 2021 arrangement, of course, Jagdishan had become the CEO. Our sources say the board's action has been confined to the current management only, largely because there is limited legal leeway to pursue any kind of disciplinary penalty against former employees. RBI, however, is expected to conduct its own assessment of the MSRDC matter. Now, while accountability of individual executives rests with the bank's board, the regulator could still impose a monetary penalty on HDFC Bank if it concludes there was a regulatory violation.
All right, thank you so much for joining us with all those details, Ritu. The stock has recovered from the lows of the day, and that is leading to the recovery that we're seeing on the Nifty as well. Look at that, it is at the day's high. Big moves across the board. We do have some of these names like Reliance Industries, which is moving from the lows of the day. There's M&M, HDFC Life, Nestle India, Bajaj Auto, some of these names which are leading to the recovery from the lows for now. In the broader markets, which is outperforming for now, we do have Coforge, which continues its up move. Lodha Developers is the other one, which is up around 7.5%. We do have Newgen Software, which is high by 5.5%, and Swiggy is the other one, which is seeing gains of around 4.5%. So recovery which is underway. The big question whether that sustains or not. And with that, it's a wrap on this edition of Chartbusters. Stay tuned. Trading Hour comes up next.
Good morning, you're with us here on Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormis Patakia. Joining me as always is Ritu Singh. And well, today is the monthly expiry of the Nifty contracts and the markets are looking to stage a bit of a recovery from the lows. It's been a choppy but a range-bound start. It's a 70-point range that the market has traded in all through the morning, and now we are at the higher end of that range, 24,040, and sustaining above that 24,000 mark is going to be very important for the bulls for today's trading session as well, and of course to enter into the August series on a positive note, still at the lower end of the range that the Nifty has found itself in. The Nifty Bank has still not managed to find its range so far. It's been very, very volatile, more volatile in comparison to the Nifty all through this month, and still now below the mark of 57,000 as we speak. Ritu, hi.
Good morning, Hormaz. I mean, it's good to see 24,000 back on the frontline index. But like you said, Bank Nifty yet to find its footing, and that is the major heavyweight we're looking at. Still trading with cuts of about 120 points below that 57,000 mark at 56,970 odd as we speak. The IT pack is holding up, though, on the other end, and that is helping. The IT pack is seeing gains of almost 4%, so that's the positive end of the market. But the market breadth still looks weak. If you look at, that crisscross lines, there are about 1,830 stocks that are declining for about 1,100 stocks that are advancing. So we'll have to see if those lines intersect and that green comes out on top. But there is weakness in the banking pack, no doubt, and that's what's dragging the market lower, although there's been a bit of a recovery, especially in that heavyweight HDFC Bank in the last half hour and so on. That is reflecting in that upward move for Nifty 50 as well. There's been a smart recovery in the last half hour or so, and that's primarily on the back of what's happening with HDFC Bank as well, though still very much in the red on macros as well. It's stacking up well. Crude remains below that $88 a barrel mark, and therefore the rupee is also strengthened a bit today. But let's look at the individual movers and shakers, and Hormaz has walked over to the wall to give us that list. Hormaz.
Sustaining above 24,000 is going to be very important, and the bulls are doing every effort possible to do so. Of course, the second half is when the action will actually begin, and whether this recovery gets sold into or not, or we build on this recovery, is something that will remain to be seen. The price action that you have seen all across Asia, particularly in the Kospi this morning, and a sector that is sitting in a corner and having the last laugh with a with a smirk is the Nifty IT index, and 3.5% higher at the day's high. That is the index that is keeping the Nifty in the green and above the mark of 24,000, even as most of the other sectors continue to struggle. The stock of the morning, though, has been Coforge. The results, the management commentary, the stock is up 10%, and as a result of which it has turned positive on a year-to-date basis, becoming one of the very few IT names, apart from Oracle Financial and Tech Mahindra, that have turned positive on a year-to-date basis. Take a look at the other IT names as well. 4.5% higher on TCS, a stock that has slipped below the mark of 2,000 just last month, back at 2,400. 4.5% for Persistent as well, as is for LTM and Infosys, all of them seeing gains of between 4 to 5% in today's session. The earnings reaction of the morning, though, has been HUL, and after the volumes miss, the stock has slumped. The expectations were for a significantly higher volume growth, but it has missed expectations, and now the stock is down 4%, and that is keeping the gains in check as well on the index. So take a look at the other earnings reactions. Most of them have been on the negative side. Orient Pro Solutions is the top loser today, 11% lower on the stock after its results. Senor's Pharma as well, down 6. Godfrey Phillips has extended its losses, now down 7.5%, and Gravita too down 7% after its results that were reported last evening. Take a look at the newsmakers. Cipla, after the US FDA approval for Advair, was up 2.5%, still holding on to some of those gains. Lodha, after the upgrade that has come in from Morgan Stanley earlier in the day, 8% higher now on the stock, among the top gainers on the real estate space. PVR Inox was building on those gains earlier in the day, has come off the highs, still holding on to the green. And Ramco Systems, a 10% lower circuit on Friday, 10% lower circuit yesterday, and after the revision in price band is a 5% lower circuit in today's trading session as well. And lastly, stocks at 52-week highs. Take a look at Nilkamal, is up 6%, Cupid is up 4%, RR Kabel was up around 9% at the start of trade. We just heard from the management a few minutes ago. The stock is up around 4%, and Saregama too is having a good day at the office at a 52-week high, Ritu.
Hormaz, thanks very much for running us through that exhaustive list, as always, to prepare us for the next hour. But let's invite in our first management on the show. We have Home First Finance, which has posted a healthy set of first quarter earnings with strong growth and marginally improving asset quality as well. Let's go across to MD and CEO Manoj Vishwanathan to discuss more on their numbers. Mr. Vishwanathan, thanks very much for your time here on CNBC TV 18. Very strong AUM growth of 25.7% year-on-year, 6.7% sequentially, and an even stronger disbursement growth of 31%. What drove this kind of a disbursement growth, and do you expect to, exceed this 25% kind of an AUM growth for the full year as well?
Yes, we are confident of a 25% growth for the full year. If we get enough tailwinds, then we could probably, exceed the 25%. What has led to this? I think since last October, we are seeing fairly strong demand on the ground. And we have been preparing for the last 1 year. We have been building our teams and distribution. So we were able to capitalize on this, demand which was picking up right from October onwards, and that demand still continues.
Was there any reason that the repayments look lower in the first quarter? You're talking about the 31% plus disbursement and, sustaining AUM above 25%, which again was higher this quarter. Any reason for the lower repayment rate then?
Yes, the balance transfer rates have come down. So about 12 to 18 months ago, we embarked on a protocol to control the balance transfers. And that whole process seems to be working well for us. So last quarter, we were able to bring the balance transfer rate, below its normal range. So normally it is in the 5 to 7% range, but last quarter we were able to bring it below 5%. So that is, I think all the protocols that we put in place have started working.
Mr. Viswanathan, a couple of questions. First up, your stage 3 PCR. What is the reason behind the sequential decline that you have seen? And where do you see that figure going forward as well?
Marginal. It's a very marginal decline. I think it is just, quarter to quarter, there are, some variations, and that's all there is to it. Nothing more to be read into it. We try to maintain it in that 25-27% range.
Clubbing two questions into one, Mr. Viswanathan. First up, what is your average ticket size currently, and do you expect that to increase further considering the fact that property prices are rising? And part two is whether first-time buyers are the ones that are continuing to dominate the demand within this space.
Yeah, within the space, it's first-time buyers, and 90% plus of the customers are first-time buyers. But as you mentioned, ticket sizes are inching up, and it is just a testimony to in rising incomes and more prosperity across in most of our markets. So people are more aspirational; they want larger homes. So as a result, ticket sizes are inching up. So yes, we expect to, and we have always been guiding to that ticket sizes will keep going up in this segment. While the customer segment remains the same, and these are basically affordable housing customers, first-time home buyers, the ticket sizes keep on inching up quarter on quarter.
Okay, ticket sizes keep on inching up. I believe the RBI is widely expected to hike rates sometime later this year, during this financial year itself. Do you think, people sitting on the fringes, that demand typically gets impacted when rates go up? That's the first question, and then we'll come to the next one.
See, the rates that the rate movement that we are expecting now is fairly nominal, probably 25 basis points in that range. So generally, home buyers, especially first-time home buyers, do not postpone their decisions because of interest rates. They have a lot of other things, on which the home purchase is dependent. Their ability to pay down payment, ability to allocate a property, etc. So once all those boxes are ticked, they generally go ahead with the purchase. They don't wait for rates to change.
So could you leave us then, Mr. Viswanathan, with some guidance for FY27? Spreads have been flat. Where do you expect that and the margins and the biggest growth drivers, geographies or otherwise, for FY27 for the company?
So growth drivers have been our traditionally strong markets, Gujarat, Maharashtra, Madhya Pradesh. But we are also fairly confident that we'll be able to bring back growth in some of our other markets like Tamil Nadu, Telangana, Andhra, etc. To leave you with the note, I would say that we are off to a very strong start this year. That gives us the confidence that we are going to have a fairly strong year. Of course, we have given a guidance of 25% AUM growth, but we hope to exceed that.
Mr. Viswanathan, thank you for sparing time and joining us today on the show. Wish you good luck for the rest of the year as well. We'll take a short break. Lots of stocks that are buzzing around in today's session. Get your wrap of all of that. Stay tuned.
Welcome back. Let's focus on some earnings that have come in, starting with Bharat Electronics. Now, that stock has been under pressure. Their revenue, EBITDA, net profit, all of that was above estimates. What the street didn't like, though, was the margin contraction, which was sharper than what was estimated. Ria has the fine print of those numbers. Ria.
Well, yes, BEL has reacted negatively to its earnings. The stock is down nearly 3 to 3.5%. And this is even after the company posted a good set of numbers in Q1. And remember, Q1 is also the weakest quarter seasonally for the company. But despite that, the company has posted a good set of numbers for in terms of the revenue, EBITDA and net profit, all above the estimates that the street was working with. But the margin has been, the margin contraction has been sharper than what the street was estimating. Now, in terms of the revenue, that has gone up by nearly 25%. Versus estimates of a 15% growth, and this has been driven by strong execution in Q1. EBITDA and net profit also up by nearly 12 and 8%, and margins on the other hand have contracted by nearly 300 basis points to 25% nearly versus estimates of just about 150 basis point margin contraction. Now remember, these margins have normalized compared to the elevated levels that we saw in Q1 of last year and even in the previous quarter of Q4 of FY26, and this has also been led by higher material costs that we've seen this time around, nearly 55% versus around 47% that we saw last year, which has also led to some margin compression. But remember, the company has come out and said in its earnings call that this Q1 margin compression is largely due to a change in the product mix and not a structural cost pressure that they are seeing. And apart from this, in the Q1 earnings call, the company has said that they will be maintaining their guidance for FY27, which is 15% revenue growth, EBITDA margins at 28%, and order inflows to exceed nearly 55,000 crores for the year, including the QR SAM order that the company is expecting soon.
Priya, thank you for that update there. Some flashes at the bottom of your screens. Iran, Saudi Arabia and Oman have held calls to discuss the need for cooperation on the Strait of Hormuz. That is the flash coming in at the bottom of your screens from Bloomberg. Iran Foreign Minister Abbas Araghchi held calls with the Saudi and Omani counterparts. They have discussed the need for cooperation. And look at the oil prices as well, still trading around the mark of $88 a barrel for Brent. The oil prices sold off very sharply in yesterday's trading session and continue to remain subdued in today's session as well. We'll get you more details on this as they emerge during the course of the day. Of course, Saudi's involvement in this is something that needs to be monitored because there have been reports about Saudi Aramco's oil facilities being attacked by Houthis. Of course, there has been no official confirmation on this either from Saudi Arabia or from Saudi Aramco as well. So keep an eye out on these developments going forward. But of course, moving on to some other stock movers, then Orion Pro Solutions is the other one. That's down in double digits today. The first quarter performance was a muted one. Vinny is joining in with the fine print of the numbers. Vinny.
Hi, Urmaz. Absolutely a weak performance that's coming from Orion Pro. Now, when you look at it in terms of the growth, whether it's sequentially or YOY, it's a very low single-digit growth that we're seeing. Now, look at the revenue trends that come in for you as well, right? On a YOY basis, normally the company has managed to see a growth of 28 to 30%. That's the range in which they were reporting growth. In the last two quarters, that's Q4 and Q1, that growth has come to 5% in Q4, and now the growth is just 6% on a year-on-year basis. So we're seeing that low single-digit, mid-single-digit growth, which is the lowest growth that we've seen for the company coming in, which has been reporting a CAGR growth of around 30%. Now, even the EBITDA margins, I beg your pardon, that's come in at just 17.3% during this quarter, which is the lowest levels in the last couple of years for the company at least. The EBITDA margins usually are in the 20% range. So this also seen a significant compression versus last quarter, which was at 19% as well. Now that's come to 17.3%. So overall, we're seeing the profits of the company seeing a decline as well. It's been a weak set of numbers. Now, what the company is highlighting, they've added 23 logos this time. The banking fintech side of the business, that's around 4.7% growth that they've seen coming in on a year-on-year basis. Technology segment has seen an 8% growth, and overall, the deal conversions or revenue conversions, the company highlighted in the press release that is still below the normal level or the normal trajectory. They expect a couple of more quarters to actually come back to the normal levels. Now, impact this time obviously is going to be seasonality, rising input costs, supply chain disruptions. Projects are much fewer in terms of the timing shift as well. Disruption in the MEA region, geopolitical tensions, that's also a concern. MEA accounts only to 2% of their revenue, but that is also a factor that comes in here. And second consecutive quarter of double-digit revenue, a single-digit revenue growth, margins at the lowest levels, and revenue CAGR growth is something that has been muted. The stock also has been underperforming versus other IT companies in the last 1 year as well. And despite that, today we're seeing a very sharp fall because of the weak numbers.
All right, Winnie, thanks very much for getting us that update. We'll slip into a short break on that note. But when we get back, we are going to discuss what's next for HDFC Bank and its CEO reappointment process as it closes the MSRDC review. Amit Tandon of IIAS and Ashwin Parekh, managing partner at Ashwin Parekh Advisory Services, will be with us to discuss that.
Welcome back. Another stock in focus all this while has been HDFC Bank for various reasons. And today's news is the fact that the bank's managing director and CEO, CFO and retail assets head have been fined 1 lakh rupees for business overreach. Now, this comes after concluding the internal review into the Maharashtra State Road Development Corporation deposit agreement. Ritu, tell us more on this first. Set this up before we go to our guests for this.
Well, despite HDFC Bank taking that unprecedented step of penalizing a sitting CEO in this MSRDC deposit case, what we've been given to understand from top sources is that the episode is unlikely to stand in the way of Sashidhar Jagdishan's reappointment as the CEO, and that's the biggest takeaway for the street. Now, sources tell us the bank's board viewed the entire issue as a procedural lapse, a one-off error of judgment rather than any personal misconduct. And therefore, our sources indicate even the regulator is unlikely to view the episode as any major negative when they look at the CEO reappointment application. Now, this, of course, comes after HDFC Bank concluded that internal review into the MSRDC deposit arrangement, with the board concluding the employee's conduct amounted to business overreach, clearly stating there was no malified action, no personal enrichment, and no improper motive there. But even so, they cited a potential divergence from RBI directions, and therefore the board issued warning letters and a 1 lakh rupee monetary penalty to each of the 3 senior-most employees, which, apart from the CEO, includes the CFO Srinivasan Vaidyanathan and the Group Retail Head of Assets Arvind Vora. Now, RBI, we understand, is expected to conduct its own assessment of the MSRDC matter, and if it finds that there was any kind of regulatory violation, there could be a monetary penalty for HDFC Bank. But let's take this forward with our guests. We have Amit Tandon, MD of proxy advisory firm Institutional Investor Advisory Services, with us now, as is Ashwin Parekh, Managing Partner at Ashwin Parekh Advisory Services. Gentlemen, thank you so much for joining us here on CNBC TV 18. Mr. Parekh, to you first. How much weight do you think RBI is going to attach to these findings, this distinction that the board has made between commercial overreach and personal misconduct when they look at Sashidhar Jagdishan's reappointment application? Do you think that will still weigh on their decision?
Well, I wouldn't know what RBI will really do. I won't speculate that. Yeah. But if you go back to our earlier conversation, Ritu, I still maintain that the matter was actually not a breach, but a commercial or a market outreach. Now, after this investigation that was conducted by the independent directors at the board of HDFC Bank, they've also really reconfirmed the same matter. They said that there is no compliance kind of breach, but there is certainly a market outreach. Now, so to a certain extent, the board has really assured itself, that even when they make a recommendation, to the RBI for an extension, at least there is a basis on which they say that, after having investigated and found out, that there was more of a governance or a market outreach issue rather than a compliance or let's say a breach issue. And to that extent, I would certainly say that at least the clarity is available with the board to really decide on that. So that's one. The second one is, clearly the signal, the penalty for a sitting, for a CEO and a CFO is unprecedented. I totally agree with you. But perhaps let's look at it in a positive way. It's some kind of a signal that the board has sent out saying that from the governance point of view, it's very critical that at least for this market outreach, there is some kind of a warning, which is what has been given to the executives. And also, not just CEO and CFO, but all the executives associated with this, and a penalty to of them. Okay. So that's the way I look at it. So, I would certainly say that at least the board's conscience is clear in terms of whether they will make an extension, let's say, an application to the RBI.
Got that. So you're not commenting on how RBI will look at the application, but you're making it clear the board's conscience is clear. And this is unprecedented and stronger governance message coming out of the fact that, the very top level executives have been fined. But Mr. Amit Tandon, coming to you on that one, do you see any kind of inherent contradiction in the fact that the board, on one hand, that has penalized its CEO, is now expected to recommend his name for reappointment? Or do you think that it strengthens the process because it is in a way separating accountability from fit and proper, from fitness to lead for him?
Good morning, Ritu. Thanks for inviting me for your show. Now, the first thing is that HDFC Bank remains one of India's strongest and better managed financial institutions. And I don't think any of the analysts or any of the investors are questioning this. But, ever since the Tanu Chakrabarti resignation, where he cited certain happenings and practices that were being a little bit inconsistent with his values and ethics, the bank has kind of got pulled into various governance issues have been surfacing, whether it is with regard to board oversight, whether it is with regard to that letter itself, whether it is with regard to the MSRDC deposit taking matter, which was just been, the cause of this disclosure yesterday and the reason for our debating it today. I just want to say that, look, what is coming out is the fact that, look, there are governance issues, and governance means that are just as important as the ends, and the processes are just as important as the outcomes. It's not enough to conclude, which they had in the past, that there is no financial impact or the matters have been resolved. What investors will want assurance going forward is that the process was sound or is going to be sound, that the oversight is going to be effective, and importantly, that the right lessons have been learned. Therefore, it's not a question of looking at each of the events in isolation. Tanu Chakravarti's resignation, the MSRDC issue, the bubbling issue with the global investors, but look at it a little bit holistically and, kind of emphasize the fact that, look, there are governance, and how is it that we are going to go about building trust with the investors, which seems to suddenly take a bit of a beating over the last 6 months. And that is what the bank needs to focus going forward.
But, Ms. Tandon, are you saying more could have been done, in the spirit of governance? Have they stopped short with just this monetary penalty of 1 lakh rupees? I mean, the fact that they've made this distinction between business overreach and misconduct, can you really draw a line? Can you have a serious governance lapse while also claiming there was no malified intent?
Look, if you kind of break it up into its different in some of the components, was there any malified intent? No. Was there any, did anyone individually benefit from this? The answer is clearly no. So therefore, you kind of are looking at it and trying to say that, look, what the bank is trying to do is bring closure to issues one after the other. They did so with that external report with the chairman's resignation. They've done so now. And therefore, you can look at it in terms of saying that, look, yes, let's kind of put it behind. We've learned our lessons and we want to move forward. So that is something which the market is going to wait for and look at the clarity which they get going forward on that issue.
Okay, Mr. Parekh, you think this gives some kind of closure to investors, one governance lapse after another, and what the board has decided to do with a warning letter and a 1 lakh rupee penalty. Is that going to be enough to satisfy investors, you think?
No, so I would say, as Amit said, I suppose the bank will have to now make sure that both, the outcomes and the processes are equally critical. And processes need to be conducted sort of, in a proper manner. The way they are to be conducted. And so that's one part. The second part, however, is let's not also, overreact to something like this. And let me try and justify my statement. You see, I'll tell you, as a banking organization, it's a huge bank we are talking about. We're talking about decisions being made on a regular basis of the nature that we are talking about, deposit taking, institutional deposit taking, you have HNIs, for example, who may expect a certain order of little extra kind of rate or whatever. These are the issues that any banking company, not just HDFC Bank, go through on a regular basis. Now, sometimes, it may happen that you may not have conducted the process entirely well, or you may have outreached. In this particular case, this is clearly an outreach issue, basically. It now appears from whatever facts that are available to us that the bank got very excited with the opportunity. They thought that all the land acquisition money that, the MSRDC, the organization will get, will be parked with HDFC. They were expecting a certain amount of, business from out of this, including deposits. So to that extent, I would certainly say that it was a business decision, certainly. And you could go wrong on that business decision,
All right, Mr. Amit Tandon, just to wrap this up, do you think investors are going to find it very hard to ignore yet another lapse, by just imposing that token penalty? Has the board risked appearing too lenient? What more could have been done?
We can always argue whether, there should have been some malice and clawback, whether this is enough. But look, I think what is important is that, the issues facing HDFC Bank are not insurmountable. They've kind of faced this and a lot worse in the past. The bank has a fairly strong franchise, a resilient business model, and a history of great execution. So the next phase should be less about, revisiting some of these issues and saying that, okay, let's kind of not look at each of the issues in isolation, but collectively see what we've learned, rebuilding confidence through greater transparency, stronger board oversight, maybe more consistent governance practices, a little bit more focus on the processes, which is always, again, I must say, has always been strong at HDFC, because you have to remember that you have to build back, the bank has to build back its long-term credibility, which it very quickly lost.
Mr. Parekh, my apologies to interrupt there, but thank you, gentlemen. The HUL management is actually now addressing the media on their earnings, so we'll cut across to that, and thank you for your time.
Coordinated fiscal and monetary policy actions help to manage energy security, inflation, and currency volatility that we know. In all this context, what we saw was that the FMCG demand environment remained stable, reflecting the underlying strength of consumption as well. In this entire context, as you saw results, we delivered a turnover of 17,184 crores with an underlying sales growth of 10%, driven equally by volume and price. This marks our highest growth in 13 years. We progressively stepped up performance from 3% in first half of FY26 to 10% in this quarter, while strengthening our competitiveness. What's more heartening is that our bottom line has also grown double digit, and I'll spend some time on this later on. We delivered this performance in a volatile environment through competitive moats built over time. First, our global supply chain network, R&D agility, and manufacturing capability ensured continuity of supplies and faster response to market demand. This helped us to maintain service levels during this period of supply crisis as well. Second, our resilient portfolio, straddling across price-benefit pyramid and strength of our brands, enabled us to implement calibrated pricing actions while preserving the consumer franchise. Third, despite the cost pressures, we continued to invest behind brands by stepping up absolute A&P spends to the highest level in the last 11 quarters. We further strengthened our omni-channel presence by growing distribution in general trade and continuing offline expansion of digital-first brands such as Minimalist and Simple. And finally, our financial agility enabled us to balance near-term pressures with long-term value creations. That brings me to the overall consolidated results. Our EBITDA margin at 23% was within the guided range. Our absolute EBITDA grew 8% year-on-year, while profit after tax before exceptional item grew 9% year-on-year. The reported profit after tax declined 2% on account of one-off tax credit in JQ25. The tax credit was to the extent of 337 crores. If you adjust for that, then the year-on-year reported underlying PAT has grown by 11%, which is same as profit before tax as well. This performance reflects the quality of our earnings, which means double-digit top line and double-digit bottom line growth and resilience of our business model. Moving to segment performance for the quarter, Home Care delivered 14% USG, driven by high single-digit UVG. This marks our strongest performance in 3 years. Both fabric wash and household care delivered double-digit volume-led growth. Within this, liquids continued its double-digit growth trajectory. We continue to see inflation in crude-linked derivatives and are taking calibrated price increases across the segment. Beauty and Wellbeing delivered 12% USG, driven by high single-digit UVG. Within this, hair care delivered another quarter of double-digit volume-led growth, driven by premium hair care. We further strengthened our market leadership during the quarter. Skin care and color cosmetics business grew in high single-digit, led by double-digit growth in premium skin care. Within this, Minimalist recorded double-digit growth and continued to expand aggressively in offline channels. Oziva saw a near-term softness. We continue to invest behind the portfolio and are confident of its long-term growth potential. Coming to personal care, the business delivered 4% USG driven by pricing as this segment continued to see palm oil inflation for the second consecutive year. Skin cleansing grew mid-single digit. Premium bars and body wash within that continued its double-digit growth trajectory led by volumes, which is outlining our premiumization strategy in personal care. Oral care delivered mid-single-digit growth, with premium innovations like Close-Up White Now continuing to gain traction. Foods delivered USG of 7%, which is again a step up of growth sequentially, driven by mid-single-digit UVG. Premium tea within this reported low single-digit UVG, while coffee delivered double-digit volume-led growth. Lifestyle nutrition, which is Horlicks and Boost, delivered double-digit growth in this quarter. This is its 5th consecutive quarter of positive UVG and a strong growth. During the quarter, Boost crossed the 1,000 crore annual turnover milestone, making it our 21st brand to be in the 1,000 crore club. Packaged foods delivered high single-digit growth. We expanded Kisan chutneys with 2 new variants during the quarter and continues to see step up as we move forward. As we continue to deliver the short-term performance and step up, we are investing ahead of the curve to build capabilities and remain future fit in marketplace. A powerful example of this commitment is the launch of Unilever Fragrance House in India. It brings together the science of fragrance creation with consumer insight and artificial intelligence closer to one of the world's fastest growing markets. Our liquid labs of the future in Mumbai is another such example. The lab can accelerate formulation development timelines by up to 6 times to respond with speed to consumer needs. In supply chain, our Haridwar and Sonipat factories were recognized by World Economic Forum's Global Lighthouse Network for supply chain resilience and sustainability categories respectively. HUL now holds 8 WEF Lighthouse designations across 6 sites, the highest for any company in India. And finally, we are embedding AI across our value chain. An example of this is our first digital distribution center in Vijayawada, where AI-embedded real-time visibility creates a digitally orchestrated fulfillment ecosystem to serve consumers better. Taken together, these investments are building the foundations for long-term value creations along with many others. Now coming to our midterm outlook. The economy continues to be resilient and we expect the consumer demand, FMCG demand to remain stable. Having said that, we continue to monitor the progress of monsoon and evolving geopolitical developments. Backed by the actions that we have taken, we remain confident that fiscal year 27 will be better than fiscal year 26, which has been our guidance so far. And we expect the consolidated EBITDA margin to be around the current guided range, which has been our medium-term guidance. Our focus remains clear and unchanged. Drive competitive, volume-led growth anchored to our key strategic priorities. With this, I conclude our prepared remarks and will now take questions.
You were going to go first, right? Yeah. Good morning, Priya and Niranjan. If we see your EBITDA margin, the calculated margin is below 22%, it's 21.7%. So for this financial year, are you expecting to revise your EBITDA margin lower? If you're expecting to keep the EBITDA margin in the 22.5 to 23.5 range, what gives you the confidence? Is it the monsoon? Is it the consumer demand? That's one part of my question. My second question is, if we see volume, again, a bit subdued growth in the first quarter. So for the overall year, what's your outlook on your volumes, on the underlying volume growth? And the third question is, what's the outlook on raw material pricing, especially for commodities, tea, coffee?
Maybe I'll take the last part of the question first, and then Niranjan can add. So in terms of inflation, it remains a volatile environment. And we are closely monitoring, both the geopolitical situation, the monsoon conditions in the country. And we believe that in September quarter, we will see sequential inflation. This could be depending on how inflation pans out, between 2 to 5% sequentially. for September quarter over June quarter. And we will take calibrated price increases as we have been taking in June quarter. The same we will do in September quarter, but really leverage all the lines of our P&L. So it remains volatile. Given our portfolio, which spans across and spreads across both categories and the depth of our portfolio across price architecture, we believe that we are in a good position to ensure that we navigate this.
And coming to your EBITDA margin, I would like to correct you that if you look at the consolidated EBITDA margin, which is what we report, it's actually 23%. And our EBITDA guidance is also on consolidated EBITDA margins, which is 22.5 to 23.5. And our margin reported for this quarter is 23%. So we are well within the guided range.
Hi, Priya. Hi, Niranjan. I think just the fact that, in the last so many quarters, volume growth has been on an uptick. I understand that this quarter there was also price hikes that has impacted the overall volume numbers. But you've mentioned that 2 to 5% is the inflation that you see sequentially as well. So when you say calibrated price hikes, is there a percentage set that you will be taking, in the next quarter or so? And do you think that for the whole year, the pricing pressure should be mostly done in the first half, and the second half is when you again start that volume growth trajectory coming in?
So I think, firstly, I'll repeat what I said. The conditions continue to remain volatile. So given the geopolitical challenges that we continue to see, we have to monitor this, and we have to monitor what happens to commodities. The other is the monsoon conditions in India, and we need to monitor the El Nino impact of the monsoon. Now, given that overall agriculture, actually monsoon has become much more limited in terms of the impact of monsoon on irrigation is more important today. But the issue really at hand is what happens with rural sentiment. And this is something we need to watch. But it depends. It depends on how monsoon pans out geographically and also the depth and extent of the monsoon challenge that we have, if we have one. So this is the two things we need to monitor in the country. Having said that, we feel very confident and comfortable with our equation between price. It's a very balanced equation between volume and price. With 5% volume and 5% price, this is a good balanced equation. We also are very competitive and continue to drive competitiveness in the quarter. So for us, this bodes well going forward.
And just on the fact that monsoon plus there's price hikes, which has overall impacted rural demand, which was seeing a recovery last quarter. So what is your sense there in terms of rural demand versus urban demand going forward? What is it going to look like?
Yeah. So firstly, we see rural demand continuing to be stable and robust in the quarter. So in the quarter that's gone by, June quarter, we see both urban and rural demand continuing to be stable in the quarter. So that's really our outlook going in. We have to keep watching, like I said, in terms of the monsoon and in terms of geopolitical impact on inflation. But given all the measures that have happened in the country, both in terms of the monetary measures, fiscal measures, the demand in the country remains consistent, remains stable. Niranjan, if you want to add.
No, I think just a couple of probably builds on that. Even on the volume point, even with the price hike of 5% UPG that you saw in the quarter, the volume has only come off from 6 to 5%. So really speaking, a 5% underlying volume growth with that kind of trajectory, again, actually is a strong evidence of our portfolio that straddles across the price benefit pyramid and our brand power, plus our broad-based growth. So the growth is not just coming from a category, it's coming from across, whether you look at a laundry or a dishwash or a hair care or a beauty or a foods or a Horlicks. So it's a very broad-based growth and not just a category which could be impacted by inflation. Yeah. Okay.
Hi. So you've called demand stable, but like we've seen, growth has improved. So do you see a progressive improvement in volumes going forward, or do you see them settling, or what's the normalized range that you're looking at? First is that. And secondly, also, you said Boost has entered the 1,000 crore mark, and Horlicks Superfoods is also seeing the traction. So does this mean that category is now sort of turning around, and what's the roadmap to make that the growth engine and also the outlook on the personal care segment?
Yeah. So let me begin with the lifestyle nutrition category. Our lifestyle nutrition category has now seen 5 quarters successive continued good strong growth. And what's behind this is really what we've done behind the brands. So we've gone back to talking about the basic needs for nutrition. With the Horlicks Superfood launch, we've gone back to talking about the ingredient storytelling in Horlicks. This has done extremely well for us. Combined with the changes in pack price architecture, this is the reason we are continuing to see now a volume step up. With this, we've also entered into Horlicks with Horlicks Protein. This is a new entry we've recently made, and we remain confident of the opportunity that exists in India. There's a huge headroom in India for supplementation of health, and this is just an area which we're beginning to enter with the Horlicks Protein business. So that's really what I wanted to add. Niranjan, if you want to add.
Yeah, I mean, just building on, again, on this point, as far as volume is concerned, so you see one, demand being stable, our trajectory improving, which also is a function of our competitiveness improving. For instance, we have hit a new high on our laundry market shares, on our hair market shares. So the market share improving as well, again, as a consequence of all the actions that we have been taking so far. Yeah.
Would you see a similar stories with the personal care segment as well, with what's happening with nutrition now?
Yeah, so the way we should look at our personal care business, I think it's a story of 2 parts for us. One is the category has seen 2 years back-to-back inflation, and therefore overall the category has seen a shrinkage in terms of volume as a result of 2 years back-to-back inflation. That is certainly affecting our mass business in soaps. Our premium business, on the other hand, is growing double digits, strong double digits, and we're continuing to have competitive performance in body wash. So we actually think this augurs extremely well as we go forward into the future, and this will continue to be our focus in personal care.
Right. And lastly, just if there's a price hike, what would be the quantum of it, given the input costs are not easing anytime soon?
Yeah, again, like I said, it's a volatile situation in which we are. So we will take calibrated price increases in line with the inflation. We always look at it in a very calibrated manner, ensuring that we are giving the right amount of price to consumers, looking at all the elements of our P&L savings so that we are able to insulate consumers as much as possible.
So if you see, for instance, our June quarter inflation, which we had called out, was around 10%, but we passed on only 5% price increase because we are very conscious of the consumer, because we are obsessively focused on the consumer and therefore protecting the franchise. Therefore, we take all the other actions across the lines of P&L, and thereafter we are passing the calibrated price increases. So we're very conscious of that, and we'll continue to adopt the same strategy moving forward on sequential inflation.
If I could just add, I mean, I want to just reiterate what our focus is. Yeah. Our focus is we are obsessed with volume-led revenue growth. And I think that is our core focus, and you will continue to see us ensuring that we calibrate for that.
So volume-led over price-led.
Hello ma'am, hello sir. आपने जैसे कि कहा कि calibrated price hike होगी और volume-led.
The management of Hindustan Unilever there addressing the media after its first quarter results. The volume growth proving to be a bit of a disappointment this time around, contrary to street expectations. The stock down 5% at the lowest point of the day. The last few minutes have seen a very, very sharp knock on Avenue Supermarts, and just pull up that one as well. The stock is now down 5.5%, and it's a nosedive that the stock has seen from higher levels. There you can see 6% lower now on Avenue Supermarts. They're supposed to hold an analyst meet earlier in the day, and Mangalam has shared these details where the management has highlighted the fact that they wanted to grow their stores by 15% of the basis, which is 75. We'll get more details on this as the day goes by as well. Take a short break. We focus on the bond markets on the other side.
Welcome back. You're still watching Trading Hour. As promised, let's get you all of the action from the bond street. And Manisha Gupta joins in as always to get us up to speed. Manisha.
Well, it's the second straight day when you have the Indian bond markets continue to trade on the positive side, and that is because the crude oil prices continue to be soft. We are now trading below $88 a barrel even, and from the highs that we saw in the previous week, the crude oil prices have come down by nearly 11%, and that has been supportive. The Indian rupee has firmed up as well. The Indian equities seem to be doing quite well, and that is where the markets are taking cues from. Also, bonds maturing up to 5 years are perhaps being most actively traded right now, and the papers that were issued by Hudco, Power Finance, Aditya Birla Housing Finance, IFL Finance, Tata Power Renewable Energy are being the most traded actively therein. The primary market bond issuances, when you look at that on Monday, was to the tune of 31.5 billion. If you look at the bond issuances that are happening today, you have I Finance coming in for this one. They are planning to raise nearly 2.2 billion, and they're doing it via issuances of 2-year bond maturities there. Satin Finserv should be next on your screens because they are also into the market today asking for bids. They are looking to raise nearly 850 million, and they are doing it via issuances of bonds which are maturing in 2028. And then you have another company, Fincurve Financial. They're also in the markets today. They also are looking to raise nearly 260 million. Reissue of bonds really of 11.38%. They are looking at maturities of bonds in 2029 therein. Interestingly, when you look at the public sector banks, they have been kind of absent from the market because the route that they're exploring to raise funds has been external borrowing there. What is going to be in focus today? Well, it's going to be 7 states which are looking to raise 181 billion. They're doing it via bond issuances, which is happening today. And then the US FOMC meeting, well, that announcement comes in tomorrow. You also have the the Indian RBI finance meeting happening next week. So these are a few things that the street will take further cues from.
Well, yes, that major supply coming in. We'll keep an eye out on that one, Manisha. Thanks very much, as always, for joining in with that update. Take a break on that note, but we'll be back with more on the markets, so stay tuned. the market staying in the green. The Nifty at 24,011 holding there. The Sensex also trading with gains of about 70 points. But the market breadth, that remains negative with almost double the number of stocks declining than the ones that are advancing. For the Bank Nifty as well, staying below that 57,000 mark at 56,966 as we speak. And on that note, Hormaz and I take your leave on this edition of Trading Hour. But stay with us. More news and updates will continue after this break.
Nifty and Sensex stay in the green, but the number of stocks declining clearly outnumbers gainers ahead of NSE F&O expiry today. Utilities and industrials are the big drags, while IT and realty notch gains.
Hindustan Unilever stock dips after its Q1 volume growth of 5% misses estimates. Revenue and EBITDA are mostly in line, but a tax credit last year makes net profit seem lower. CEO Priya Nair says the FMCG major remains focused on volume-led revenue growth.
REC deposit matter while clearing them of any malified intent. Sources tell CNBC TV 18 that with this issue settled, the CEO appointment will now be taken up next.
Zepto's proposed IPO seems in a spot of trouble with investors balking at its asking valuation and demanding a sharp discount. The big question now is whether the IPO stays on course and what valuations it finally commands.
Coforge navigates the EI flux to post strong deal wins and guides for FY27 to be an exceptional growth year. Its profit margin scaling to the full year aim in Q1 only adds to the optimism. The stock surges.
Hello, good afternoon. You tune into Halftime Report coming live from the CNBC TV 18 Motilal Oswal studio. I'm Vinny Motiwala, with me my colleagues Sona Bhutra as well as Ekta Batra. Good afternoon, ladies. And in a day today, we're seeing obviously the Nifty expiry that is coming in. Bit volatile, but still holding on to the 24,000 levels as of now for the Nifty. The broader end of the market, if you pick up the Nifty small cap specifically, that's a bit more under pressure versus the benchmark indices as well as the mid cap. So let's watch out for that in the trading session as well. Small cap a bit more under pressure, still down 0.4%. So we're seeing a bit of an ups and down kind of a day coming in for the Nifty. Advance decline ratio still more in the favor of declines versus advances as well in today's trading session. So let's watch out for that. And in terms of sectors, we're seeing IT that is managing to hold on to good gains, 3% to 4% gains, mainly led by Coforge, TCS, Persistent, Infosys, all of them holding on to gains, as well as Realty. That's another one that's managing to hold on to strong gains in the trading session as well.
Hi guys, yes, absolutely. Today we're consolidating, but just look at what's happening on the Asian screen. That's something to talk about at this point in time. We do have the Kospi, which is down around 10% the Japanese markets, which declined around 4% in today's trading session. So sharp cuts which have come in. Earnings from Amazon, Meta, Microsoft, all of this is going to weigh in terms of what the future of the chip industry would be. And that would probably weigh in terms of how some of these key markets such as the Kospi would act out or go, the triggers going forward for that. But separately, we do also have the US Fed Reserve meeting which takes place. So we'll be reacting to that on Thursday morning. That'll be important in terms of a global Q as well. So yes, fairly resilient considering the softness that we've seen in Brent crude prices. So taking that with both hands.
And also, of course, the biggest factor driving markets today will be the F&O expiry. It's the monthly one. So we will be looking at August series from tomorrow. The last 1 hour of trade could be very volatile, but volatility has already started from the word go. But let's tell you what we do have on the show today. Earnings remain in the thick and center of conversations. We'll be speaking with the managements of Ceneris Pharma, Supreme Petrochem, and Rajratan Global. All of them reported a steady set of June quarter earnings. We'll focus on stocks and big movers in trade today. Stay tuned for that. And in our commodities segment, we'll be joined by Siraj Hussain, who's the former agricultural secretary as well. So let's go across to Vivek now. He's here to take us through the stocks that are moving around in trade. Vivek.
Well, thank you so much for that. We've seen significant volatility, especially in the last half hour or so. In terms of individual names, the one that we're tracking, we start off with Cipla. The company finally has received the US FDA approval for generic version, and we are, analysts believe that there is significant opportunity of stock up almost 2%. The entire IT pack post a very strong results, and a strong commentary coming from Coforge has seen a very smart rebound. TCS up 5%, Coforge almost 10% higher, Persistent as well as LTM. All of these stocks doing very well. Neogen Chemicals, at one point of time was up almost 5%, has cooled off significantly. In fact, dropped into the negative territory. That's another stock on the radar. RR Kabel, very strong set of numbers for Q1, well above what the street was anticipating. Very good management commentary coming as well. When they joined us earlier today, stock higher by 2%. And Lodha Developers, whole host of brokerage upgrades coming in as far as EPS estimates are concerned. Again, 7% higher for this particular name. On the other hand, quite a few laggards as well. None more so than Godfrey Phillips. A very muted quarter. The margin compression has been quite significant, down over 7.5%. Bharat Electronics, street disappointed with the margin miss that the company has seen in terms of EBITDA. So that is something that has led to a sell-off of a little over 3%. HUL, again, volume miss versus what the street was anticipating, down almost 6%. The entire capital goods pack under a bit of pressure, in fact, very sharp volumes across most of these names. G. Vernova Hitachi Energy, PHEL, CG Power, all of these names down anywhere between 2 to 5%. And HFCL, after a one-way rally, this particular stock continues to cool off, one of the top drags as far as the NSE 500 index is concerned.
Okay, all right, Vivek. Thanks very much for that. Yes, Cipla is one of the good gainers in today's trading session after getting that US FDA approval for Advair generic. It's been many years since they've been waiting for that, but the opportunity is definitely going to be diluted as compared to before. We'll take a short break, but up next we'll get you a lot more in terms of stocks. We'll get you a couple of earnings as well. We'll in fact try and get you the management of Supreme Petrochem on the other side. Stay tuned. Welcome back. Well, quiet for the markets, but not so for a couple of stocks which have reported their Q1 numbers. In fact, let's talk about Ceneris Pharma, which reported over a 30% rise in revenues in Q1 from a year ago. Net profit also surged quite smartly on a year-on-year basis. To understand the company's quarter gone by and the recent news updates in more detail, we have with us Swapnil Shah, who's the Managing Director at Ceneris Pharmaceuticals, joining in now. Swapnil, hi. Thank you very much for taking the time out. Just wanted to understand, there was a CARE ratings report which came out, and we'll discuss the earnings soon enough, which flagged a delay in your Atlanta sterile injection facility. So your capex, so the company's sought shareholder approval, we understand, to reduce the objects of the proceeds as well to around 107 crores to 42 crores. Just take us through what's taken place there and why the delay.
Yes, no, thank you. Thank you for having me on the show. So, as you know, we have a lot of filings on the oral solid side, and there is capacity expansion that we are planning to do on the oral solid, both at our plant in Atlanta and our plant in India. So we felt the immediate need of reallocation of our funds of IPO proceeds towards the expansion of oral solids, since we have multiple filings, and that's about close to 187 strands that are going to be approved in next 6 to 8 quarters. The plan for sterile injections is pretty much there. The idea is to put up a relatively smaller to begin with, and then expand it there more. And we have very strong cash flows coming in, right? So that will also fund our growth plan on the sterile injections plant as well, not just the IPO proceeds.
Okay. Well, moving on, Swapnil, we do understand you get around 70% of your sales from regulated markets, and majority of that, in fact, is from the US. We did have the announcement from Trump exactly same time last week about the tariffs on generic drugs if in case there is not enough of a presence or manufacturing presence in the US. How exactly is that going to impact a company such as yours?
I think we are pretty neutral that way. We have manufacturing on both the sides, US as well as India. India, we are expanding our manufacturing, and as well as we are expanding our manufacturing on the US side. So I would say it's neutral for us, but at the same time, I think I will wait for a trade deal to sign before pulling it in either of the direction. So I think once the trade deal will be signed, we'll have more clarity in terms of how this sector is going to be placed as far as tariff is concerned. So I think I would wait until the trade deal is executed.
You're building up your presence in the US. How much do you have in terms of a facility in the US, and how much are you incrementally adding?
So we have 3 commercial lines today in the US. We have plans to add 4th line, which will be probably within next 12 to 15 months as we speak. At our India facility, currently we have 2. We are installing 3rd. And then depending upon how the situation looks like, we'll see whether we want to install 1 more line in India or in the US. As far as landmass and everything is concerned, it's already in place. So we have enough capacity in terms of land expansion that we could do to install more lines.
Swapnil, this Atlanta sterile injection facility where you are looking at lesser money to be put in, is that going as per plan? I'm just trying to understand. You said everything is going as per plan, but you've cut the capex there because there are enough cash flows that you have internally. So what will you be spending finally on that facility will be the same. That will be around 107 crore rupees. Is that understanding correct?
That's correct, yes.
And by when does it come on board? When does it get commissioned, and what kind of contribution will it do to your bottom line or the P&L for starters?
I think the right frame to put it is about 12 to 18 months in terms of commercialization from what we are today. Difficult to put a number in terms of how much it can add to our top line or bottom line. Besides that, we have guided for at least 2,500 to 3,000 crore revenue in next 3 to 5 years time frame from what the products we have, which is already mapped both on the regulated side as well as on emerging market side. So I think in another couple of quarters, we'll have better clarity what kind of revenue the sterile injections can put it on the revenue side as well as on the EBITDA side.
Swapnil, just in terms of your margin front as well, right? In your con call, I think you mentioned about emerging market margins at around 18 to 20%, which is much better than what is currently at 14%. What do you think is going to drive these margin upwards then? What are the factors? Is there any change in mix? What is it?
Yes, so if you see our Q4 FY26 quarter, our EBITDA margin on the emerging market was about 20%, 19-20%, which is today, this quarter is about 14. But historically, if you see, we have always had a far better H2 than the H1, especially on the emerging market side. So we feel on a consolidated basis, I would say on a yearly basis, we'll go back to at least 18-20% EBITDA on the emerging market side. As far as what is driving the margin is the product mix.
So we have a lot of products on the emerging market which are first to launch, first to file kind of an opportunity, which are still patented in the regulated market, but we have an early launch advantage on some of those emerging markets that we are present in.
Okay. Well, Swapnil, just on the guidance, because you're expecting as solid a year for FY27, I think around 30 to 40% growth and 60% growth in terms of profit for FY27 and going forward as well. That's correct?
That's correct, yes. So similar growth, as I said, looking at about 2,500 to 3,000 crore revenue in about 3 to 4 years, 3 to 5 years, worst case 5, best case 3, I would put it that way.
So give me your product mix. What is going to lead to that revenue according to you? What's going to be the geography mix and what's going to be the product mix? How much are you going to get, say, from complex generics, biologics? How much are you going to get from generic ANDAs where, you know, the margins are lower?
Well, it depends, right? I mean, it also depends how the product are being sold, right? So some of those products may be generic going into government business. The margin profile is better than typically how the generics are. So I would rather than putting it a generic margin lower, I would say how you are selling the product. I think that makes a lot of sense. So as far as the business is concerned, you know, we have 58 approved ANDAs, right? 58 approved ANDAs, which corresponds to about 187 strengths. We have 35 yet to be launched, which is correspond to about 136 strengths. And we have about 39 products that are under R&D, right? So some are going to be filed, some are already filed, some are going to be approved in next 2 to 3 quarters. So if you see the whole basket is pretty large. Coming to our CDMO, CMO, we have 37 molecules that have signed. We have 120 strengths corresponding to 37 molecules on the CDMO, CMO side, which is added towards more than what we have said in terms of our
Okay. All right. Looks like it's a snappy line. We'll try connecting with him, but for now, we'll do one thing. Take a look at Varun Beverages. The stock is lower, reported numbers where consolidated volume growth has come at 19.8%. The expectation was of around 20%. The stock, though, has come off sharply from the highs of the day. India business volume growth has come at 14.5%. We'll look at these numbers in greater detail. For now, we'll slip into a short break. When we come back, we'll be joined by Rakesh Nair, who's the Executive Director of Supreme Petrochem, to discuss the quarter gone by and the outlook ahead. Stay tuned for that. Welcome back. You're still tuned into Halftime Report. It's time for another earnings conversation. This time we have the management of Supreme Petrochem joining us now. Reported a good set of earnings despite the West Asia crisis. Revenue saw an uptick of 22%, while profit grew multifold to over 230 crore rupees. To break down the road ahead and more, we are joined by Mr. Rakesh Nair, who's the ED at Supreme Petrochem, joining us now. Mr. Nair, good afternoon. Thank you so much for joining us. Well, things were quite volatile in the quarter gone by, and there is volatility yet again. But give us a sense of what really worked this time, because volumes declined 24.5% on a YOY basis. Despite that, there's a revenue growth and a profit growth. Was the pricing higher? Was it because of higher raw material prices? Even styrene monomer prices were higher in quarter one. Has that trend continued in quarter two so far?
Thank you for having me. The revenue and the profit was up because the styrene prices also shot up. The deltas, global deltas between the styrene and polystyrene and other products, they increased substantially. And so we got the benefit of that. Now going forward, the styrene prices started coming down towards the end of June and early July. But with the recent, again, the war issue starting, the prices have kind of again started inching up. But then now for the last 3-4 days, they are more like stable at the moment.
So how much higher are the prices? If you can give us a sense of percentage increase versus last year versus what we saw during the peak of this West Asia crisis. And what does that mean for FY27? Will it be a pricing-led growth, or will you see some sort of volume growth as well?
Coming to the volume growth, it's very difficult to predict anything right now to give any kind of guidance, because we earlier thought that maybe this war will last only for a couple of months, 2 months, 3 months. And in the last interview, I had said that if everything is normal, starting the second quarter onwards, we could have a 10% growth during the year. But now the way we have lost the market in the first quarter and also the way things are currently, it's very difficult to give any guidance on the volumes at the moment. As far as the styrene prices are concerned, during the war period, that is from the March till June, the prices peaked to almost $1,500 for styrene monomer, whereas pre-war, the prices were at $980 plus freight, meaning $1,050 or so, thereabout. And the deltas, global deltas, which were originally around $200, they had peaked for GPPS at around 300 plus, and for HIPS 400 plus.
So point taken there, obviously it's very uncertain to realize or give a number in terms for volumes growth. But could you help us understand, is domestic demand actually enough to cater to the growth targets going forward, given exports is nothing right now? So what is it in terms of that? And would you also be looking at more price hikes if volume growth is not there? What is the price hike you'll look to take furthermore?
As far as volume growth and demand is concerned, during the months of March, April, May, the non-OEM sectors, the demand was not there. The demand fell down by almost 49% from the non-OEM segment. And as far as the OEM sector is concerned, they were steady. Now, coming to the price hike, you said, the price hike is all dependent on the raw material prices and also the global supply chain issues which are there currently, the freight and other related matters, and the global deltas. So it's very difficult to say whether I will increase any price at the moment or not. It's totally dependent on the raw material. And exports during the last quarter, we could only export around 10% of our regular exports in a quarter. And currently also, with the Red Sea also getting blocked, the exports are very, very difficult to do.
Okay. All right. Well, the visibility that you have for your business, Mr. Nair, seems a little cloudy at this point in time. That's what we're gathering. Before we ask you that question, some changes with regards to the management of Instamart at Swiggy. So do watch out for that. The stock is up around 4%. The current CEO has resigned, and the CEO from Myntra, Nandita Sinha, has been appointed as the Instamart CEO with effect August 3rd, 2026. That's just about next week. But Mr. Nair, just wanted to get back to the conversation. You did mention that you're quite uncertain in terms of how the raw material prices will move, and that will determine your price hikes going forward. Net, what is the situation on the ground for you in terms of raw material prices on a blended basis? How much has it risen year on year, Q on Q? And what are you projecting internally for FY27 based on the situation that you see? I know it's volatile, I know it's difficult to ascertain it, but just based on some internal estimates.
See, giving any guidance is not right at the moment when the raw material prices, the demand,
you can provide qualitative guidance.
Deltas are very uncertain. So it's kind of looking at the business on a daily basis at the moment. But yes, we know the business, and going forward, as the situations evolve, we will be able to take those challenges and be able to meet the demand from the local industry.
No, it's understandable because the input is very commoditized and also very dependent on how things are according to the West Asia crisis. Last question before we let you go. You are looking at further capex, polystyrene, the capex that you have announced here. By when does this get commissioned? How will you fund it? What is the amount that you will be putting in here?
For this line of our polystyrene, our capex is estimated at 325 crores. And this is being put up at our existing complex in Amdoshi in Maharashtra. It is likely to be completed by December 2028.
Okay. All right, Mr. Nair, pleasure speaking with you. Thank you so much for joining us. Uncertain times and the West Asia crisis being back and that risk being back on the table is making things very uncertain, but that's the word coming in from Supreme Petrochem. Time for a break now. On the other side, Manisha Gupta joins us with Siraj Hussain, who's the former Agriculture Secretary, to discuss all things agricultural. Stay tuned.
Welcome back. Joining us on the show now is ex-Agri Secchi, Mr. Siraj Hussain. Mr. Hussain, thank you so much for joining in. Your sense on the sowing numbers that came in yesterday. The numbers have narrowed down, more sowing has happened, but we're still down 5%, and the major concerns clearly coming in for core cereals and pulses. How are you deciphering those numbers?
Actually, last 15 days have been very good for sowing, even though the monsoon has not been very good in most parts of India in these 15 days. But early July, we had good rains, as a result of which the sowing numbers have gone up by about 55% between 10th of July and yesterday's number. So that is a good news. Now, the only thing is that if the rainfall continues to be good in the balance period, that is in next few days of July and then the month of August, then we should not see much drop in production. Today it is raining in NCR, so I'm very happy that rains today have been good. And if the rainfall is widespread, then I think we are going to have good Kharif season.
I know the window for course and pulses is slightly longer. Is that the reason you're not really concerned? Because we still have July and we still have perhaps until 10th of August. And do you think those numbers can pick up?
No, the numbers of pulses, unfortunately, are not likely to pick up because in Maharashtra, Karnataka, South Indian states where monsoon reaches first, in those states, because of very low rainfall in July, the sowing of pulses has been much lower than normal. So whether it is tur or urad or other crops, even soybean, the area is lower than last year. Maize area is also lower despite all this push for ethanol and things. So I do not think that we will be able to make up those deficiencies. In North India, the rainfall is good. So it will be other crops. Sugarcane is slightly higher. I see more sugarcane area in UP, perhaps. Pulses and oilseeds, I don't think we will be able to make up.
The next leg of the rainfall, that is in August and perhaps in September as well, and that is where the major concerns seem to be coming in for, because even now, even with July being such a great month in sense of rains, we are still 16% deficit. Does that worry you? And going forward, if that El Nino does develop and starts to impact in August and September, are we looking at further worries then?
Actually, worry is also justified because at the farmer level, in regions where the rainfall is very low, the farmers would be suffering loss of yield, even if that is not showing in the area, in the sown area. Sown area may show a figure, but actually the yields may be lower. So, in certain crops like tur, etc., even the area itself is more than 10% lower than last year. So I would say that if the rainfall continues to be good in the balance period of July and in the month of August, then on the whole, in the major crops, other than pulses and oilseeds, we should not see much loss of production and therefore much loss of income. So that is a good news, but a lot depends on what happens in August.
Mr. Hussain, as is always the case, when it is monsoons, we do see fruits, vegetables, those kind of crops actually see price rise that we already are working with. Are you also anticipating a higher inflation when it comes to many of these grains and edible oils going forward?
Edible oils, since we import about 60% of edible oils, so a lot depends on what happens in the global market. Where does the war take us and other impacts of climate change, etc. In case of pulses, it seems that private sector has a good carryover stock, and therefore the expectation of the private sector is that there will not be very high inflation. But my own sense is that because of lower area under tur and urad and other pulses crops, I think pulses we may see higher inflation. But in rice, we are well shielded. And maize is a very interesting crop because a lot is being said that so much money has gone to farmers because of ethanol and so on. So if that is so, why is the area under maize lower? It takes less water than rice. So I'm watching maize quite carefully.
All right. How are you looking at the prices overall? As you said, there are inflation worries, especially when it comes to pulses, edible oil as well. Rice, you mentioned, is pretty shielded there. How are you then looking at cane prices, one, because that, of course, is managed on both sides in some sense. Core cereals, is that a worry as well?
Core cereals, maize is covered under the core cereals. But overall, if we take core cereals, the sown area is down by about 12%. But core cereals do not deliver a very high price to farmers. Unfortunately, they are not procured. Even though in recent times we have seen urban middle classes consuming more of coarse cereals, therefore it seems that private companies are buying coarse cereals from farmers, bajra, etc., jowar, and then they are supplying. But I think I don't think the farmers earn a higher income from coarse cereals. So the coarse cereals is okay, but as far as sugarcane is concerned, here is something I would like your listeners to understand, that in case of sugarcane, the price received by the farmers is guaranteed by the government, even the price paid by the private mills. So ethanol or no ethanol, the farmers are guaranteed a certain price.
Well, absolutely. So, well, one thing is very clear, Mr. Hussain, as you said, that the prices are expected to continue to be elevated for many of these agricultural commodities. More or less is something that we'll see, of course, in the month of August there. But thank you so much.
Okay, Mr. Hussain as well as Manisha, thank you so much for taking us through that conversation as well. And on that note, we're going to slip into a very short break. We'll come back after the break and we'll connect with the management of Rajratan Global Wires. We'll have the chairman as well as managing director, Mr. Sunil Chordia, who will be joining us for that conversation. Welcome back to Halftime Report on CNBC TV 18. Nifty still holding on to those 24,000 levels where it's going to be headed in the second half of the trading session will be key from here on. But let's move on and put the spotlight on the next management for today. We have Raj Ratan Global Wires that he's reported his number, Q1 number, steady quarter that came in, maintaining the double-digit volume growth for the quarter as well. So 70% uptick in terms of profits of the company, revenue growth also very strong at 30%. To talk to us about the outlook of the company, we have the management, who is Sunil Choudhary, the chairman and MD of the company, joining us right now. Good afternoon, sir. Thank you so much for joining us on the show. So, I want to start with two numbers. One is in terms of margins. You've seen an improvement versus last quarter and versus last year as well. Margins are back to that 13% mark. And apart from that, volumes. Still seeing a double-digit volume growth, 16%, but below your guidance. So one, in terms of margins, given that you have already taken price hikes, now input cost is coming out, what is the outlook for margins and what is the outlook for volumes as well?
Yeah, so you have already covered everything. As I said in the Q4, that our margins are low because there was a sudden price increase in raw material, which we could pass on in Q1 of this year. And we are back to the margins we operate with. Coming back to your question on the outlook for future, as you know, we are growing at all the 3 locations. Our Thailand plant is also taking up a project to increase capacity by another 50%. So Thailand will become 60,000 tons, will become 90,000 after 1 year. Our Chennai capacity has to ramp up from 30,000 tons to 60,000 tons in the current year. And we are investing in a steel cord project in our mother location at Pithampur, which will start production in next quarter. Trials will start in next quarter. So I'm bullish, I'm positive that we'll keep growing at 15 to 18% in volume terms.
Okay. So just a word in terms of margins. Already, like I've mentioned and like you mentioned as well, right? Price hikes are taken. Now input cost is also coming down. So my point is that does it mean that margins will furthermore improve on from here on? What is the peak margin that we can expect then in this FY27?
No, I would not, margins may improve, but I would not like to say it here because we are in a competitive market, okay? And generally, for longer term, quarter on quarter projections is very difficult, but on a longer term, 13-14% margin, we can continue to work with. Yeah.
Confident on 13 to 14% margins. But Mr. Sunil, revenue was up around 29%. While you're talking about the numbers part of it, just wanted to understand the demand scenario that you're working with at this point in time. What were the key drivers to growth this quarter, considering the geopolitical uncertainty? And did that in any way impact your business?
It has impacted our business. The input cost has gone up, starting with the cost of LNG to a lot of other inputs, petroleum-based inputs, all have gone up. And that is why the margin could not improve. Of course, we passed on the price increase to our customers. But going down the line, I see that, the demand is very good. In India, automobile industry is doing well. Tire industry is running at full capacities. And our order book position and everything is good. Yeah, we are running at full capacities.
So you're running at full capacities, and that's why the capacity addition plans have also come into place. Mr. Choudhary, the last time we had spoken, you did indicate that, exports are also an important market for you and something that you have discussed at length earlier. Give us a sense of how demand in export markets is currently, and do you plan to expand it? Would margins be better, the realizations be better in export markets? And if that is the case, this increased capacity, will it cater more to export demand or domestic demand?
We will grow in our exports. Getting approval from global customer is a long time. It takes very long time, but it is happening, okay? And it will continue to grow. Our exports to USA are growing, our export to Europe are growing, and we have been traditionally exporting in Southeast Asian market. So export from India is something new we have started for last 1 year, which will double this year. From current level of 10,000 tons, our export will go to 20,000 tons from India.
Doubling in terms of exports. So, I just want to understand in terms for the bead wire side, right? The bead wire segment, and that's what you give. Now, we have Bansal Wires who's talking about entering the space. They've spoken about it. They've said that they are gaining market share. Are they undercutting in terms of pricing? So, is there some pricing pressure there? You have a large chunk that comes in here for the auto segment over here. So, what is it currently in terms of the on-ground situation? Is it that they are taking market share from you? What is the situation?
I would like to not comment on our competitor, but yes, they are also trying to get into this market. And as I mentioned, we are in a competitive market. But in our case, we are very, very old company. For last 30 years, we are in this business. We have very strong relationship, very strong approvals with all the customers. That works in our favor.
So you're not
And
seeing
it
any
will
pricing pressure, sir, in this segment?
We are seeing pricing pressure, but it is not necessary that we have to follow his pricing policy. Yeah, we operate at our price, and customers are happy to give us our
You're
price.
maintaining your market share here, right?
Yes. Rather, we have grown in our market share.
Okay, all right, Mr. Sunil. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Raj Ratan Global. That stock down around 2%. But the other stock which is under pressure post the analyst call and commentary coming in from the management is Avenue Supermarts or DMart, where they've said that quick commerce, in fact, is seen as a structural threat at this point in time. There's no big revival in same-store sales growth in a big way in coming years, which is currently at around a 5% base in Q1 of FY27. So that's one of the key takeaways which is coming in from the conference call which is held today. So that stock is reacting to that, down around 4.6% at this point in time. We'll take a short break, but we'll get you a lot more in terms of stocks. Stay tuned.
Welcome back. Absolutely flat on the Nifty. We are up 18 points, but we have come off from the highs of the day. Bank Nifty is the one which is underperforming, but there is some push coming in from Nifty IT. That is the top gainer, 3.5%, followed by Nifty Realty, and autos doing well as well. But mid caps and small caps continue to be under pressure. With that, it's a wrap on this edition of Halftime Report. Do stay tuned. Business Lunch will take all the action ahead.
Nifty and Sensex stay in the green, but the number of stocks declining clearly outnumbers gainers ahead of NSE F&O expiry today. Utilities and industrials are the big drags, while IT and realty notch gains.
Hindustan Unilever falls after its first quarter volume growth of 5%, misses expectations. Revenue and EBITDA are mostly in line, but the tax credit last year makes net profits seem lower. CEO Priya Nair says that the FMCG major remains focused on volume-led revenue growth.
HDFC Bank has fined its CEO, CFO and retail head 1 lakh rupees each for overreach in the MSRDC deposit matter while clearing them of any malified intent. Sources tell CNBC TV 18 with this issue settled, the CEO appointment will now be taken up.
Zepto's proposed IPO seems to be in a spot of trouble with investors balking at its asking valuation and demanding a sharp discount. The big question now is whether the IPO stays on course and what valuation it finally commands.
Coforge navigates the AI flux to post strong deal wins and guides for FY27 to be an exceptional growth year. Its profit margin scaling to the full year aim in Q1 only adds to the optimism the stock surges. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan and with me as always is Harmaz Patakia. Harmaz, good afternoon. You know, the market, the Nifty holding barely above that 24,000 mark is good for the markets. Lower oil prices boding well for the Indian markets. But, you know, lots of global things to watch out for. Big crash in the Kospi today. We've got, you know, big earnings, tech earnings to watch out for. And we've got the Fed decision.
Plenty to watch the global front, on the domestic front as well. Today being the monthly expiry. And that 24,000 level, of course, remains the key to track for the index. You know, plenty of results have already come in. And we need to react to a lot more. And in fact, today, if you see the count of earnings, around about 20-25 results today, and this is the lightest day for the week because we have at least 40-50 earnings almost every day from starting tomorrow. And you can see Supreme Industries' numbers flashing at the bottom of your screens as well. The profit figure is higher, yes, but we need to see what the volume growth guidance is the company giving out for the rest of the year. The revenue numbers are below expectations, but of course, the guidance from the company is going to be key. Two numbers, actually three. Not numbers specifically, but two numbers and one commentary have been the highlight of the last couple of hours, all from the FMCG space. One being HUL, the numbers coming in below expectations, 5% lower on that one. That continues to be the top drag in the FMCG space. A similar drag reported by Varun Beverages as well. The India business reporting results that were lower than expectations, and the commentary coming in from Avenue Supermarts. All of it has dragged the stock lower. Varun Beverages now down 6%. So the FMCG results / commentary from the managements have been disappointing to say the least, but there are plenty of other results to track, as you mentioned.
Absolutely. And if you take a look at the sectors, it's those IT names that are leading the up move. The index is up nearly 4% and is up for the third straight day. It's right now 3.5% higher. We've got Coforge, that's the top gainer, up nearly 10% after its strong first quarter numbers. Infosys gains nearly 3%. TCS there close to 4.5% in the green. We've got the Realty Pack that's also doing well, helping the Nifty stay in the green. We've got Lodha up 7%, Godrej and Brigade, both of those counters up 2% and 3% respectively. And as Harmaz pointed out, FMCG stocks are the top laggards, pulling the Nifty lower. HUL down 6% after missing estimates. ITC down over 1%, and Varun Beverages also falls over 4% on the back of weak numbers. But the other stock in focus today is HDFC Bank. CNBC TV 18 has learned that the bank views the employee conduct in the MSRDC case as business overreach, while sources indicate the issue is unlikely to hinder the CEO's reappointment. Ritu Singh joins us now with all of the exclusive details. Ritu?
Well, despite HDFC Bank taking the unprecedented step of penalizing a sitting CEO in the Maharashtra State Road Development Corporation or MSRDC deposit case, we've learned from top sources that the episode is unlikely to stand in the way of Sashidhar Jagdishan's reappointment as the CEO. Now, sources tell us the bank's board viewed the issue clearly as a procedural lapse, a one-off error of judgment rather than any misconduct. So now the Nomination and Remuneration Committee is expected to meet soon to consider Jagdishan's reappointment, after which, of course, the proposal goes to RBI. And our sources there also indicate the regulator is unlikely to view this entire episode as a major negative when they evaluate that extension application. Now, this, of course, comes after HDFC Bank concluded its internal review into the MSRDC deposit arrangement, with the board concluding the employee's conduct amounted to business overreach, clearly saying there was no malified action, no personal enrichment, and no improper motive. But even so, citing a potential divergence from RBI directions, the board did issue warning letters and a 1 lakh rupee monetary penalty to 3 senior employees, which apart from the CEO includes CFO Srinivasan Vaidyanathan and the Group Head of Retail Assets Arvind Vohra. Now, the timeline is very critical here because the review covers deposit mobilization arrangements in 2017 and 2021. Remember, it was Aditya Puri who was the CEO in 2017, while Sashidhar Jagdishan was the CFO. But by the time of the 2021 arrangement, of course, Jagdishan had become the CEO. Our sources say the board's action has been confined to the current management only, largely because there is limited legal leeway to pursue any kind of disciplinary penalty against former employees. RBI, however, is expected to conduct its own assessment of the MSRDC matter. Now, while accountability of individual executives rests with the bank's board, the regulator could still impose a monetary penalty on HDFC Bank if it concludes there was a regulatory violation.
Ritu, thank you for that update there. Of course, the stock of the morning reaction was Hindustan Unilever. It was an inline set of results, but the volumes turned out to be a bit of a disappointment. The stock has now extended its losses 6% lower now on HUL. Mangalam is now joining in with the fine print.
Well, HUL reported a largely in-line set of numbers with the adjusted for demerger sales growth coming in at double digits, which is the highest that we've seen in the last 13 quarters. The company reported a volume growth of 5%, with the rest coming in on account of price hikes that the company had taken. And the EBITDA margins as well, at around a little over 23%, were pretty much in line with street expectations. It was the net profit which had a base quarter impact of a tax credit, and you adjust for that, then the net profit also grew in high single digits, if not double digits as well. And the growth was this time around led by beauty and well-being, which saw a 12% growth. The home care business saw a 14% growth, whereas we did see a 7% growth coming in their foods vertical as well. Personal care, which was slightly below street expectations at 4% growth and low single-digit volume growth as well, where the company did call out that the category itself is shrinking, or 2 years of high inflation has impacted performance out there. The management commentary has been, alluding to a lot more stability. They are saying that demand conditions are stable. Even though raw material inflation is fairly volatile right now, the situation, they do believe that margins would be contained between that 22.5% to 23.5% band itself. And they do expect demand conditions to stay stable, which does imply that maybe volume growth would come by going forward as well. On calibrated price hikes, they did say it could be anywhere between 2 to 5% after the 5% price hikes that the company has taken in the first quarter. So that's something we will monitor. The stock, however, lower in today's trading session, maybe perhaps on account of the fact that the street expected a little more. 6 to 7% was the volume growth that was expected. HUL reported 5%, and the anticipation of a recovery in staples at large was fairly high, which is why there was slight disappointment on an otherwise in-line set of numbers.
So firstly, we see rural demand continuing to be stable and robust in the quarter. So in the quarter that's gone by, June quarter, we see both urban and rural demand continuing to be stable in the quarter. So that's really our outlook going in. We have to keep watching, like I said, in terms of the monsoon and in terms of geopolitical impact on inflation. But given all the measures that have happened in the country, both in terms of the monetary measures, fiscal measures, the demand in the country remains consistent, remains stable. We are obsessed with volume-led revenue growth. And I think that is our core focus, and you will continue to see us ensuring that we calibrate for that.
But the stock there lower 6% in trade today. Shares of Coforge zoomed in trade on the back of a strong June quarter. Earlier today, we spoke to Sudhir Singh, the CEO and ED of Coforge, who expects the robust growth to continue and to deliver better than guided margin for FY27. Take a look.
I think what you should expect is very robust growth from Coforge in what is a demand environment that is under stress and in flux. What I emphasized was that Q1 has been an exceptional quarter, and that exceptional quarter sets us up for an exceptional growth year. In quarter 2, 1 month of which is gone, we expect that robust growth to continue, and of course, hopefully not just continue, but accelerate quarter 3, quarter 4 onwards.
Take a short break. More news and updates follow on the other side. Stay tuned. Welcome back. Moving on to the latest from West Asia, then US President Donald Trump said that Washington is having quote-unquote very friendly talks with Tehran, but suggests that he is not prepared for prolonged negotiations. Meanwhile, Tehran said that the US is struggling to find a way out of the war. CNBC's Dan Murphy gets us the latest updates.
President Trump saying talks with Iran are going well, but also warned of a resumption in attacks if there was still no resolution. Take a listen.
No, you can't bribe them. You got to beat them, and we're beating the hell out of them. But we'll see how it turns out. Right now, there are very friendly negotiations going on.
But Iran's foreign ministry spokesperson said while messages were being passed via mediators, they were not currently in negotiations with the United States. He maintained that the Strait of Hormuz remains shut and pushed back against America's, quote, unilateral actions.
No agreement can be unilaterally implemented. This is natural. Therefore, Iran has ceased fulfilling its commitments. When the time becomes right, we will discuss future development directions.
So once again, the US says they're talking, the Iranians say they're not. And in the backdrop as well, Yemen's Houthis are trying to replicate Iran's strategy in the Strait of Hormuz by disrupting shipping through the Bab el-Mandeb in the Red Sea. Speaking in Riyadh, the country's top diplomat said the group has been emboldened by what she called an insufficient international response. The escalation has also raised fears of a return to full-scale war in Yemen, with missile and drone attacks, cross-border fire, and growing concerns over the security of global shipping routes. The Houthis are claiming a direct strike on Saudi oil infrastructure. The group says it targeted facilities linking eastern Saudi Arabia to the Red Sea export hub of Yanbu in a move that could heighten concerns about the security of global energy supplies. Saudi Arabia, though, said it intercepted a number of drones that Iran-backed militia in Iraq had launched at the kingdom's oil facilities, who have not claimed responsibility for the attacks. Iraq's Prime Minister Ali al-Zayedi has ordered an investigation into those drone attacks, saying Iraq will not allow its territory to be used as a corridor or launchpad for strikes against friendly countries. Pro-Iran militias have carried out repeated drone attacks across the Gulf since the Iran war began in February.
So Dan, there were the latest from West Asia. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Tata Sons has released its FY26 annual report, and there's a lot to unpack. From strong growth in both standalone and consolidated numbers to a big dividend payout and a decade's worth of wealth creation for shareholders. Beyond the headline financials, the report also throws light on how the group's big bets are shaping up. Hormaz is here to break it all down for us. Hormaz?
You know, a lot has been spoken about Tata Sons all through the last 12 to 18 months, and this report card is possibly the proof of how one of India's largest conglomerates has fared in the previous financial year. You start off with the numbers first up, with the revenue growth of 9% on a standalone basis, then a profit growth of 22%, the revenue standing at well over 40,000 crores, profit at well over 30,000 crore rupees, and that number gets even bigger on a consolidated basis. The 7.8% revenue growth there, consolidated profits going up 52%, and that has gone to nearly 2 lakh crore rupees, revenues crossing 16 lakh crore rupees as well. And finally, the company had declared a dividend as well of well over 1.1 lakh rupees a share. Now take a look at the change that the financials have seen over FY20. The revenue growth has now is double of what it was in FY20. Profits have gone up by well over 5x from FY20 till FY26. Now over the last decade, Tata Sons has created wealth for its shareholders as well. The last decade, the Tata Sons value has gone up 287%. That is in comparison to the Nifty 50, which is up 250% during the same period. And if you exclude TCS, which has been battered all through this year because of the various disruptions taking place in the world of AI, that figure goes up to 575% for Tata Sons. As the conglomerate is making a very big push on semiconductors, and Tata Electronics has been the highlight possibly of this annual report. It is becoming the biggest job creator for the group in the previous financial year. It has already become the 4th largest group company by revenue. Its operating profit is at a break-even point, and its fab in Gujarat is under construction as well. So Tata Electronics possibly being the highlight. On the flip side, though, you can say the same for Air India. Although its net promoter score has improved from a negative 35 to a positive 42 over the last 3 years, the airline is encountering serious headwinds such as airspace closures, the war-driven rise in fuel costs, and of course the tragic AI 171 crash last year. And the management of Air India has said that the turnaround could well be a 5 to 10 year long journey. And similarly for Tata Digital as well, there have been concerns raised with regards to the mounting losses for Tata Digital. FY26 was no different, and despite a gross merchandise value of over 46,000 crore rupees, Tata Digital still reported a net loss of close to 5,000 crores in FY26. Although there is a reset that is underway, with the focus area now moving towards financial services, lending and insurance for Tata Neu compared to the entire broad e-commerce space that it earlier focused on. Of course, the conglomerate is also backing future businesses. It is now also funding Agritas, which is the EV battery gigafactories which are being made in Gujarat and the UK. It is also funding Tejas Networks, which is building India's first indigenous 4G, 5G stack, and of course Tata Advanced Systems, which is also producing India's first privately built C-295 military transport aircraft. That is something that Tata Sons has been betting on. Among some of the other key milestones, of course, they demerged the passenger and the commercial vehicles business of Tata Motors. There was a big disruption that took place in JLR. They said that the business activity is almost back to normal by the end of the 4th quarter. They also had the IPO of Tata Capital last year, which became the 4th largest Indian IPO in history. And for Tata Steel as well, which also went on to hit its highest ever domestic deliveries. And Tata Power also reported record profits in the previous financial year as well. So that was Tata Group, Tata Sons in FY26, betting big on the future businesses, still trying to reset the digital business. Air India's turnaround is a long way away, but of course the financials have shown some strong growth.
So that's the FY26 report card for Tata Sons. Thank you so much for that, Hormaz. Now, the IMD's latest rainfall data till 22nd July shows an overall deficit of 19% for the country as a whole. The Southern Peninsula has seen the sharpest shortfall at 26%, followed by East and Northeast India at 32%. Northwest India's deficit stands at 13%, while Central India has fared relatively better at 9%. Water levels in 166 reservoirs across India as of the 23rd 3rd of July have improved slightly to 38.37%, but it is still below the 415% normal level, much lower than last year, 60.21%. Now, the Supreme Court orders an independent probe into allegations of excessive use of force against protesters. The court says a prima facie case is made out and has issued notice to Delhi, Maharashtra, Bihar, Madhya Pradesh, Assam, West Bengal, Kerala and Uttar Pradesh. In a key directive, all states have been told to release protesters who don't have a criminal record, with the court ruling out any coercive action against them. The bench also directs that digital data of protesters be preserved and kept out of the public domain.
With that, we call time on this edition of Business Lunch. Don't go anywhere. More numbers are set to come in as we go by during the day. The market's also back in the red. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
afternoon. Welcome to Midcap Radar. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Vivek Iyer. Well, markets continue to be quite volatile. For now, we are below the 24,000 mark, but for a larger part of the day, we've been above that. But again, it's the monthly expiry, so things will get very volatile. The broader end of the market, though, is outperforming the benchmarks for now.
Good afternoon, Sonal. Absolutely right. Volatile trading session as expected on expiry day, but we are continuing to outperform Asian peers. That's something that's quite good. But we have a lot lined up on the show, so let's start off with the top headlines. Market sees a sharp fall to trade near the low point of the day. The Nifty trades below the 24,000 mark, dragged by FMCG, metals and chemicals. Realty and consumer durables buck the trend.
Coforge delivers a strong quarter, reporting 21% sequential growth in dollar revenue. Combined EBIT margin of 16% tops its FY27 guidance of 15.5%. Speaking to CNBC TV 18, CEO Sudhir Singh says the company remains confident of sustaining growth despite a challenging environment.
RR Kabel extends gains onto a second straight session. The management strikes a tone of optimism. Joint MD tells CNBC TV 18 that they expect cable and wires margin to be 10.5% levels this particular fiscal. The stock, however, is off the day's high.
Godfrey Phillips slips after a weak set of numbers. Volumes contract both YOY and on a quarter-on-quarter basis, while profit also drops around 44%. Management says it will pursue a balanced pricing strategy to limit the impact of consumers going forward.
Warren Beverages Q2 results disappoint. The India business volume growth of 14.4% fails to top estimates of 20% growth. The stock sharply lower at lunch hour.
All right, those are the top headlines that we are tracking. As we say, Nifty, the headline index continues to be very volatile, but we do have a lot of action beneath the surface, especially if we talk about Nifty IT, that continues to be one of the top gainers. This month itself, Nifty IT was up 16%. We do have Nifty Realty, which has done well. It is up today, and this month itself, it's up around 10.2%. Autos are also not far behind, up 5% in a month, in the month gone by. But today, in terms of the losers, we do have CPSE index, which is down 2%. FMCG is also not doing so well. So there are more losers in trade today versus gainers, and that is something that we'll be tracking very closely. Mid-caps, however, are outperforming the benchmarks for now. So this is our segment, Mid-Cap Movers. We have Upasna to take us through the mid-caps that are moving around in trade. Upasna.
Well, first, let me take you through the Nifty Mid-Cap Index, which is up just about 0.1%. Now, let us focus on the top gainers in today's trading session. Lodha continues to remain in focus. If I talk about the 1 month move of the stock, it's up nearly 34%. And today, as we can see, it's up more than 6%. Prudent Corp, the result rally continues for the stock, and also management's strong commentary in its con call, which was held last evening. Hexaware Tech also in focus, one of the key volume buzzers. Volumes up more than 30 times the weekly average, up more than 5%. Newgen Software and Apple also seeing a sharp gains of nearly about 3 to 9%. Now let us put the focus on some of the stocks that are reacting sharply on the back of its Q1 results. Aeroflex, strong numbers reported by the company, up nearly about 5%. Gravita and JK Paper are seeing some weak result reaction. Now on the flip side, let us look at some of the top losers in today's trading session. And mind you, select capital good stocks are under pressure today, be it for the likes of CG Power, GE Vernova, Apar Industries, all these counters seeing deep cuts between 3 to 4%. Data Patterns, after its weak Q4, continues to see that cut down about nearly about 5% as we speak. And lastly, Godfrey Phillips also down nearly about 8%. So all in all, these are the stocks that are on our radar today.
Well, thank you so much, Upasna, for joining us, giving us a sense of all of the top movers and shakers as far as the broader end of the markets are concerned. Well, moving on, it's a good time to get a quick technical check on the markets. Sachitanan Dutekar from Trade Bulls joins us. Sachitanan, good afternoon. Well, what do you make of the markets at current levels? Nifty, largely flat with a negative bias. Where do you see expiry headed, and do you see this is a consolidation for a further up move?
Good afternoon, Vivek. When we look at the broader structure, I think there is still scope that Nifty would move higher. But if you look at today's data itself, it is trying to defend its 5-day exponential moving average support, which is placed somewhere close to around 23,970 thereabout. But if you look at the hurdle, it has to surpass the 20-day exponential moving averages cluster, which is placed at around 24,040, which looks difficult for the day. So maybe we may see some bearish sentiment in the final hour of trade, and that's why we believe that the Nifty could expire somewhere close to around 23,900 thereabout. So I think it's a consolidation, but for the last leg of the move, we are expecting that 24,040 remains a very strong hurdle, which may not be crossed during the day.
Well, Sachithanand, that's your view as far as the indices are concerned. What are your individual trading picks for the day?
Well, IT is something which is looking lucrative, and if you look at the way InfoEdge has been performing, it has been an outperformer, and we have seen a fresh breakout from a bullish flag formation on the daily scale. It is still exhibiting a large price action which needs to be unfolded. We may see a surge towards 1390 in the coming series itself, but from a trading perspective, one can keep a stop loss at around 1210 and deploy fresh long positions for an immediate target of around 1320. The other stock which we have recommended to our clients is BDL. We are recommending building long positions here. Even here, we are looking at a good turnaround. We have already seen a good consolidation within the triangle formation on the weekly scale. We are expecting a move towards 1266, and hence we are recommending building fresh long positions in BDL futures, keeping a stop loss at 1214.
Okay, Sachithanand, thank you so much. So your two top calls for the day is InfoEdge as well as Bharat Dynamics. Thanks once again. Well, we'll now slip into a short break. We'll get to the management of Aeroflex Industries on the other side. Stay tuned.
Welcome back. You're still tuned into Midcap Radar. Let's get you an earnings conversation now. Aeroflex Industries is the management joining us on the show now. Revenue rose above 70% while profit more than doubled. Margins also saw healthy expansion. Let's get in Asad Daud, who's the MD of Aeroflex Industries, joining us now to break down the quarter for us and most importantly talk about the outlook going forward. Asad, good afternoon. Thank you so much for joining us. It's been a good start to the fiscal. You've seen a revenue growth of 73%. Profits are up 160%. What is the internal guidance, or what are you guiding for in terms of FY27 performance on the revenue growth, margins, and profits?
So, thank you so much for having me here. In terms of the growth, yes, Q1 has seen significant growth in all the parameters. And for the financial year, full financial year, like I mentioned in my last conversation with you, that we expect that this year we'll have a growth of about 30 to 35% in the top line, and a similar level of growth also in the bottom line as well. This is on account of the capacities that we have, being commissioned in the skid assemblies.
Okay, so 30 to 35% growth on the top line, followed by a similar increase on the bottom line. Now, Q1 has been extremely strong. When you're looking at the top line growth, a little over 70%, profitability has more than doubled. So we are expecting a bit of moderation, maybe on a higher base as far as the rest of FY27 is concerned. Is that right?
So if you see just Q1 from last year to Q1 of this year, so the last year Q1 was, one of the worst quarters that we had in the foreseeable future. So on that scale, 70% was a extremely big jump. But if you see for over the period of the next quarters as well, Q2, Q3, Q4, we expect that the growth overall on a yearly basis to come to about 30 to 35%.
Okay, 30 to 35% is the growth that you're expecting. You did see an acceleration in the liquid cooling solutions business. How much did it contribute this quarter? What is the yearly target that you have for this particular business? And what kind of growth rates are you seeing in this particular segment?
So in terms of Q1, the liquid cooling business contributed about 23% of the total revenue. And we expect that by the end of this financial year, the liquid cooling business would contribute anywhere between 25 to 27% of the overall business. And that is where we see a significant growth also coming in this year as well as in the future years as well.
So you're saying that compared to the rest of the businesses, it probably doesn't go as fast, because from 33%, you're expecting the FY27 contribution to drop to around 25%, or are we getting the math wrong?
No, so currently the contribution is 23% right now, and we expect that to increase it to about 25 to 27%, because we are also seeing increased growth in our core business as well, which is the flexible hose and the hose assemblies. That is also seeing significant traction coming in, not only from India, but also from Europe and USA.
Asad, when I see, the presentation, there's a lot of focus this time around as far as, data center as well as hyperscalers is concerned. We understand that this particular segment that you just spoke about is what, is driving quite a lot of traction. Give us a sense of what exactly you do, number one, very briefly, and what is the kind of growth rates you're seeing over there in terms of top line? And number two, what is the EBITDA margin that you're making for this particular product?
So in terms of the liquid cooling, right now we are supplying two products. One is our hose assemblies that we are supplying to the data centers. The other is the secondary fluid network, or the skid assemblies that we call it, which is actually used in the entire cooling systems to cool the racks. So the entire product is being manufactured by us, and we have a partnership with a very large US company who has a presence in India, wherein we supply the products to them, and then they ultimately supply the entire solution to the data center business. And, this business is seeing a tremendous scope. As you can see that with a lot of data centers being already planned and commissioned, we expect that this particular business vertical to see extremely high growth in the foreseeable future.
So when you say extremely high growth, just trying to understand, Asad, how big of a opportunity it is, because it's just not you. A lot of companies are talking about data centers being a big business opportunity. Do you think after a while it will become a commoditized segment for every business? How would margins pan out here? Because once you reach scale, maybe margins will not be at premium versus the core business, right? So what are the margins you would enjoy currently? And if you pick up scale here, what happens to margins?
So in terms of the margins in this business is in a similar line to our overall blended margins. And, as competition comes in and as we, as the pricing also becomes competitive, we would also be, working internally to do cost optimization, because to be fair, right now we are focused purely on supply because that is the constraints right now and not so much focused on cost optimization. I think as, competition increases and there'll be a squeeze on the margins, I think we'll be focusing a lot towards the cost optimization part, which will help us to maintain our margins.
Okay, Asad, that's quite helpful. What we want to understand is going forward, in terms of the domestic market as well as the export market, what is the ideal mix you're targeting? In the Q1, it appears also, exports have outpaced domestic market. And in terms of margins, do you operate at similar margins for both the domestic and the export market, or is there a differential?
So in terms of when you talk about our core business, so exports definitely has better margins as compared to the domestic margins. Right now, the ratio of export to domestic is about 60-40. I think as the domestic business of liquid cooling increases, this ratio might come down to approximately 55 for exports and about 45 for domestic. And we would expect to continue that ratio with a nice balance between exports and domestic.
Okay, all right. Take that point, Asad. Thank you so much for joining us today and giving us a sense of what the business is looking like and the outlook going forward. The stock is reacting well at 5% in an otherwise volatile market. That's the word coming in from Aeroflex Industries. Slip into a short break. When we come back, we'll get you more on the markets and talk about some stock-specific action. Stay tuned for that.
Welcome back to Midcap Radar. Well, a couple of stocks hitting the screen. Now, have a look at Kalyan Jewellers. After a sell-off that the stock saw yesterday, stock high by almost 7% today. The other stock that's hitting the screen is Nuvama. That particular stock has slipped to the day's lowest point, down almost 5%. And Suzlon Energy, whose results are expected anytime, that particular stock, has seen quite a sharp downtick of a little over 3%. Now, as we speak, it's falling significantly lower. So, Suzlon Energy, you can see the results on the bottom of the screen, a net profit dip of close to 6%. And that's caused the stock to dip to the lowest point of the day. But moving on, this is our special segment, Midcap Spotlight. Upasna will focus on RR Kabel.
Well, the company reported a strong set of numbers with the revenue growth above the street estimates, while the PAT and EBITDA margin was largely in line with what was street estimating. Now, coming to the revenue growth, it stood at as high as 54% versus the estimates of 38%. This was mainly led by company's strong growth reported by its cable and wire segment. Now, coming to this segment now, the reported revenue growth here is 57% on year-on-year basis versus the estimates of 40%. And also, mind you, it was a turnaround quarter for FMEG as it turned a bit break-even this time around with a 28% revenue growth on year-on-year basis. Now, coming to overall EBITDA margins, they stood at 8.9% with a sharp uptick. And also, this was led by the cable and wire segment, which led to the sharp margin expansion. Now, sharp surge in company's other income also supported the overall PAT growth of the company. Now, coming to the peer comparison, now Polycab, Havells and RR Kabel, all these counters have reported their Q1 results. And clearly, this RR Kabel stands out with a cable and wire revenue growth of as high as 57%, which is highest amongst its peer. But coming to the margins, it stands at 9.9%, which is lowest as compared to the other two counters. Now, management joined us today after its Q1, and it has given a cable and wire EBIT margin guidance of 10.5% in FY27 is what the management has indicated. Now, let us look at the brokerage stake. Now, Citi has given a buy call with the target price of 3,000 per share, and CLSA has also given an outperform call with the target price of 2,850 post the Q1 results of the company. So, certainly Q1 bodes well for the company. Let's see what lies in FY27.
Okay, thank you so much, Upasna. So that's about RR Kabel. The stock was up 7% at a point in time, has come off sharply and almost closer to the day's low as we speak. But the other stock which is under pressure is Avenue Supermarts after news flow from the analyst meet. Mangalam is joining us with the key takeaways and what that means for the company going forward. Mangalam.
Well, DMart is trading lower as the analyst meet is currently underway. Among the key updates that we have gotten so far, no fresh change in outlook is something that the street is slightly disappointed by. We do know that the company is guided for 15% store expansion annually, which implies about 80 to 100 store additions. And at the same time, they've said that, there would be a higher proportion of stores coming in from the leased model. So those are a couple of factors that really stood out so far. But the analyst community is slightly worried about, the fact that the store expansion could have been a little more. And at the same time, the looming threat from quick commerce keeps same-store sales growth in the urban centers slightly muted. So these are a couple of factors which the street is perhaps disappointed by. But by and large, no change in policy has, the stock lower in today's trading session. No aggressive guidance, uncharacteristically or characteristically coming in from DMart this time around. And as the analyst meet is currently underway, the street's chosen to take some profits off.
That's right. Thank you so much, Mangalam, for joining us and giving us all of those details as far as the ongoing analyst meet of DMart is concerned. But Supreme Industries, just a while ago, declared its Q1 results. Ria joins in with more details.
Well, yes, we have seen a mixed quarter this time around for Supreme Industries. In terms of the revenue growth, we've seen growth being muted at around 4% compared to an estimate of 7% growth on a year-on-year basis. Margins, however, have expanded by 240 basis points to 14.6% this quarter, well above the estimates that the street was working with. Even the net profit has gone up by 39% versus estimates of just 15% growth. But if you look at look deeper into the segments, the plastic piping revenues have been flat on a year-on-year basis. Margins have improved to nearly 11.4% for the segment, but if you look at the volumes have seen a whopping decline of nearly 14.2% compared to the previous year, coming in at 1.57 lakh metric tons this time around. And on this front, the company has said that Q1 for them was impacted by an extraordinary volatility that was seen in polymer prices, and particularly the abnormal downward price movement that they witnessed during April, which has triggered this inventory correction across the value chain. But going forward, they do believe that the volume impact is a temporary phenomenon, and they expect improved business momentum in the quarters ahead as the channel inventories normalize and demand conditions recover for them. So that is the positive commentary that has come out of Supreme, but nonetheless the volumes have taken a big hit in this quarter. In terms of the guidance that was given earlier for FY27, the volume growth expectations was nearly 15 to 17% for the plastic piping segment, and the overall company volumes were expected to grow by nearly 12 to 13% for the full year of FY27.
Okay, Ria, thank you so much for joining us. So that's about Supreme Industries. The stock has come off from the highs of the day post numbers. And look at that. First, there was a sharp spike, and that has been sold into. With that, we'll take your leave on this edition of Midcap Radar. Stay tuned, MF Corner when we return.
Hello, good afternoon. You tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. Now, today what we're going to be discussing is more in terms for where to park your short-term money. Now, that isn't a simple question that can be answered, right? And it's not easy as it sounds. There's so many options that you have. You have liquid funds, overnight funds, ultra short-term funds, arbitrage funds. That also comes into the mix, right? So all these a different purpose. Now, how should you be breaking it down? How should you be framing this for the short time period as well? And depending on your short-term period, whether it's few months, a year, 6 to 9 months, what is your strategy? How does it work? How does the redemption work for this as well? To answer all of that, today we have our experts joining us. We have Santosh Joseph, founder and partner at Germinate Investor Services, as well as Amrin Agarwal, financial educator, as well as director at Nifty India, to help us understand the strategies that you should have to park your short-term money. Santosh as well as Brain, good afternoon. Thank you so much for joining us on the show. Let's get started with the basic, right? How should an investor think about the time horizon when picking between these short-term funds, whether it's liquid funds, overnight funds, ultra-short funds, or arbitrage funds? Santosh, let me start this with you first.
Hi, Vinny. Good afternoon. Good to be on the show. It's important for us to even consider parking money in fixed income as much as we consider parking money elsewhere, because many times we think that parking fixed income, you can just park it anywhere, because even within fixed income, there are different categories. Like we just discussed that in overnight funds, it is for the absolute short term when you do not have a date or you do not have a time. If your time horizon increases, then you move into the liquid fund. And then if you have a slightly longer time towards close to a year, you look at money market funds. What this tells you is that you align even before you invest into the category of fixed income product that helps you best realize value for your money and also minimize any sort of risk or uncertainty as far as the liquidity of the fund is concerned. You also have to keep in mind that in fixed income, there could be also some bit of a duration risk, which is being sensitive to the interest rate movements. So therefore, if you're really looking for short term and don't have a time on horizon, the overnight fund with 1 to 7 days is an ideal time horizon. But if you're looking for between 90 days to maybe 180 days, then liquid funds will help you fit the bill there. If you're closer to a year, money market funds, which are typically looking at the 1 year rates, is helpful. If you have a 2 to 3 year horizon, that's when you look at maybe short-term fund, ultra short-term fund, low duration. That way, you're well suited to match your time and the return and even the risk there.
Absolutely, timing is also a matter that comes here, and depending on your timing, you can invest in all of these. Mrin, good afternoon. Taking this question as well as, what is it that when you are advising investors, a big mistake that you think investors actually make when picking these funds as well? What is the biggest thing that you're seeing them ignoring? Is it that they're chasing returns? How is it that, they miss out on this opportunity?
So good afternoon, Vinny. Lovely to be here today. And I think, the first mistake, as, Santosh pointed out, that it's very important to align the time period of holding with the fund that you're choosing. So that, of course, to me is the biggest mistake, because many a time you see that people are choosing funds based upon the returns and not really what is the investment period of holding. So like, for example, somebody might be looking at an arbitrage fund, just looking at the returns being better than an ultra short duration debt fund and choosing that. The second aspect, also keeping in line with arbitrage funds, is the fact that a lot of times people tend to choose tax optimization over liquidity. So, let's understand that while arbitrage funds might give you a more tax optimized return, the fact remains that, these are typically meant for periods above a year, because you may not have opportunities in some time frames in less than a year. So again, focusing on tax optimization over liquidity. And let's remember that when we are looking at shorter term investments, it's all about liquidity. It's really not about returns. It's really about liquidity and risk. So again, the third thing would be taking very, very risky bets. And I think that's another big factor, when we look at the non-mutual fund investments that people tend to consider over the mutual funds, which are, of course, where risk is managed, credit quality is managed.
Santosh, obviously risk, credit quality, all of them also is important to manage as well. There's a thing that I want to understand. Now, for an ideal investor, maybe who is looking at an overnight fund, you mentioned the timing, but does it merit that, overnight funds are mainly more for corporates parking treasury cash, or even retail investors can look to participate and benefit from this as well even more?
Vinny, I'm glad you asked that, because there's a general tendency to think that overnight funds are only for treasuries and corporates or non-individuals. It couldn't be further from the truth, because overnight funds are for all of us. It's for you and for me, and retail investors can and should avail of this benefit. As the name suggests, overnight, it also means that you are not sure when you might need to withdraw the funds. Now, because it's overnight, high liquidity, certainty of being able to get the money back in that short T+1 redemption. Now, you also have to keep in mind that for retail investors also, they have needs that not only do they need the money, but they may want to do an STP, or they may also want to switch in at a time when the market gives them opportunities. So therefore, the overnight fund also serves for parking as well as for transient purposes, where the end goal is some other investment, but you're parking it here. You want to keep your capital safe, and you also want high liquidity and a quicker turnaround. So retail investors should take the most of this.
Retail investors can also make the most of this as well. Mrind, we've in the past spoken a lot about emergency funds as well, and how they should be maintained as well. I just want to understand, with overnight funds in the play, you have liquid funds as an option as well, and you have your savings bank account. Someone who is building out their fund, would you recommend overnight funds, liquid funds? How does that also play into this mix for a retail investor?
So I think the first thing is that, again, for the emergency fund, I always recommend to have some money in the savings account, of course. But I think, and some money in the liquid fund, but I feel a larger portion of the funds should actually be invested in probably slightly longer duration funds, like the ultra short duration or the low duration funds, right? I mean, I feel, you shouldn't really be keeping everything in overnight or liquid, because typically, this is the overnight and liquid. Like overnight, you would keep for a few days. Liquid fund, you would keep for periods up to a month, right? So it's not necessary that you're going to have the emergency in the next 1 month, right? So I would say that put some money in, between the savings bank account, between overnight, between liquid. I think choose two of the options, 1 year, 2 option. It doesn't really matter, and put some money over there. And the balance, which is what I would say would be at least 75%, put it in slightly longer duration funds, like the ultra short duration or the low duration funds.
Just one word, what I want to understand in a bit more is, when you are looking at these sort of funds or short-term money also, how does the planning actually work? Because you have to start planning before. You may need it suddenly. Savings bank account, the liquidity is there immediately, right? You will get it immediately from your savings bank account. But when you are invested in all these funds, then how does that work? And how does that planning have to work for an investor?
So, of course, the liquid funds, all of these funds follow the T+1 redemption cycle. And hence, you have to keep in mind the fact that when you have an emergency, the funds are going to be available only after 1 day for you, right? So you have to keep that aspect in mind. I think some of the funds, the overnight and the liquid funds, have launched the Insta redemption facility. But again, you must remember that the maximum over there that you can withdraw is 50,000. Or 90% of the invested amount, whichever is lower. So, for example, if your invested amount itself is 40,000, then the maximum that you can withdraw is 36,000, right? So keep that aspect in mind. But yes, the Insta redemption is there for anything that you might need right away. But clearly, I think, when you're looking at investing in funds for emergency purposes, you must keep that in mind, that the money would be accessible only after 24 hours.
Santosh, two-part question, same to you. One, in terms of obviously liquid funds versus overnight funds, how should an investor look at both of this? And in terms of the redemption confusion as well, anything that you would like for an investor to be aware of, so when they are planning it, they know their redemption story?
Clearly, I think overnight and liquid is a little easier to differentiate, because in an overnight, there is no that 7-day exit load clause that is present right now with liquid fund. So therefore, when I mean overnight, it's literally overnight and it's quick redemption. You get the money in T+1 day. And I'll add on to what Mrind said. In some cases, if there's an emergency within an emergency fund, there is a small window of getting the money in really quick time, but then that's limited to 50,000. And even if you want to overcome that, you'll have to open multiple folios and do multiple redemptions. So it's better avoided. Plan for 1 business day, ideally. Now, between liquid and overnight, the liquid is usually when you have the money at least for 2 weeks or 3 weeks or a month. ideally, that's when you get into a liquid directly. If you do not know how long, it could be 1 day, it could be 3 days, it could end up even being 15 days, then you're better off being in overnight. Literally, the name itself tells you that you can pull out the money overnight. Whereas in liquid, you have to give it some time. Better to come in at least when you have a 2-week plus kind of a window there. So that is the easy way to segregate overnight and liquid.
Okay, point taken there. On that note, actually, we're going to slip into a very short break. We'll continue this conversation after the break as well. Stay tuned in. Welcome back to MF Corner on CNBC TV 18. Today we are discussing how you should be parking your short-term money. Where should you be parking it as well? And obviously we're continuing this conversation with Santosh Joseph as well as Mrin Agarwal. Let's take this conversation forward. The next point that I want to understand is ultra short duration fund, market money fund. Where does it fit in the whole short-term scenario as well? And how much of the money should actually be on the short-term side of your portfolio? Mrin, over to you first.
Yeah, so again, ultra short duration fund is something that you'd ideally do for a 3 to 6 month period, and typically money market fund for 1 year and above. So clearly, I think, it's really a question of what is the money you need when, and you allocate it accordingly. And, Vinny, many times, in fact, I hear people asking that, do we even need a debt fund in our portfolio? And I do believe that, a debt fund is very much required in a portfolio that has any short-term requirement, right? So again, everything really needs to be tied in very well with the period of holding, because what could happen, especially when interest rates rise, that if you're invested in a fund that doesn't tie in with your investment horizon, then you could like see some less, negative returns. You could see some, some sort of volatility in that case, right? And that's the reason why we typically say that the most important thing in the debt funds is not to look at what's happened in the past, but to actually look at what's the sort of duration, what's the sort of time period that you have for this investment.
Santosh, arbitrage funds, where do they fit in this mix as well? They are taxed like equity, but they behave like debt in terms of volatility. So does it fit somewhere in the short to medium term investment strategy if someone wants to look at it? Or is it something that they should avoid if they're looking at a short to medium term outlook from this one?
Arbitrage funds are actually great products. You rightly said, they're actually fixed income, get the benefit of equity taxation, essentially for people who do have a time horizon of more than a year, and they can park the money here to get the benefit of fixed income like return and get the equity taxation, thereby significantly improving your post-tax return on the investment. Now, there are two things that you have to keep in mind, that if the investment horizon is less than 365 days, it will qualify for short-term capital gains, so therefore that won't be favorable. Second thing is, unlike any other fixed income product here, you need to wait T+2 because this constitutes as equity, because the way the arbitrage fund gets the equity taxation is by being minimum 65% in equity. How do they get a better yield or better post-tax yield? It's simple. They buy in the cash and they sell in the future. They lock in a yield and they get some good months and some average months. The yield works out to be slightly better than the short-term rates on a one-year basis. So for an investor, when you're beginning your investment journey in fixed income, you have the certainty at least of a year or more. Arbitrage funds are a great play. Post-tax return make great sense. And it also helps you plan your overall portfolio strategy because you're bucketing the investment for more than 1 year and less than 1 year. And the minute you bucket more than 1 year, you have the benefit of this lower taxation benefiting your post-tax returns.
Point taken there. There's this important question that a lot of investors send us as well. So I'm going to give you 3 time horizons: 3 months, 1 year, 2 year. This question is for both of you. How would you allocate in different fund categories for each of this time horizon if it's the short-term outlook as well and short-term investment strategy? Mirin, first to you.
Okay, so I know we've been talking about, in the whole show, we've been talking about aligning with your goals and your investment time horizon. So, before I talk about where to invest, the one place that I'd suggest you not to invest is, of course, corporate bonds. I do see a lot of people investing in corporate bonds for like 2 months, 6 months, 8 months, like there are various maturities that are available. And of course, the returns are much higher because these are very lowly rated bonds. So, off late, I have been receiving a lot of inquiries from people saying that instead of putting it in these funds, which are, maybe giving you between 5.5% to 7% returns, why don't I look at these bonds which are giving me 10-11% return? So I would say, please don't do that because the risk over there is much higher, huge amount of default risk. Now, clearly where 3 months is concerned, you can consider the ultra short duration debt fund. For a 1 year period, I would say either you can look at the, if it's just less than a year, look at the low duration fund, 6 months to a year. But clearly for the 1 year, 2 year periods, given the fact that the arbitrage funds does give you the tax arbitrage as well, certainly I would say that look at the arbitrage funds.
And what's your view on this as well, Santosh? 3 months, 1 year and 2 year time period. How should they be dividing the money in liquid fund, overnight fund, arbitrage fund?
In line with all that we discussed, the 3 months should ideally be positioned between overnight and liquid. I would say about 25 to 30% between overnight and the rest of the money in liquid, especially since it's 3 months. The minute you go for 1 year, I think a very small portion in overnight, that is for an emergency. Otherwise, most of the money could be between liquid to money market. Because it's closer to 1 year, I would say money market. And if people have got 2 or maybe even 3 year horizon, then you keep very small money in liquid, bulk of it you park it between ultra short. And this is where you can even introduce arbitrage because you definitely have a 1 year and about time period, and less than 2 year arbitrage will add value to you. What we've done essentially here is align the time with the category of the fund for the most appropriate yield, liquidity, and the quality of the papers that you're buying into.
Okay, point taken there. So, this is how you should be dividing your short-term money. Mirin as well as Santosh, thank you so much for joining us on the show, explaining us how investors should actually be looking at short-term investments, should they plan their short-term strategy as well. So that is what we will be discussing going forward. But thanks so much for that conversation today. But let's move on and talk about some important news flow that's coming from the mutual fund side as well. And now you have Edelweiss Mutual Fund that is set to launch India's first REIT-oriented index fund. Now, what does this focus on? It's going to be an NFO period will be 5th of August to 19th of August when this NFO will be opening up, and this is going to be focusing and managed by Bharat Electronics, as well as Mansi Jagalankar, who will be managing the fund as well. Then you will have the fund which will be aiming mainly Nifty REITs as well as the Realty Total Return Index, which they'll be focusing on. So this is important because this is a time when everyone's focusing a lot more on REITs. And when asked to Radhika Gupta, she clarified as well that they're not focusing on InvITs because they come in a hybrid strategy. So obviously it's more of a REIT focus fund and not a hybrid focus, which is still not allowed by the SEBI as a construct for this sort of funds. Now, let's move on to the next news flow for the week. We had an important news flow that came in from SEBI as a consultation paper where they're focusing on a PMS that can invest exclusively in direct plans of mutual funds, including ETFs, SIFs. Minimum investment will be reduced to 25 lakhs from previous 50 lakhs. These are some of the changes that are proposed in the consultation papers. Obviously, apart from that, there are a whole host of other changes that have come in to allow more flexibility to the fund managers as well. So they could maybe invest in foreign listed entities, equities. They could be investing in listed overseas debt securities as well, overseas mutual fund investing, listed equities like debt, REITs, all of this will also come in here. And in terms of other news flow that have come in as well is going to be on the consultation paper as of now. Will be key to watch out for whether this actually goes through. But as of now, this is a consultation paper, and mutual fund specific for PMS only mutual funds investment is also what they're talking about. Some of these proposals that have come in here, but that's all the time we have on this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Nikkei, Kospi, that's where the major fall came in as well.
You know, we're having good talks. So we'll see what happens.
Quote unquote, very deep talks, very friendly negotiation. It is unchanged almost, right? I mean, blinking red and green.
6 to 7% of our revenue on an ongoing run basis is now outcome based.
It's not that we'll make profit on that, but we'll not make loss also in Mudra.
The revenue as well as the EBITDA are largely in line with street expectations.
There's no malified action, no personal enrichment, and no improper motive.
Continue to see palm oil inflation for the second consecutive year.
Well, markets continue to be quite volatile. For now, we are below the 24,000 mark, but for a larger part of the day, we've been above that.
Well, that is the day so far. I don't think there's very much going on with regards to the Nifty. It's absolutely evenly poised. 3-point change, could be up, could be down, but not going anywhere. It's FMCG on one side and IT on the other. It's been that way, I think, from the morning. So no real change as well. We're coming to you from the CNBC TV 18 Motilal Oswal studios. And we'll talk about individual stocks because that is where all the action is. I'm Prashant and Reema and Nigel with me. Guys, hi. Afternoon.
Hi, afternoon. So the Nifty IT index has rallied about 6% in just the last 2 days. So the good run on IT continues. And you can see that in individual names. So frontline names like TCS, Infosys, HCL Tech up between 2 to 5%. And even mid-caps are surging. You've got a Coforge up 10, but even a Mastech, Eclerx, these stocks are higher by 6-7%. And on the way down, it's FMCG, which is clearly the accident of the day. Very sharp declines in the Godfrey Phillips, Varun Beverages, HUL, 6.5% down. And even Avenue Supermarts not spared today.
Opposite ends of the spectrum, tech doing well while FMCG is down. And, the sector that I track, Ambuja Cements, the commentary that's coming in from Ambuja Cements actually is fairly subdued. They're talking only about 5% volume growth for the remainder of this year. They're also saying that input costs will continue to remain elevated. Operationally, these numbers actually look better than what the street was working with. If you look at it on an EBITDA per ton basis, there's a good recovery on a sequential basis, and there's a mild bait. Remember, expectations were very, very low on this sign. The volume degrowth has come about, and barring Kotak, most were working with a volume degrowth of close to 5%. But I'm just looking at the number. The volume degrowth is to the tune of close to 7%. So clearly, they've lost some market share. The street will hope for better times ahead. But the commentary that was up for you on the screen with regard to only 5% volume growth for the industry, as well as input costs remaining elevated for quarter 2, that's a bit of a dampener. That's why you're seeing the stock not running away, despite the numbers being relatively better than what our poll threw up.
Well, absolutely. And I think, some more, lots of commentary coming through, right? There's Ambuja, I think I just saw something from Radico.
Yes.
And they've a bit about the volume guidance and what they are saying about the volume guidance for the prestige segment. So they're saying that they're upgrading their volume growth guidance in the prestige segment to over 25% for FY27. So that is the Radico commentary. Numbers were very strong on a year-on-year basis. Of course, I mean, the stock move has also been extremely strong, and there is some more detail coming through in terms of commentary and guidance. Well, a bit about the margin as well. Expect to deliver margins of around 20% for FY27. So that's coming through from the Radico management. Well, let's just quickly run you through what's lined up here. So, of course, markets will be in focus, although indices are flat. Mid and small caps are losing a bit of luster. IT stocks are building on gains. HUL is a top drag on the Nifty. There is, of course, D-Mart as well. That's Avenue Supermarts. So both will be in focus, along with, of course, what's happening with IT and whether this is more tactical or something else. Varun Beverages, TTK Prestige are also, of course, reacting on the back of earnings reactions. So this is all in focus over the next 60 minutes. And, of course, expectations, Larsen reports, that's a big one. Eicher Motors will report. So we'll get you previews as well. Mitesh is with us. How should you position yourself in the last hour as we head into it? Mitesh, good afternoon. Welcome back. Your thoughts on the absolutely flat trade on the index, if there is a trade here, and then let's get to stocks.
Yeah. So, good afternoon, Prashant. I think no trade per se, because one, I think
Today being the expiry day, the movement might happen around 3 or just post that time. Secondly, I think the index is still not showing signs of a breakout. We were close to the upside range, which was 24,050, but kind of have tapered off from there. So we're broadly stuck in a range, not much happening with the Bank Nifty not participating. I think Nifty breakout chances are slightly on the slim side. Having said that, you're rightly pointing out IT, so I have a buy on Wipro with a stop below 178.5. Look for a target of 187.5, 188. And Tata Power is broken below its earlier lows, could see some more downside. So that's on the sell side, call with a stop at 373.5 for a target of 356.
Anything on the FMCG names? The stocks is, yeah, go ahead.
In fact, I was positive today, and there were, stocks like Colgate and Lever, which were looking interesting. But while Colgate has done well, Lever has clearly had a breakdown as it kind of started trading below 2100. So I think there could be this important level where the stock had bottomed out in April, which was around levels of 2020, 2025. And it's just trading around there. But in case we get a closing below that, I would expect more downsides in Hindustan Unilever, and a target of 1930, 1940 opens up.
Let's talk about IT. Clearly the sector leader, the star today. The Nifty IT index is now 18.5% up from the 1st of July low. That was a 52-week low. And this month, TCS is up 18%, Infosys up to 11%. And Infosys was, remember, a stock which got pummeled after its numbers. The street was disappointed with its guidance, and yet the stock is up double-digit. HCL Tech is clearly the standout performer, 23% rally so far this month. On the side, if you zoom out and see, globally, the tech trade has come under pressure. So the Kospi was down 11% today. The Japanese markets, Taiwanese markets also down 4-5% today. And the Korean market has fallen 35% from the June high. That was a record high. It was a level above 9,000. And today, Kospi is closer to 6,000. The Taiwanese markets also off 15% from the recent high of 48,000 plus. It also helps when companies like Coforge, which investors have bet on to play the IT services game, come out with very strong numbers. So the CEO is confident about Q1. He says Q2, Q3, Q4 is going to be a robust quarter. This leads the company to have an exceptional year. Q2 deal wins will be higher than anything that they've signed ever before. They hope to get closer to $1 billion, but not putting a timeline in terms of $1 billion in terms of overall deal signings. And there's also a possibility that the company does better than the margin guidance of 15.5% that they had shared earlier. That said, the global tech trade remains under the watch point, because tomorrow Microsoft Meta report numbers, Amazon is on Thursday, and the big question is, will the AI capex spend guidance be upped? Already the numbers are very large. These three together would be in excess, closer to about $550-600 billion. Alphabet last week raised the guidance, turned free cash flow negative for the first time, and the stock got hit. So this week, we will know what happens with the AI capex trade. So that's going to keep the IT stocks and the global chip names and the AI names extremely volatile. But that's the update that's happening. In fact, let's talk a little bit about Coforge, because we had a chat with the CEO, Sudhir Singh, earlier, and this is what he had to say about growth and demand.
I think what you should expect is very robust growth from Coforge in what is a demand environment that is under stress and in flux. What I emphasized was that Q1 has been an exceptional quarter, and that exceptional quarter sets us up for an exceptional growth year. In Q2, 1 month of which is gone, we expect that robust growth to continue, and of course, hopefully not just continue, but accelerate Q3, Q4 onwards. All planned exits are behind us. We announced it in advance so that there were no surprises, and Q2 is going to be a robust growth quarter for us, as are Q3 and Q4 likely to be. What we did say in the investor call is that we do expect at least 15.5, which was our guidance, but we suspect that that number can inch up, possibly go up as the year progresses.
Ashish Chaturmutha, MD and Fund Manager at JM Financial, is now joining in. Ashish, where do you all stand on the technology names here in India?
Hi, very good afternoon, and thanks for inviting me on this show. So obviously, at one point of time, we were very, very cautious about this entire IT space. But of late, the view has been changing first, because if you look at the entire AI Bloomberg Value Chain Index, it has been continuously seeing a lot of correction in the last couple of weeks. And there's a very inverse correlation between this AI Value Chain Index versus Indian IT. And clearly, in the last 1 month, we have seen very, very strong outperformance started coming from IT companies. So obviously, I think there's a very strong sector rotation which has started happening from this entire AI semiconductor data center story globally to some of these Indian IT companies. Second, if you look at this quarterly numbers, so obviously the numbers were ahead of expectations, and particularly companies like Coforge has posted very, very strong set of numbers. So market is liking this entire numbers. And from a valuation perspective, most of the larger cap names, whether it's TCS, Infosys, or Wipro, they are trading at 20 to 25% discount to their 10-year averages. So that is also giving us a lot of confidence from a valuation perspective. And even from a ownership perspective, if you look at some point of time, mutual funds used to own almost 15 to 16% of the holding but currently it's around 5 to 6%. So clearly there is extreme under ownership from institutional clients, and that's where our thought is some kind of re-rating will start happening. What we like, obviously Coforge would be our top pick in the entire IT space, and in the large cap, I think HCL Tech and Infosys, these two looks quite promising at current juncture.
Ashish, tech rotation in absence of any meaningful improvement in earnings can only get you so far, and we've already seen a 15-18% recovery from the recent lows. So how much further can IT stocks run from here on?
So see, first of all, if you look at the FCF yield, has become very attractive. Second, if you look at, for example, we are very positive on basically Coforge. So if you look at the numbers, it is quite promising, and from the guidance perspective, also they have surprised. So if these kind of surprises starts to come from IT, the short covering can be very, very sharp in nature, and this is also got reflected in the last 1 month data, because it is more to do with how the global positioning at this point of time. So if you look at the AI value chain index, it is down good 30%. You look at what is happening to Kospi, it is down good 30-35% from the peak, and clearly this gets reflected into the kind of short covering which is taking place in IT. So definitely we don't call it as a structural trend, but definitely from a 6 to 9 month perspective, there can be very, very strong short covering which can lead to re-rating in the entire IT space.
You know what happens, but you would agree that maybe there are people, Ashish, I've known, people are making fundamental cases, but what I've heard mostly is all so far positioning, tactical, too cheap, right? And maybe little to lose, maybe those kind of arguments, right? But as we've seen, I'm not saying it'll happen again, but by the time it focuses your attention and you start to look at whether I should do something, it's time to, it goes the other way. It's already too late. It's not sustained, right? Maybe this is different, and this is going to be a bigger move. Already, I think we're up about 15% from the lows. That's the Nifty IT index from the absolute lows, that is. Well, we'll talk more IT for sure, because that continues to one way or the other attract all the attention. The other side of the sort of equation is the FMCG names, and HUL is the biggest loser in the Nifty. Q1 numbers came in earlier during the day, actually in the morning. Mangalam is here with the earnings fine print, what the market did not like. Stocks down almost 7%. Mangalam.
Well, HUL reported a largely in-line set of numbers, with the adjusted for demerger sales growth coming in at double digits, which was the highest that we've seen in the last 13 quarters. The company reported a volume growth of 5%, with the rest coming in on account of price hikes that the company had taken. And the EBITDA margins as well, at around a little over 23%, were pretty much in line with street expectations. It was the net profit which had a base quarter impact of a tax credit, and you adjust for that, then the net profit also grew in high single digits, if not double digits as well. And the growth was this time around led by beauty and well-being, which saw a 12% growth. The home care business saw a 14% growth, whereas we did see a 7% growth coming in their foods vertical as well. Personal care which was slightly below street expectations at 4% growth and low single-digit volume growth as well, where the company did call out that the category itself is shrinking or 2 years of high inflation has impacted performance out there. The management commentary has been, alluding to a lot more stability. They are saying that demand conditions are stable. Even though raw material inflation is fairly volatile right now, the situation, they do believe that margins would be contained between that 22.5% to 23.5% band itself. And they do expect demand conditions to stay stable, which does imply that maybe volume growth would come by going forward as well. On calibrated price hikes, they did say it could be anywhere between 2 to 5% after the 5% price hikes that the company has taken in the first quarter. So that's something we will monitor. The stock, however, lower in today's trading session, maybe perhaps on account of the fact that the street expected a little more. 6 to 7% was the volume growth that was expected. HUL reported 5%, and the anticipation of a recovery in staples at large was fairly high, which is why there was slight disappointment on an otherwise in-line set of numbers.
So firstly, we see rural demand continuing to be stable and robust in the quarter. So in the quarter that's gone by, June quarter, we see both urban and rural demand continuing to be stable in the quarter. So that's really our outlook going in. We have to keep watching, like I said, in terms of the monsoon and in terms of geopolitical impact on inflation. But given all the measures that have happened in the country, both in terms of the monetary measures, fiscal measures, the demand in the country remains consistent, remains stable. We are obsessed with volume-led revenue growth. And I think that is our core focus, and you will continue to see us ensuring that we calibrate for that. In terms of inflation, it remains a volatile environment. And we are closely monitoring, both the geopolitical situation, the monsoon conditions in the country. And we believe that in September quarter, we will see sequential inflation. This could be depending on how inflation pans out, between 2 to 5% sequentially for September quarter over June quarter. And we will take calibrated price increases as we have been taking in June quarter. The same we will do in September quarter, but really leverage all the lines of our P&L.
Okay, all right. Well, let's keep an eye out on the bottom of your screen. You have Pine Labs that's come out with this set of numbers. The profitability is move up, but I think the street is spotting something with regard to the numbers that they don't like. Revenue as well as up by close to around 20%. The other number I think that was flashing for you on the screen was Chola. I think we should get the stock up for you. Valuations, as we know, are not very, very cheap, but they've never been cheap actually. But the street had given it a very premium multiple out there. But it seems these numbers have not gone down too well with the street, at least prima facie, the first look at it. Because the stock from going up, I think, close to around 1%, it's suddenly come down close to around 3%. So we'll just try to track what exactly the street doesn't like on this particular name. Ashish, I wanted your view on some of these NBFCs, if they're not going to be rate hikes very, very soon, in the near future, then the cost of borrowing as well will remain fairly subdued. And growth is coming back. What do you like from this pack? At one point of time, the gold finances, they went up one way. Now, what's the next trend you're observing? What would you like from that space?
So within this space, we like Shriram Finance a lot, Nigel, because if you look at the kind of NIM expansion which has happened in Shriram Finance case, almost 10% kind of NIM, it is very, very positive. And if you look at with this MUFG deal, the cost of borrowing is going to come down significantly. And in the next 3 years, the kind of AUM growth the company expects is close to 18%. So, and even within this space, the gold business has also contributed significantly, and the growth was quite high. So, all in all, we believe that Shriram Finance, with a very reasonable valuation, strong growth trajectory in terms of AUM growth, NIMs have been expanding, and the credit cost under control, all put together, we believe it is very positive for Shriram Finance. So, our top pick in the entire space is Shriram Finance. Apart from that, definitely we are also looking into players like Aditya Birla Capital, where a lot of transition is happening from wholesale lending to the retail lending, and that's where I think the margins are going to see some expansion. So yes, even Aditya Birla Capital in that space looks quite promising. Okay, got it. All right. What about Ambuja Cements? We've come out with that set of numbers. The numbers are subdued, but I don't think anyone was working with a big surprise on that one. For the time being, the stock has pulled back close to 1.5%. It's as has been a big underperformer. Your view on this name? So Nigel, we have been avoiding this entire, cement space because of the kind of, volatility which is there on the raw material side. And if you look at the margins are also under pressure because of huge raw material and inflationary concerns. Even realizations for that matter were not great. And Ambuja per se has also started losing market share. So that is also putting a lot of pressure. But if you look at the numbers of Ultratech, where the capacity expansion and the margin profile is very, very stable. I think if one has to really take a bet in the entire cement space, our preferred bet would be a player like Ultratech Cement rather than Ambuja.
Got it. All right, Ashish, we appreciate you joining in. You want to go with the big boy. Everyone thought that Ultratech was going to be under threat, but the big boy came, stood tall and in fact has grown not just capacity, but even profitability still holding at around 1,200 rupees per ton. Well, it's monthly expiry, so let's do a quick check on the FNO data. Then the options data should come up for you. The writers are at play on both sides, the 24,000 call as well as the 23,950 put. And that's why, in today's trading session, the sense you get is the bulls and the bears, they just want to play out the session. And then from tomorrow, we take, the new course, whether or not in the August series, the Nifty can actually scale towards 25,000. That's what's going to be on the bulls wish list, while the bears will want to actually pull back to around the 23,500 odd. That is writing clearly that you're seeing. On both those two strikes, the premium's almost down to zilch. So just looking at the options data, looking at the high and low of the day, the support you're getting is that around 23,920. The reason I say that is because 23,950 put, the premium on an average is around 30 rupees or thereabouts. So that becomes the reference mark on the downside. On the upside, 24,070. Remember, the high of the day is close to around 24,040, and from there we saw a bit of a U-turn. And there is some writing that we're seeing at around the 24,000 call. So it explains why, in fact, we are not able to get past that range. But, this is going to be a stock-specific market, whether the markets break up or down out of this range. But a couple of stocks that we have been, highlighting the FNO segment the last few days. One is Kalyan Jewellers. Even after such a big run, the sense you get is the shorts are still stuck in this one. And that's what could give it that additional fillip. Now we're talking about a stock that's gone up close to 45%. And in the past week, it consolidated. Now it's resumed their up move. So can it get past these resistance marks is going to be important. The other stock we're looking at is Eternal. I recall on the day of the numbers, the street initially reacted negatively to those numbers, but then the fine print looked quite good. And in fact, if you look from those lows, 275 rupees was the low that we saw in terms of Eternal. Currently, it's at around 306 rupees. So telling you that the shorts are getting covered out. There's delivery-based buying as well. And from this entire space, it appears that Eternal is the pick of the pack, with that IPO that's still in the works, with a smaller player not able to eat into its market share. It appears the street is focused on this one. So that's why we're seeing a bit of a bounce. But let's get Mangalam back with us. He's here to take us through the takeaways from Avenue Supermart's analyst meet. Mangalam?
Well, DMart is trading lower as the analyst meet is currently underway. Among the key updates that we have gotten so far, no fresh change in outlook is something that the street is slightly disappointed by. We do know that the company is guided for 15% store expansion annually, which implies about 80 to 100 store additions. And at the same time, they've said that, there would be a higher proportion of stores coming in from the leased model. So those are a couple of factors that really stood out so far. But the analyst community is slightly worried about, the fact that the store expansion could have been a little more. And at the same time, the looming threat from quick commerce keeps same-store sales growth in the urban centers slightly muted. So these are a couple of factors which the street is perhaps disappointed by. But by and large, no change in policy has, the stock lower in today's trading session. No aggressive guidance, uncharacteristically or characteristically coming in from DMart this time around. And as the analyst meet is currently underway, the street's chosen to take some profits off.
Okay, all right. Thanks, Mangalam, for that. Well, Ashish, I wanted a view on some of these big movers today. Suzlon, it seems in a seasonally weak quarter, these margins actually have come in still below what the street was working with, because the margins have declined by around 220 basis points on a sequential basis, coming in at around 15.8%. One of the reasons could be higher EPC revenue as a percentage of its mix. And that's the lower margin business. So that's why now the stock is selling off. It's down close to around 8.5%. On the flip side, the bright spot actually has come in from TTK Prestige, because those numbers look good. Stock up 10% after rallying 30% in the last 2 months. Ashish, any view of this big winner or this big loser?
I think Suzlon definitely, what we have been observing in this entire wind space is that this contribution from the EPC business is definitely going to be is going to reduce the margins, and that's where markets have been, avoiding this space. Not just for today. If you look at, Nigel, for the last 6 months, the stock has clearly underperformed, and we avoid this name at this juncture also. But from the consumption space, I would like to comment upon Eternal for that matter, where we believe that the TAM is improving a lot. Competitive intensity is intensifying, and that's where players like Zepto or Swiggy, for that matter, is going to see a lot of challenges. And there we believe Eternal's market share is going to improve a lot, and that's where our top pick in the entire consumption space would be players like Eternal and and Shadowfax also to play a proxy to this entire quick commerce and e-commerce play. So Eternal and Shadowfax, these are the two stocks within the consumption theme which we like the most at current levels.
Thank you, Ashish, for that. We were chatting with Rahul Arora on the quick commerce space, and he said that if the Zepto IPO fails, if they don't come to a conclusion on the valuation, then perhaps Swiggy could straight away rally to 320, 350. But over the longer term, I think the stock that he likes is Eternal. So he said if you have to play the space, then Eternal is his bet. And both the names are actually doing well as Zepto IPO remains in a bit of a limbo. We will get into a break. On the other side, we'll return with our alpha manager for the day, Sanjay Doshi and Pritesh Krishnan of Abacus Asset Management.
Welcome back. I think the market is absolutely flat. 10-point change, 23,985 is where we are at. Well, interesting next chat. Sanjay Doshi is head of investment and research, and Pratish Krishnan is senior fund manager, equity, both, of course, with Abacus Asset Management. Gentlemen, great to have both of you here. Thank you very much for joining us. So Abacus Mutual Fund, of course, is building out with new schemes, new offerings. I think, their fourth scheme is open, third equity-oriented scheme, but fourth scheme overall. They've got a liquid fund as well. This one, of course, I think is in the towards the end of, I think it closes soon. And this is a large and mid-cap fund, gentlemen. So, I just wanted to ask you, you guys have a small-cap fund, a flexi fund as well. This basically mandates you to put in, I think, 30-40% in large caps as such, right? So what's and this is a category which has done poorly over the last few years. Is that the logic here? I mean, to get exposure to large caps in a mandatory kind of way? Sanjay, let's start there.
Yeah, thanks, Prashant. Thanks for having us on your show. I will request Pratish to take it because he will directly manage the scheme. So let him give a brief about the large and mid-cap fund that we have ongoing now.
Sure. No, we know about the fund. I just wanted to get Pratish, come in. You want to, just the logic, right? Because it's a category which is not done well. Maybe that's the opportunity. Is that it?
Yeah, sure. So if you look at the entire large cap space broadly, and especially if you look at the last 2 years, we've seen that, the broader indices have been broadly flattish with the last 2 years. And specifically in the Nifty 100, we are seeing a lot of stocks, at least there are more than 50% stocks which are compounding earnings by more than 10-15% plus, right? So in a large cap space, I think our ask rate from these companies would be if you can identify 15-20 names broadly, which can compound earnings for the next 2-3 years by more than 14-15% plus, and valuations are fairly reasonable. This is also a space which got impacted by the huge FI outflow. I think broadly it seems like probably the worst maybe from the FI outflow is probably behind. So it should kind of benefit from earnings compounding and also some valuation, benefit which is there for the space itself.
Got that. What's the view, guys, that you guys have right now as far as the market is concerned? Is it constructive? Is it tilted more towards large caps, mid and small caps? Sanjay, you want to come in there?
No. Yeah, we remain fairly constructive on the India story. And I think it is very clearly reflected, despite the West Asia crisis, the challenges that we saw on crude, which is very critical for us, and the large dependence that we had from the corridor or the West Asia space that we used to get our crude. I think that's the basic thought process that India remains a very strong 7% real GDP economy, real GDP growth, and the nominal growth could be in the range of 10 to 11%. And we have seen the mid and small cap give you an opportunity to do much better, maybe in the range of 13 to 18% kind of growth potential. And I think that's where we believe there is a potential from the next 3 to 4 years. A lot of reforms have been undertaken by the government. We have seen how we could navigate the challenges on crude. And also, I think the tech trade, which was sucking in a lot of capital, is probably now taken a re-evaluation, and that provides a great opportunity for a more diversified market, more structural market like India. And I think that's what we remain fairly confident on.
Sunil was on last time and he said that, he said, I'm sticking my neck out and saying that by the end of 2026, foreign flows will be positive. I mean, I think as right after that, foreigners started putting money in, and then you had another flare-up with this US, Iran, and oil went all haywire. But we are cooling off once again. So hopefully, I mean, I think... and as you said, there is this tech meltdown which is happening. So that allows the opportunity for some of these global investors to look elsewhere. But just themes, Sanjay, if you want to take us through it, bottom-up themes, because it's been very thematic as a market, right? Not now, but for the last 4 or 5 years. Be it transmission, distribution, electrification, some data centers, power, lots of these new age. It's been very thematic. Stocks have done well, but usually there has been the sector tailwind behind it. So defense is another, manufacturing broadly. So just thematically, what are you most bullish on, Sanjay?
Sure. There are macro themes which play around in markets from a global level and also from a domestic level. When you see the government efforts in a particular direction, So we are fairly optimistic as a house on a long-term potential of premium consumption. If you look at financialization of savings, that's another big opportunity. Manufacturing footprint in India still remains fairly nascent. Probably the intensity in economy is around 14-15%. And there the opportunity is to take it towards 23 to 25%. We can also play a very dominant role in terms of a reliable supply chain on a global level in certain areas where we have created our niche. Right from auto components to chemicals to pharmaceuticals. And I think that's a lot of these areas which will come in. As you highlighted, the new age opportunities also, a lot of efforts have been done through PLI and through capital subsidies, especially on the semicon side. And once we have these manufacturing footprint in India, you will have a huge opportunity in the value chain across the space. So these are the 3-4 areas that we are fairly constructive as a house. And I think that's probably going to continue for quite some time.
Pratish, you want to add anything to it, to the list?
So definitely, I think the financial space that Sanjay referred to clearly is a fairly large one. And this is both across the banks, the NBC financials, but also the entire spectrum of wealth management, the capital market names, right? I mean, which are far more structural. See, the broader consumption story remains, right? If our GDP kind of expands over the next 3 to 4 years, per capita income is growing. We are clearly seeing a different consumption pattern kind of playing through, and that is something which we are fairly excited about. So those kind of sectors or sub-segments in the market will clearly play out over the next couple of years.
Yesterday there was that reply in Parliament, right? Finance Ministry data which showed the number of, the 100 crore income club. And that number has gone up about 4 times in the last 4 years. So that's, financial services and financial services offerings. So is that, Sanjay, wealth etc. is where you're most bullish on? I mean, I know AMC it's a basket of companies, but within that, what's the best way to get exposure?
Yeah, true. Asset management companies, wealth managers, as well as market intermediaries and exchanges, all of these provide you a good opportunity to look at it. Obviously, we'll be mindful a bit about valuations and where we find comfort. But this remains a very structural story for us. And if you think at it from an Indian economy perspective, if we are going to go towards our $8 to $9 trillion economy, I think this is a huge space which is going to come up.
Got that. I just want to ask you, Sanjay, broadly speaking, right? I mean, what is done well is done phenomenally well. What is not done well, it's middling. So you want to be with, it's not a one-size-fit-all answer, but you want to be at one end of that spectrum, which is done very, very well. I mean, it's not in between. It's routinely there are stocks which are up 100% this year. And at all-time highs. On the other end, you've got lots of names beaten down, struggling, middling, not doing well. Just as an approach, where are you? If you have the winners, maybe you ride them and you stay on. But as for new money which is coming in, where are you looking at allocating them? Slightly reasonable, low valuation companies, or some of the big winners which have already provided excellent returns.
We are, fortunate to have a very clear investment framework. We call it the NEET framework. And there we try to analyze through various qualitative and quantitative factors, various aspects of management, earnings quality, the structural trend, the timing, and the valuations of various sectors and stocks. And I think that guides us very well. So as you rightly said, we would definitely look to ride some of the major themes and the momentum which is there in some of these areas. But at the same time, we are very focused about the value that we pay upfront, because I think from a long-term compounding, if you get things at the wrong price, it is not going to serve you much. Coming to the areas that you mentioned that have not done well in the near term, it could be of interest provided we see a reasonable certainty of growth coming back, because otherwise we have seen that some of these areas becomes value traps. So it is very important to have a proper understanding of what are the drivers and is there a possibility of growth to pick up. It could be any reasons in terms of competitive intensity or certain macro setback for that space in the near term. But if we are confident about growth coming back, I think that's what interests us.
Got it. Yeah, no, absolutely. Low prices, your best friend, but you also want to be sure that there is something happening there. Otherwise, it becomes dead money in that sense. Thank you very much, Sanjay and Pratish, for joining us. Good speaking with both of you. Thank you for being here on CNBC TV 18. Appreciate it. Okay, that's the Abacus Mutual Fund team with some perspective. Lots and lots of numbers are coming through thick and fast. So let's just get a quick earnings roundup. Upasana is here with exactly that. Upasana, take it away.
Well, first up, let me start with TTK Prestige. Strong set of numbers reported by the company. The revenue growth stood at 34%, which was mainly led by the strong domestic demand, which saw sales of over 36%. But the export business, there is a revenue decline of nearly about 18% owing to the disruption. Now, induction cooktop theme continues to remain in focus. That also drove sales in Q1 as well. Now, growth was mainly driven by categories such as induction cooktop, electrical appliances, induction pressure cookers and cookware products. Now, if I look at the sales growth across the categories, cookware stood at 29% growth. Cookers stood at 29%, cookware stood at 41%, and appliances also stood at 40% on year-on-year basis. If I talk about the margins, they have also seen a sharp uptick from 6.6% to 10%, and PAT has also increased by 1.2 times. This is because of the various cost control measures taken by the company, such as employee expenses and other expenses as a percentage of sales have also come down, leading to the PAT growth overall. Now, moving on to Varun Beverages, it was a miss in terms of the India business volume growth, which stood at just about 14.4%, weak as compared to what the street was estimating, which was more than 20%. Revenue, PAT largely in line with the poll, but margins have taken a dip much lower than what the poll had indicated. Revenue has seen an uptick of 21%. Revenue growth was mainly led by companies' improved realization and 19.8% volume growth reported by the company. Now, coming to PAT, it saw a growth of nearly about 15.5% and margins stood at 27.1% versus 28.2% as compared to our poll.
All right, thanks a lot for that, Upasana. I think, everyone will be happy actually today, those that are in the bar or in the kitchen, because if you look at TTK Prestige, the stock is up close to 40% in a matter of close to around 1.5 months. On June 5th, we are at CNBC TV on Editors Roundtable, had presented this piece about, kitchen appliances. Probably the kitchen is getting heated up. If you look at it, from there on, the stock has seen a big rally. And the bar as well is serving good amount of alcohol today. You just take a look at Radico Khaitan. They've gone ahead, they've revised their margin guidance to around 20% from around 18.5% earlier. So that one, has taken that very positively. Put up the intraday chart actually. And on the P&A volume growth, they're talking about 25% odd. So initially the street didn't react too much to the numbers. And once they've revised the guidance upwards, the street likes it both on margin and Prestige and above volume growth at around 25%. Cheers to that particular name. Well, we'll slip into a short break. On the other side, we'll get you the buy and sell trades from our technical experts. Stay tuned.
Okay, welcome back. City Union Bank is in focus after it reported a good set of first quarter earnings. And Anya is back with us to do all the number crunching. And Anya, take it away.
Well, yes, City Union Bank is in focus after a strong set of numbers. They delivered net interest income growing 31% year-on-year, while operating profit rose nearly 29% and profit increased 25%. Here you can see the core profitability remains really strong. And if you see sequentially also, it is decent YOY trend, Q-on-Q trend you can see. Asset quality remained a key positive with gross and net NPAs declining, while return on assets improved and capital adequacy also remained comfortable here. Now also Cholamandalam also reported their numbers. The company reported a robust growth. If you see, with NII rising nearly 27%, operating profit up 30% and PAT growing about 46%. So growth all in all looks good. The loan book also expanded over 20% here, led by vehicle finance, now a loan against property and home loans also. While stage 3 assets, if you see, it increased sequentially due to the seasonal pressure, capital and liquidity also remain strong here. Now the main thing is the board of Cholamandalam, they approved raising up to 55,000 crore through the issuance of secured or unsecured NCDs. So all in all, good numbers for both the companies.
Thank you very much for that. Mitesh Thakkar is back with us now for a few BTST calls. It's been such a quiet market, at least on the headline front. The Nifty Bank, though, is under pressure. The 200-day moving average on the Nifty Bank was about 800 points higher than where the stock currently is. And it seems, the index currently is. And that's where it seems to be facing some amount of resistance. Mitesh, what would you go with? Any short-term trades?
Clearly, there's kind of strong price volume breakout in turn. So that's the BTS established at 304.75 for a target of 313.315 for tomorrow. And Jubilant Foods is another one that's also picking up after going through a long correction period. Jubilant Food is a BTS with the stop at 428 for a target of around 438. So.
All right, got that. Thanks a lot for that, Mitesh. By the way, before we go to Vivek for L&T preview, just keep an eye out on Pine Labs. The stock initially did see a bit of a knee-jerk reaction, but now it's recovered from the day's low. The reason is the commentary that we're seeing, because they're saying that the transaction volumes compound and investments mature. They expect higher margins in the coming quarters, as well as for the full FY27. That will lead to better EBITDA margins. So after seeing a bit of a knee-jerk reaction, there's a bit of a positive commentary that's come about, which has led the stock up yet again from the lows of around 145. That one has spiked up to the high point of the day. But the big daddy this evening is going to be L&T. They report their numbers. Vivek's going to have a busy evening for the time being. He's going to tell us what to expect. Vivek.
Well, looking at L&T this particular quarter, remember, it's been marred by the West Asia crisis. The company has significant exposure over there. So any commentary over there, what is the kind of impact that the execution saw, whether any damages have been done. And that'll be something that the street will clearly have an eye out for. And going forward, whether there is any opportunity in terms of reconstruction projects that are coming up. So most times, especially when L&T comes ahead and gives the conference call later today, that'll be what investors will be asking. In terms of the numbers themselves, expected to be a slightly subdued quarter. Revenue seen higher by close to 4.5% on a year-on-year basis. EBITDA seen higher by just around 1.5%. EBITDA margins on a year-on-year basis are seen lower, 30 basis points lower is what EBITDA margins are seen, and profitability is seen lower on a year-on-year basis. Now, especially when you're looking at the core EPC business this particular quarter, expect domestic EPC execution to be quite subdued. Along with that, the disruption in the overseas business. Domestic water projects, the company has been calling out worries on that particular front for quite some time. So, all eyes will be on that. And one thing that the street will keep an eye out for will be Lakshya 2.0. What is it the management is saying, especially in terms of ROE targets, when the Lakshya 1.0 was done, something that led to a bit of a re-rating. Lakshya 2.0, what exactly is the management saying? And of course, there is now a new CFO on board as well. So that'll be something that the street will look forward to hearing from.
So Lakshya 2.0, that's the next 5-year plan, was already announced by the company, right? A few months back?
That's right. So at the end of Q4, that was done, when you're talking about the top line growth from FY26 to FY31, a 12 to 15% top line growth is what they're talking about, and this compares to a 10 to 12% growth that they're envisaging for FY27. core margins at 8.3%, that's something that they've not really said. But the street will be hoping that that particular number, especially when it comes about, when they speak about Lakshya 2.0 in further detail today, whether that particular number can inch higher after the disruption that they're seeing due to the West Asia crisis. Order inflow growth, for the next 5 years on what is essentially a very high base. They're expecting, year-on-year growth of 10 to 12%. Whether that can continue, that's also been something. And again, in terms of domestic ordering, so far they've stayed away from the Indian thermal power business. Last year they did make a bit of a comeback when it came to the BTG part of the business. Whether they put out any commentary on that, whether they are interested in more as far as domestic ordering is concerned, is something that the street will watch out for.
Thank you very much for that. The L&T Group has set these 5-year targets for all their businesses. So even on the IT front for LTM and LTT, and they're called the Lakshya plans. They'd already set it for the last 5 years. So now Lakshya 2.0 is in effect. It started in FY27 for the next 5 years. But tomorrow is going to be another heavy day in terms of earnings. We've got 4 Nifty companies reporting numbers. There's Eicher Motors, Asian Paints, Adani Ports and Adani Enterprises. But let's talk about Eicher Motors and the expectations. Sudarshan joins in.
So like all the other auto companies, Eicher Motors too has seen an expansion as far as the volume is concerned, but the focus would be on the margin if company like TVS Motor and Bajaj Auto sees an expansion margin, because the expectation is that company might report an unchanged margin of less than 24%. And talking about the headline numbers, profit might increase by 15%, revenue double-digit growth may continue, can see an increase of 27%, and EBITDA too can see a jump of almost 27 to 28%, and margin can come in at 23.9%, and that would be unchanged YOY. Volumes, if we talk about, it was up both on a YOY basis as well as sequentially. On YOY up 24%, sequentially up almost 4%. Now in the commentary, what exactly would be watching out for? First, the demand for 350cc plus segment, because in Q1 it has come down. The contribution to the total volume has come down to less than 11%. So what's the strategy on that front? Because if that improves, then it will also aid margin. And also company had announced the capacity expansion plan. So what exactly company comments on that front, and what would be the demand outlook on both domestic as well as exports? Because on the export front, company has been seeing a decline, but as far as overall numbers are concerned, expected to report a strong set of numbers.
Okay, all right. Thanks a lot for that, Sudarshan. The Royal Enfield, we'll keep an eye out on that one. By the way, a few stocks in the broader markets actually have spiked up. You pull up HFCL. That stock was sitting, I think, with a 5% downtick. That's got released, so I think we should just get that one up for you in the screen. Aeroflex, that's the other stock that actually was up. We had the management a couple of hours ago. That stock has now moved to the high point of the day, so good move out there. Lodha Developers has made a strong move, 9% up on that one. And Tilak Nagar, earlier today, the stock was down 4.5%. Got positive commentary coming in from Radhiko Khaitan. I don't know what the street is reading into this one, but that one as well has cut its losses. Maybe they're viewing the 2029 target of an EBITDA number of around 1,000 crores, which now then makes the valuations look pretty okay or rather cheap. So that's why the stock has spiked up. But it's that part of the show where we get in Jay Bala. Hi, Jay. Good afternoon. Good to see you in. That I think you were talking about, what, 29,000, right, by the end of this calendar year?
That's right, Nigel.
What about August? 25,000 is possible?
Yeah, see, the recent low of 2606 that's registered a couple of days ago, that has the potential for the markets to fire it up. If I get too fine, maybe there's an intraday low that's coming below 2606, but the recent low of 20, that itself is good enough for me. But if it were to break it on an intraday basis, that'll be good. But I want to see the markets close above 24,530. Then that will confirm that 26,000 is coming by August, and probably we are looking at 29,000 by Diwali or earlier.
Sorry, on IT, so yeah, Nifty is 24,530. But on IT, sorry, what was the view? Because last time you were saying that maybe there's one test and then, right? That was the view. But, that one touch, I don't think happened, right?
That's right, Prashant. And I would have preferred the markets to have broken below the July 1st low on an intraday basis at least. That would have given the market a more clear structure. Right now, I'm a bit skeptical about what the IT index is doing. I need to force myself into a very curve-fitted path for the IT structure if I were to take the July 1st low as the final low. So I'll be a bit cautious on the Nifty IT large caps name like Infosys and TCS. There also there's ambivalence here. Infosys is signaling maybe there's one more low coming, but TCS is probably signaling that it's bottomed out and it's moving up. But so I'll be a bit cautious on the frontline name. I would rather play the IT through mid caps and large caps, like mid caps like Tata Technologies, small caps like Newgen, Saxsoft, or those kind of names. But yeah, I'll be still maintain my cautiousness on large cap IT. I would rather get in a little later rather than now because of the ambivalence that's there in the Nifty IT structure.
Got that. Stay on. We need to slip into a very short break. News coming in from Pine Labs from the investor presentation talking about higher margins in the upcoming quarters. Get into a break. We'll come back with market closing.
Welcome back. Well, let's wind the markets down for the time being. Let's get in, Jay, for a couple of quick calls. Jay, you got some stock trades for us, individual trades?
I actually have only one today, Nigel. That's Container Corporation of India. It's looking pretty interesting on the short term as well as the medium term time frame. A stop loss of 470, probably heading to 665 at least, and it has potential to scale past the 950 mark in the medium term. So that'll be a fresh all-time high for it. Once the stock crosses about 535, it will trigger an inverse head and shoulders pattern. But even otherwise, there is other bullish setups that's already there in place. So this should quickly cross 535 and trigger that move and accelerate the path forward. And there is, I'm watching two other stocks to complete the price structure. One is Tata Chemicals, and there seems to be some action in chemicals and plastics names. Last week we had picked Nilkamal Plastics. That's today at already about 25-30% up. Today it's up about 11%. So you might want to look at that too as an additional adding candidate. But Tata Chemicals and Clean Science Technologies, they need to make further lows from today's low. Once that's done and it makes a one-day reversal bar, we can look at them positively.
Quick word, HUL, stock has seen a big fall. There's a conference call at 4 p.m. today.
Yeah, I've always, since 2024, awarded FMCG names, and I've been skeptical about it. And you need to be very selective about your picks within the FMCG space. And HUL probably has downside potential somewhere close to 1900 to complete the medium-term correction that started from its all-time high in 2024 September or July, whatever be the high. But so a little more downside left. Once that's done, I think the whole FMCG sector has the potential to at least rally as a sizable short covering rally.
Okay, we'll leave the conversation here for now. We'll chat with you on markets forward. Flat close for the markets. The Nifty just shy of 24,000. So after yesterday's big day of gains, where we rallied more than 200 points, today less than 200 points, markets consolidated and moved sideways. It was IT on the way up with a 3.5% rally, with gains led by a TCS, Tech Mahindra, Infosys and Coforge in the mid-cap space. That was on the way up, offset by losses in HUL. The biggest loser today, stock hit a fresh 52-week low, dipping to levels of 2,000. And then large banks like an ICICI Bank, SBI also weak in trade. Reliance Industries also sold off. The mid-cap index was up 0.2%, but the story was in individual names where you had big moves. Suzlon Energy was down 10%, Varun Beverages sold off, Capri Global, Equitas Small Finance Bank, BEL, Coal India, not mid-caps, large caps, but these are the stocks which stood out. Lodha Developers, City Union Bank on the way up. Along with that, a TTK Prestige had a good session. We're going to take your leave on closing bell. Thank you very much for watching. The markets end flat after a range-bound trading session, with earnings remaining the key driver. While the Nifty held above the 23,900 levels, we are seeing mid-caps that continue to see that outperformance.
The Nifty IT index has rebounded nearly 19% from its 52-week low and it's on track for its best month since July 2020. Coforge's bullish outlook added to the optimism. The management has guided for FY27 to be an exceptional year.
HUL shares slip after Q1. Volume growth of 5% misses the estimates. Revenue as well as EBITDA are in line, while a high base due to last year's tax credit weighs on the net profit. Varun Beverages also misses the street estimates, with Indian volume growth at around 14.4%, falling short of expectations. Hello and welcome to Markets Forward on CNBC TV 18. I'm Vinny Motiwala. With me is my colleague Mangalam Malu, and this is your go-to show where we highlight all the key data points to gear up for the next trading session. I'm Mangalam, and it was the monthly expiry, the weekly expiry. That expiry kept the volatility in the markets today. We did close slightly below the 24,000 levels.
Yes, we did close slightly below the 24,000 level. In fact, it was a fairly range-bound session. The high and the low on the Nifty was between 100 odd points as well. But that's just the frontline index. Most of the action happened beneath the surface, and what kind of moves that we saw on account of earnings, not only ones that came today, but also some reactions that happened from yesterday as well. So, start with the Nifty itself. You had HUL reporting its numbers. The stock ended about 7% lower, and we saw a big gash out there. But on the way up, IT did well. So basically, FMCG took away whatever IT tried to, put on for the bulls. And then we didn't have much support coming in from the banking index as well. Speaking about individual stocks, look at Godfrey Phillips, down 8% after reporting a poor set of numbers. It was a slight miss on Varun Beverages. That stock ended about 7% lower. And then you had Suzlon as well, which fell by about 7-8%. But on the gainers side, we did have Coforge did well. We'll speak about that. Lodha Developers and Kalyan Jewellers, all of them were the big gainers. So we did see a lot of stocks move around today. It was a lot more stock specific than just index, which, as you pointed out, was range bound because of expiry.
Absolutely, Mangalam, but that's a roundup in terms of the markets. But what's lined up for you all on the show today? Let's talk about that. What we have in store. We'll start up with the movers and shakers for the day with Sudarshan, and then move on and we'll decode the latest earnings from FMCG majors, as well as also take a look at Indian IT space, the rally that we saw coming in. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. First up, let's kickstart with Sudarshan, who's at the big wall to take us through the top movers and shakers of the day. Sudarshan, over to you.
Not so bad day for market. Nifty though closed below 24,000, but at the end, despite some of the major bank heavyweights reporting earnings and those earnings looked below expectations, at the end it was a flat close for Nifty, and good parties, broader markets have outperformed. So top Nifty loser, HUL. The reason? Volume growth. Company has reported volume growth of 5%. The expectation of CNBC TV 18 was 6 to 7%, and that was the main reason why you are seeing a 7% downtick coming on that counter. BEL too has seen a fall of more than 4% despite reporting an inline set of earnings. What is weighed on the stock here is the outlook, and Coal India too has seen a fall of almost 4% after reporting Q1 earnings. Eternal, on the other hand, for the second straight days amongst top Nifty gainers, up more than 4%, and its peer Swiggy too saw a big move as today as well. TCS, like all the other IT names, continues to see a big move, and today also TCS is among top Nifty gainers, up more than 4%. Some of the stocks that have reacted majorly to the earnings, on top of the list is Coforge. Company believes that FY27 is going to be an exceptional year, and stock reacted exceptionally too. At the end, the stock was up almost 10%. Radico Khaitan, when the company reported the earnings of Q1, had gone down, but then the outlook comes. Company has upgraded the outlook not only for volume but also for the margin, and from there stock has recovered almost 5% from day's low, and at the end was up more than 3%. And Suzlon Energy, it was a weak set of earnings for Q1 FY27, stock down 10%. Godfrey Phillips, too weak set of earnings, down 8%. And Varun Beverages India volume reporting number 14.4%. Our expectation was more than 20%. That's the reason red downtick was there. Kalyan Jewellers, yesterday it was down, today it saw a big move again amongst top mid-cap gainers, up more than 7%. Lodha continues to see a big move because of the data center play, and the stock has been seeing. And today also this stock is up more than 9%. Avenue Supermart held the analyst call, and some of the commentary that company has made weighed on the stock, and at the end down more than 4%. Lastly, Pine Labs too has upgraded the outlook both on revenue as well as margin. That's the reason up 4%.
Take that point, Sudarshan. Like you pointed out, it was all about the earnings, a bunch of stocks moving around on the back of earnings, and none bigger than HUL, which declined over 6%, close to 7% after the company's volume growth estimates actually missed the street expectations out there itself. The stock ended at 2,022 rupees a piece, down 7% today. If you look at the overall numbers, the reported numbers were largely in line with street expectations, if not better. Year on year, the revenues actually grew by about 10%. The street expectations were that of close to around 17,340 crores. You had the EBITDA margins, which were flat year on year, again 22.8% compares with 23%. The EBITDA itself was up by 8.5%. The reported decline in the net profit was largely on account of a tax credit in the base quarter. You adjust for that, and then there's a big growth that has come by in the profitability as well. Even if you look at the segments, you have the home care business, which grew 14%. The street expectations were 16 to 18%. You had personal care, which grew by about 2% here as well. The expectations were 4 to 6%, so that was a bit of a miss. But beauty and well-being was fairly strong at 12%, and we did see some traction come by in the food business as well, with Horlicks and Boost actually doing extremely well. The management commentary, they expect demand conditions to remain stable. They maintain their margin guidance between 22.5 to 23.5%, and they say that volume growth is their number one priority, with FY27 actually being better than FY26. The stock sold off because, one, the street expectations were fairly high, and secondly, there was a mild miss on the volumes. Let's hear out what Priya Nair had to say.
In terms of inflation, it remains a volatile environment. And we are closely monitoring, both the geopolitical situation, the monsoon conditions in the country. And we believe that in September quarter, we will see sequential inflation. This could be depending on how inflation pans out, between 2 to 5% sequentially for September quarter over June quarter. And we will take calibrated price increases as we have been taking in June quarter. The same we will do in September quarter, but really leverage all the lines of our P&L.
That's the word coming in from the HUL's management there. But today was a busy day for Mangalam, from HUL to now Varun Beverages. Mangalam, how were the numbers for this one? The stock clearly saw that pressure coming in after they reported their numbers. So what didn't work out for them this time?
Well, overall, the numbers were slightly softer than street expectations. This was expected to be a good quarter for the company, largely because of two factors. One, there was a lower base. Same time last year, we had unseasonal rains. And this time, because of delay in rains, it was a longish summer as well. So the street was going in with good expectations. The company reported, numbers which were fairly strong on an absolute basis, 20% revenue growth, 17% EBITDA growth, 15% net profit growth as well. But they fell short of street expectations. Net profit at 1570 crores, the street was expecting a number of 1570 crores. The company reported 50 crores shy of that. If you look at the EBITDA as well, 2343 crores, the expectations were that of 2400 crores, and the revenue at 8451 crores. The street was working with a number closer to 8600 crores. Then add to all of this the domestic volumes, which were expected to expand by 20%. They actually grew by about 14.5% itself. And this, on a low base and extended summer, was expected to be higher. And we saw the realization per case as well. A consolidated basis, obviously, because of international business, it did improve by 1.2%, but standalone was down by 0.6%, and that explained why the stock was lower in today's trading session. So we saw a sell-off across the FMCG names where the numbers were shy of street expectations, or maybe in case of something like an Avenue Supermarts, where the management commentary in the analyst meet fell short of street's expectations. But on the contra side, the numbers that have come by, which did well so far, either the updates or the reported numbers, those stocks actually saw a big move. Say, case in point, something like a Nestle, which ended higher in an otherwise weak day for FMCG companies, or Marico, which actually hit a fresh record high, because these companies reported a good performance and a good update at a time when the others have not done well. So basically today was a day where the men were separated from the boys. See, Nestle did well. We had Marico, which did well as well. But HUL, Varun Beverages, DMart, all of them fell.
Absolutely. Mangalam, very well put there. But let's take this conversation forward now with our guest for today. We have Jayabala from Cash the Chaos, as well as Gurmeet Chadha from Complete Circle joining us. Thank you so much for joining us, gentlemen, on the show.
Gurmeet, what's your view coming in on the FMCG pack, right? Mangalam rightly put it in as many words as he could, separating the men from the boys. What's your word for HUL, Varun Beverages? What are you looking at?
No, agree with Mangalam. I think market is rewarding performance and punishing underperformance. I think HUL volume has been an issue. Look at last 3-4 years, nothing much has moved. I think not confined to this quarter alone. And you know what has also happened, especially in the BPC segment, there are a lot of foreign and local brands which are taking market share and doing pretty well. Look at Estee Lauder, for example, and along with Forest Essentials, doing not in the listed space, of course, but going at 8-9%. And actually is even struggling to get into the early 4-5%. What has happened is that food business in particular, companies like Nestle, Tata Consumer, Marico's food division, that's where the growth has come in. So I think the street likes volume growth. It wants to see better realizations, and that's what is happening. I would tend to stay away. I know there's a bit of a value trap here. The stock has been cheap now for a while, but the growth has to come back. Same. It's same like IT services. I mean, if the growth is 1 or 2%, you may will get one or some tactical bounce here and there, but eventually, I think the growth has to come back.
Growth has to come back. Indeed, spoke about the IT pack. Gurmeet, let's focus on the IT pack itself. After months of underperformance, the IT index has rallied about 19% from its 52-week low. The big catalyst coming in from the US, where big tech earnings this week could set the tone for AI spending. Rima joins in with what she's watching. Rima.
Let's talk about IT. Clearly the sector leader, the star today. The Nifty IT index is now 18.5% up from the 1st of July low. That was a 52-week low. And this month, TCS is up 18%, Infosys up to 11%. And Infosys was, remember, a stock which got pummeled after its numbers. The street was disappointed with its guidance, and yet the stock is up double-digit. HCL Tech is clearly the standout performer, 23% rally so far this month. On the side, if you zoom out and see, globally, the tech trade has come under pressure. So the Kospi was down 11% today. And the Japanese markets, Taiwanese markets also down 4-5% today. And the Korean market has fallen 35% from the June high. That was a record high. It was a level above 9,000. And today, Kospi is closer to 6,000. The Taiwanese markets also off 15% from the recent high of 48,000 plus. It also helps when companies like Coforge, which investors have bet on, to play the IT services game, come out with very strong numbers. So the CEO is confident about Q1. He says Q2, Q3, Q4 is going to be a robust quarter. This leads the company to have an exceptional year. Q2 deal wins will be higher than anything that they've signed ever before. They hope to get closer to $1 billion, but not putting a timeline in terms of $1 billion in terms of overall deal signings. And there's also a possibility that the company does better than the margin guidance of 15.5% that they had shared earlier. That said, the global tech trade remains under the watch point, because tomorrow Microsoft Meta report numbers, Amazon is on Thursday. And the big question is, will the AI capex spend guidance be upped? Already the numbers are very large. These three together would be in excess, closer to about $550-600 billion. Alphabet last week raised the guidance, turned free cash flow negative for the first time, and the stock got hit. So this week, we will know what happens with the AI capex trade. So that's going to keep the IT stocks and the global chip names and the AI names extremely volatile. But that's the update that's happening. In fact, let's talk a little bit about Coforge, because we had a chat with the CEO, Sudhir Singh, earlier, and this is what he had to say about growth and demand.
I think what you should expect is very robust growth from Coforge in what is a demand environment that is under stress and in flux. What I emphasized was that Q1 has been an exceptional quarter, and that exceptional quarter sets us up for an exceptional growth year. In quarter 2, 1 month of which is gone, we expect that robust growth to continue, and of course, hopefully not just continue, but accelerate quarter 3, quarter 4 onwards.
All right, let's go across to Jay Bala. Then, Jay, two-part question. One on the FMCG pack, the other on the IT pack. IT has bounced 19% from the lows at an index level. A lot of individual stocks doing a lot better. And FMCG has been slightly mixed, but some stocks seem like they're in a structural downturn, HUL being one of them.
Yeah, Mangal, I've been avoiding the whole FMCG space since September 2024 top. And I've been, saying select stocks like Nestle are outliers rather than the main trend. And HUL still got residual downside to complete around the 1900 mark. And then once that's done, we can look at the whole ITC, the ITC, HUL, and the frontline FMCG names to start putting in a reversal, at least a sizable, short covering rally. So when it comes to IT space, I've been looking for a bullish reversal to come through, and I wanted last time the Infosys results to push the Nifty IT index below the July 1st low. That hasn't happened, but because of this is added a layer of ambiguity to the bullish reversal structure that I was anticipating for the Nifty IT. I would have preferred the Nifty IT index to go down below the July 1st low one last time. That would have given a much more stable structure to the Nifty IT index. So what I would do at this juncture, TVS looks bullish, Infosys doesn't. So those are the large cap Nifty within the Nifty IT. So I would rather play IT through mid cap IT like Tata Technologies or News and Software, or small caps like Saxoft and things like that. And I would still avoid the large cap IT for now. And I would rather get in a bit later. That way it protects the risks and protects the downside. And if there is a play to be made on the Nifty IT, I would rather do it through the mid-cap IT and small-cap IT.
Okay, rather play it through the mid and small cap than the large cap names. That's a word coming there from Jay. But let's take a look at some other earnings that were reported through the day as well. We have Ria to take us through that list.
Well, yes, let's start off with TTK Prestige first. They reported strong revenue growth of nearly 34% compared to the previous year, led by domestic sales, which grew by 36%, but the exports, on the other hand, declined by nearly 18% compared to the previous year. Now, overall, the growth was driven by sustained demand for induction cooktops, electrical appliances, induction pressure cookers, as well as cookware products. And in fact, the EBITDA margin of the company also expanded to nearly 10% versus about 6.5% compared to the previous year. Net profit also increased by nearly 1.2 times to 59 crores for the quarter. And apart from this, Supreme Industries also reported its Q1 results this time around. It was a mixed quarter for them. The volumes for the plastic pipe segment declined by nearly 14% compared to the previous year. And the revenue growth was also quite muted at 4% growth versus estimates of a 7% growth. But on the other hand, margins saw a very strong expansion of nearly 240 basis points to 14.6%, better than what the street was estimating. And in fact, the net profit for the company also grew by nearly 39%.
Right, Ria, thanks a lot for that. Gurmeet, a bunch of numbers that came today, a lot of moves on either side. Is there anything that you liked in particular, anything that you disliked?
I think Coforge was the standout number. Even if you remove the Ancora, obviously Q and YY is not comparable, but the street was worried when they did this acquisition. I think it seems to be the integration playing out. I think that the order inflow was almost 700 million. Looks good, and it had a rub off on some of the other mid-cap IT like Persistent. So that's something we will track. We will now, with TTK Prestige, we are looking at Stovecraft, which we own in the portfolio, and how much, Philip, the stock has done pretty well. And then I think we might look at Varun Beverages, because I think the, overall the growth levers are there. They're moving into different segments, different geographies, adding capacities, including alcoholic range. So I think that's something with this correction. I think the valuation, I think the high is 550, 600, if I'm not wrong. So that is something we'll watch out for if we get even better pricing. But Mangal, one good thing is there's a lot of good companies in small mid cap reporting very good earnings. Unlike what the template was, Aeroflex, another very, very good set of numbers. We own it in our small cap portfolio. So these are the few things which start out. I think there's the two sets of the market. Revenue both market is rewarding, and the other part is where probably FIs are selling.
Absolutely. Gurmeet, made point there, but that's all the time we have right now for the show. So Gurmeet as well as Jay, thank you so much for tuning in and joining in as always. On that note, we're actually going to slip into a very short break. We'll come back after the break. We'll tell you the top corporate voices, what did they say, as well as the key events to watch out for in tomorrow's streaming session. Welcome back to Markets Forward on CNBC TV 18. Now let's take you through the top corporate voices for the day. We had Tata Power that expects power demand to grow up to 7% in FY27. Now speaking to CNBC TV 18, the management said that the talks are at an advanced stage to sign more power purchase agreements for Mahindra and other states. Capex spends is expected to be muted in the second quarter after record Capex spends in Q1 FY27.
Shares of RR will extend their gains after the company guided for margins of 10.5% in FY27. The management also added that the first quarter was marked by significant turbulence, but the company still delivered a healthy 17% volume growth.
Laggard Industries has guided for low double-digit volume growth in FY27 with revenue growth expected to come in marginally higher. Speaking to CNBC TV 18, the management said that it is targeting an EBITDA margin of up to 18% and an operating profit of around 1,000 crore by FY29.
All right, and with that, we come to a wrap on this edition of Markets Forward. But before we do that, a quick check on what the key events for tomorrow are. Riya Bhatia standing by the wall.
Well, yes, first up in the US, all eyes will be on the Fed's interest rate decision. And in the UK, we have the Bank of England consumer credit data that will be closely tracked. Back home in India, the release of the Index of Services Production, which is the ISP economic data, will be closely tracked. And apart from that, the earnings season for Q1 continues. We have the results of Adani Enterprises, Adani Ports, Eicher Motors, Asian Paints, Bajaj Housing Finance, Dabur India, Colgate, Star Health and J&K Bank all releasing their results tomorrow. And apart from that, keep an eye on the IPO of Manipal Health Enterprises, which opens tomorrow, and the Parliament monsoon session also continues tomorrow.
Okay, Ria, thank you so much for that. Those are the key events to watch out for. But with that, it's a wrap on this edition of Markets Forward on CNBC TV 18. Thank you so much for tuning in. More news and updates on the other side.
Thank you for watching.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices ease as the pause in US-Iran hostilities raises hopes of a de-escalation. President Trump calls the talks with Iran friendly but rules out prolonged negotiations. Reuters reports Oman has presented Iran with a joint mechanism to manage the Strait of Hormuz, which includes voluntary fee. Sensex and Nifty end with March losses after a range-bound session. The rupee continues to regain lost ground against the dollar. Hindustan Unilever largely meets estimates in Q1. The stock slides 7% as volume growth disappoints. Tax expenses rise. Shares of D-Mart suffer the biggest single-day fall in nearly 2 years after the management expects no major revival in same-store sales growth and flags quick commerce as a structural threat. HDFC Bank's board views the 45 crore rupee payment to Maharashtra State Road Development Corporation as a procedural lapse and not misconduct. Sources say the matter is unlikely to hinder CEO Shashidhar Jagdishan's reappointment. The board decided to impose a 1 lakh rupee penalty and issue a warning to the CEO, CFO and head of retail assets. Tata Sons chairman N. Chandrasekaran extends the timeline to revive Air India, says the transformation will take 5 to 10 years in the latest annual report. Cites supply chain disruptions, fleet renewal, legacy system overhaul, among others. Swiggy ropes in former Myntra CEO Nandita Sinha to head Instamart. She will succeed Amitesh Jha, who announced his resignation after a stint of less than 2 years. The Supreme Court moots an independent probe into excessive use of force by the police to clamp down on student protests, directs all states to release detained protesters who have no criminal record, orders no coercive action should be taken against protesters. Union Minister Jitendra Singh tables the new exam fraud bill that imposes harsher punishments on offenders. The proposed legislation also introduces a 2-month deadline to complete investigations and empowers states to establish fast-track courts for speedy prosecution. IT Ministry summons Meta officials after Prime Minister Modi's video promising strict action on paper leaks was briefly removed and later restored. Meta says the content was removed in error. Parliamentary panel on communications summons executives from Google, Meta, Snapchat, X and other platforms to discuss social media regulations. Massive wildfire tears through France and Spain. Over 3 lakh people forced to evacuate their homes. Bordeaux in southwest France is the worst affected. The fires in Spain affected an area nearly the size of New York City. Well, straight to the top story this evening. The pause in US-Iran hostilities is raising hopes of a possible de-escalation. President Trump has called the talks with Iran quote-unquote friendly. Now, here's a look at the latest developments overnight. Despite saying that the talks were progressing well, President Trump said that the US would resume strikes if, and I quote, something good doesn't happen. He also claimed that Iran asked Washington to stop the strikes, adding that the Strait of Hormuz is, and I quote again, in very good shape. Meanwhile, Tehran denied reports that it initiated the talks. Addressing a press conference overnight, Iranian Foreign Ministry spokesperson said that no direct negotiations are taking place currently. This as Gulf nations continue to face the heat of the conflict. Now, Saudi Arabia says it intercepted several drones coming in from Iraqi territory. Separately, a plume of smoke was seen in the city where the Aramco oil facility is located. The Iran-backed Yemeni militant group of Houthis claimed responsibility of the attack. However, Saudi Arabia has not confirmed nor denied any damage to the Saudi Aramco refinery yet. This as Israeli Prime Minister Netanyahu arrived in US to meet President Trump for their first in-person talk since the start of the conflict. Netanyahu said that Iran will be at the forefront of the agenda for discussions. In the oil market, Brent crude price is easing to $86 a barrel. Reuters reports that Oman has presented Iran with a joint mechanism to manage the Strait of Hormuz, which includes voluntary fee. According to ship tracker Kepler, traffic fell to 29% verified crossings between the 24th of July to the 26th.
And we're talking right now. You know, they wanted to talk. The people said, please don't shoot last night, the night before, 2 nights. Don't do it. You know, we're having good talks. So we'll see what happens. I think there's a good chance that something could happen. And if it does, good. If it doesn't, we go back to doing what we were doing 2 days ago.
Well, that's President Trump. Asian equity is down sharply as fresh concerns over artificial intelligence investments has sparked another wave of selling in global chip makers. South Korean indices led the losses, down 10%, the lowest level that we've seen since April. This as Nvidia's latest $750 billion investment has fueled worries about demand for AI infrastructure, keeping pace with the unprecedented investments. Now, reports also suggest that a Chinese company has begun mass producing immersion deep ultraviolet lithography machines. That also weighed on shares of semiconductor equipment makers. The Kospi closing about 11% lower, the Shanghai down 1% and the Nikkei down by about 4%. Back home, the Lal Street ending the day flat today. The Nifty closed above the 23,900 mark, led higher by IT stocks today. Mid-caps outperformed the benchmark indices, also closing in the green. However, the Nifty Bank Index was down today, down by about 0.5% or so. Flat but in positive territory, the mid-cap index, and a flat close for both the Sensex and the Nifty. Now, shares of HUL declined over 7% despite largely meeting estimates in Q1. This as weak volume growth disappointed the street. Meanwhile, Avenue Supermarts has seen its biggest single-day fall in nearly 2 years after the management flagged that quick commerce is a structural challenge and expected no major revival in same-store sales growth. Mangalam is standing by with the details. Mangalam, HUL and Avenue Supermarts both taking a big knock in the markets today. What seems to be worrying investors?
Well, for both HUL and DMart, the thing was that the street was expecting a little more than what these companies could deliver. Not that these companies didn't deliver, it's just that the expectations of the street ran a little ahead of what the actuality was. So let's start with HUL. The revenues grew in near double digit, which is the fastest that we've seen in the last 13 quarters. The underlying consumer sentiment, the company said, stays fairly stable with an element of price growth coming in as well. So 5% price growth, 5% underlying sales growth. And at the same time, we saw, the margins stay sustained. The management said despite the volatility in the raw material inflation environment, they hold on to the margin guidance of 22.5% to 23.5% as well. On the bottom line, yes, on a reported basis, there was a decline of 2%, but that was on account of a tax credit in the base quarter. Just for that, there too, the revenues were higher than, what the company has reported same time last year by almost 8 to 10% and pretty much in line with street expectations if you take the tax, impact off. More importantly, the internals of the company, the premium portfolio doing extremely well, and the management guiding for stable demand ahead of the festive season for both rural as well as domestic urban consumption, with the premium parts of the portfolio growing in double digits. So the stock actually fell because the street was expecting a little more. The expectations were that of 6 to 7% volume growth with a far more aggressive commentary when it comes to growth.
So firstly, we see rural demand continuing to be stable and robust in the quarter. So in the quarter that's gone by, June quarter, we see both urban and rural demand continuing to be stable in the quarter. So that's really our outlook going in. We have to keep watching, like I said, in terms of the monsoon and in terms of geopolitical impact on inflation. But given all the measures that have happened in the country, both in terms of the monetary measures, fiscal measures, the demand in the country remains consistent, remains stable.
Similar is the case with DMart. It held its analyst meet today, and more importantly, the management signified no real change from the previously guided strategy of the CEO. So as a result of which, the stock sold off because they thought that maybe Anshul Asawa, who's the new CEO of DMart, will come out with a more aggressive store expansion plan. They said they'll continue that 80 to 100 store addition every year, with more number of stores being added on the lease front. The threat of quick commerce always looms, and the valuations of DMart notwithstanding saw the stock end lower today.
Yes, down by almost 5%. Many thanks, Mangalam, for joining us. Indigo has announced a change in its top management. The budget airline has appointed Kiran Thadimari as its new chief financial officer. The airline redesignated its current CFO, Gaurav Negi, as advisor to the managing director, Rahul Bhatia. These changes are part of a larger reshuffle that's been taking place since Bhatia took over in March following the exit of former CEO Peter Elbers. This comes after Indigo appointed Willie Walsh as the new CEO of the airline. Walsh is expected to take charge in August. Swiggy Instamart CEO Amitesh Kumar Jha has stepped down from his role with immediate effect. The company has named former Myntra chief Nandita Sinha as his successor. She will take charge on the 3rd of August. Jha's exit marks the end of a relatively short stint at the helm. He joined Swiggy in September 2024 after spending nearly 14 years at Flipkart. HDFC Bank's board views the 45 crore rupee payment to the Maharashtra State Road Development Corporation as a procedural lapse and not misconduct. Now, sources say the matter is unlikely to hinder CEO Sashidhar Jagdishan's reappointment. The board decided to impose a 1 lakh rupee penalty and issue a warning to the CEO, CFO and the head of retail assets. But it is still a question mark on whether Sashidhar Jagdishan will be reappointed. Our sources tell us that it may not be a no-go as far as the RBI's fit and proper criteria is concerned. We'll head into a break, but up next, the Supreme Court moots an independent probe into excessive use of force by the police to clamp down on student protests, directs all states to release detained protesters who are minors. That and more when we return. Tata Sons reported a profit of nearly 32,000 crore rupees in FY26. This is 22% higher compared with last year. The conglomerate's annual report shows that group companies have posted a combined annual profit of 1.7 lakh crore rupees. It also says that Tata Electronics has emerged as the major job creator in the group. and that Air India's revival is going to take longer. To discuss all of this and more, we're now joined by Madhiya Mujawar and Rachna Dhanrajani. Madhiya, first to you. Chairman N. Chandrasekaran expects the airline to transform, but now only after the next 5 to 10 years. Take us through the reasons behind this.
Well, there is a significant reset coming in from Tata Sons on Air India's turnaround. For the first time, Tata Sons chairman N. Chandrasekaran has said that rebuilding Air India could take 5 to 10 years. In his letter to shareholders, he explains why the transformation is taking longer than originally envisaged. Let's first look at the numbers. Air India reported a revenue of 71,870 crore in FY26, down from 78,600 crore a year earlier. Losses more than doubled to 22,200 crore from 10,800 crore in FY25. And perhaps that's why Tata Sons is now resetting expectations. Remember, Air India unveiled Vihan.ai in September 2022 as a 5-year transformation roadmap. So we should have ideally seen a transformed Air India in 2027. But now Chandrasekaran says that the airline's transformation will take longer. In his words, he said, and I quote, Air India's transformation must be seen as a 5 to 10-year journey. Every great airline in history was built over decades and not quarters. He says rebuilding Air India has taken longer because of supply chain disruptions, fleet renewal, legacy systems overhaul, cultural transformation, and the need to build technical talent. Now, this doesn't mean that the transformation has stalled completely. Air India has upgraded its IT systems with $200 million investment. The most criticism for Air India comes on the old interiors of the aircraft. So the airline has retrofitted 27 narrow-body aircraft. So the narrow-body retrofitting is done, and only 2 wide-body 787s have been retrofitted due to supply chain issues. It also brought 30 grounded aircraft back in service. The airline had ordered, when it took over Air India, the Tata Sons had ordered about 600 Boeing and Airbus planes. So far, it has received 6 Airbus A350s, 3 Boeing 787-9s, and over 50 Boeing 737s, which are the narrow-body planes. So over 500 new planes are still to be delivered, and the airline expects bulk inductions in 2027 and 2028. So, while the transformation is underway, the wait for passengers for the fully rebuilt Air India will be longer than what they had expected.
Yes, that certainly seems to be the case now. N. Chandrasekaran talking about the next 5 to 10 years before things can turn around at Air India. But Rachna, coming to you now, Tata Electronics is now the 4th largest company within the Tata Group. It's also a major job creator with more than 86,000 employees. Take us through what the annual report says about Tata Electronics as well as its growth trajectory.
Absolutely. Tata Electronics was set up in 2020, and by 2026, it is now the 4th largest business in the Tata Group by revenue. Tata Electronics has reported revenue of 1,31,000 crore rupees for FY26. That's up nearly 97%, double of almost what it was the previous year. Only Tata Motors passenger vehicle arm, TCS, and Tata Steel are bigger than Tata Electronics now, because the company now out-earns Titan, Air India, and even Tata Power. But the profit line here tells a very different story. The net loss widened to 1,611 crore rupees from just 70 crore rupees a year ago. 23 times worse it has become. But the chairman's letter says operating profits have reached break-even, and that is true. But everything below the operating line, the depreciation, the interest on a very large bill, is now landing on the books. So where's the revenue actually coming from is the question. Well, almost all of it, roughly 97%, is one thing: making phones. The annual report does not name the client it makes phones for, but it says Tata Electronics made 12% of the total volume of phones produced by, quote, the global leader in 2025. But the 2 subsidiaries doing the work are named. One is the former Wistron India and the other is former Pegatron India. Both were Apple's contract manufacturers before Tata bought them. So it is the manufacturing of iPhones. The former Pegatron business, 60% of which Tata bought for 1,650 crore rupees, is losing 858 crore rupees on nearly 60,000 crore rupees of revenue. Now the semiconductors, and this is what the chairman is really trying to sell in this letter, because in his letter, N. Chandrasekaran writes, quote, chips are the new steel. A nation that cannot make its own semiconductors will always depend on others for the most fundamental input of the modern economy, end quote. Now, here's what the accounts really show. The two chip entities brought in about 214 crore rupees between them and lost about 777 crore rupees. The fab company, which is in Dholera, reported zero revenue. And in the entire 338-page long report, they give no capex figure for that fab nor a timeline to the first silicon that we'll see being manufactured here. Then there's the head count, 86,466 people, up almost 32%. Tata Electronics is now the second largest employer in the entire Tata Group, behind only TCS. Nearly 2/3 of that workforce is women. And here's the context that matters. Over the same 12 months, TCS shed about 23,460 people. Tata Electronics added 20,819. The group's total headcount moved less than 1%, and the Tata Group did not grow its workforce this year. It just changed its shape. Roughly 20,000 jobs moved from software to the factory floor. And Tata Sons put another 3,000 crore rupees into the business last year. So chips may well be the new steel, as N. Chandra says, but for now, it's the phones and the manufacturing of these phones is what is paying for them.
It certainly is. Many thanks for joining us, Rachna and Madiha. Now, the Supreme Court heard a clutch of petitions alleging police brutality during the crackdown on student protests across the country. The Supreme Court issued notices to Delhi, Maharashtra, Bihar, West Bengal, Madhya Pradesh and other states over the handling of the protest. The court also mooted the idea of an independent investigation into police excess and ordered the release of protesters who are minors. Meanwhile, the Rapid Action Force has identified serious operational deficiencies during the crackdown on protesters. Police records reveal an officer at the rank of Assistant Commissioner approved the use of pellet guns. The police also used electric shock weapons, including batons and shields. The state governments of Bihar and Assam have withdrawn all cases against the protesters. Both states have also promised not to take any fresh action. More than a dozen cases were registered against protesters in both states. The Lok Sabha took up the Public Examination Amendment Bill. The proposed legislation also introduces a 2-month deadline to complete investigations and empowers states to establish fast-track courts for speedy prosecution. Meanwhile, the IT Ministry has summoned Meta's global head of public policy after the platform removed and restored a video posted by Prime Minister Modi promising strict action on paper leaks. Meta says the content was removed in error. The Parliamentary Panel on Communications summons executives from Google, Meta, Snapchat, X and other platforms to discuss social media regulations. Here's all the action from Parliament.
This bill can be described in a way as a milestone legislation in the history of Indian Parliament.
जिस मंत्री के तहत में 21 बच्चों ने अपनी जान गंवा दी, आत्महत्या की, जब उसने अपने मंत्री पद से इस्तीफा दिया, कल जब वो सदन में आए आपने उनको ऐसा माला पहनाया ताकि जैसे वो पाकिस्तान से जंग लड़के आए हैं, ऐसा माला पहनाया, ऐसा उनका वजूद उनको बढ़ा किया मानो कि वो पाकिस्तान से जाकर सीमा पे जाकर जंग लड़के आए हैं।
कांग्रेस शासित यूपीए ने पॉलिसी वैक्यूम करा, वहीं पर अगर मैं जेनजी की भाषा को बोरो करूं, then I will have to say मोदी जी clocked it and provided a legislative solution.
मैं इमरजेंसी को तो नहीं देखा हूं, लेकिन इमरजेंसी में क्या-क्या हुआ है वो अभी दिल्ली की राजधानी में भी देखने को मिल गया। आंसू के गैस के गोले और लकड़ी में लगा हुआ कुछ कील का और कांटे की चीजें, उस समय करंट नहीं लगाया जाता था, इस बार करंट लगाया गया, तो ये इमरजेंसी के बराबर ही हुआ है हमला।
Well, the amendments to the examination bill being tabled in Parliament today, the discussion underway. Ashmi joins us now for what transpired in the Supreme Court. Ashmi, the court signalling the need for an independent probe into allegations of police brutality, police excess, providing a shield for protesters by blocking coercive action by the police as well. Take us through what the court said and where we are now heading.
Well, we saw a large bunch of petitioners raising concerns with respect to some of these incidents that we have seen over the last few days. Instances of lathi charge, use of pellets, use of electrified batons, use of even sticks which had nails in them. All of these instances had been flagged before the apex court. In fact, the petitioners went a step further. They also flagged the issue of police personnel in civilian clothes beating up protesters. They also, importantly, flagged the issue of facial recognition systems and digital data that has been collected as a means of surveillance insofar as the protesters are concerned. Now, on the back of all of these instances, the Supreme Court did observe, in fact, a bench headed by the CJI himself observed that there is a compelling case for a thorough investigation. In fact, went a step further and said that any investigation will be meaningless until accountability is fixed as far as these instances are concerned. But in the same breath, also important to mention that the Solicitor General was also there in court in these proceedings, representing the Delhi government as well as the centre. He made a couple of submissions. Number one, he said that the centre is not opposed to any investigation being instituted by the apex court, but in the same breath also said that police personnel have also been hurt, over 250 of them, and also importantly said that there were miscreants who had found their way into the protests, that there were people who had criminal antecedents, whether it's murder charges, rape charges, drug charges, and that is something that in fact should also be a part of these investigations. Nonetheless, the court saying that prima facie, this is a fit case, at least compelling case being made for a thorough investigation. What shape and form that will take has been deferred to the next hearing. But until then, what the court has said is that all the digital evidence that has been collected, whether that's CCTV footage, body camera footage, facial recognition systems, all that digital data, number one, needs to be preserved, and number two, importantly, the safeguard cannot be made public by the police personnel at this stage. Also, secondly, the direction that the court has given is that all minors that were rounded up as a part of these protests, they are to be released. And importantly, while the investigations can continue, no coercive action against the protesters. So clearly, the big question now is what shape and form will a court-appointed investigation take? Who will be heading it? The protesters are pushing for a former CJI. The centre is essentially saying that the recommendation should not be taken from the parties, that the court should take its own decision. So clearly, the shape and form of this investigation agency, the contours of the investigation, as well as who will be heading it, these are questions we'll hopefully get answers to in the next hearing, which will be on Monday, the 3rd of August.
All right, Ashmit, many thanks for joining us. A quick check of some of the global headlines we're tracking. U.S. pharma giant Johnson & Johnson has proposed a $5.5 billion settlement to resolve thousands of lawsuits alleging that its talcum-based products caused ovarian cancer. The company said the settlement would cover around 76,000 remaining claims. It says it needs sign-offs from law firms representing at least 95% of those claims to be finalized. The company continues to deny that its talc products cause cancer, but stopped selling it in the US and Canada in 2020 and worldwide in 2023. It has since changed the formulation of the product. Anthropic CEO Dario Amodei says his company has never advocated for a ban on open-weight models. In a blog posted by Amodei, he says that tech companies must instead focus on keeping powerful chips out of the authoritarian hands. This statement has come after a coalition of tech companies, including NVIDIA and Microsoft, released a letter late night urging policymakers to avoid premature restrictions on open-weight models. These models allow users to download, modify, and run on their own infrastructure. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. India's southwest monsoon has staged a strong comeback after one of the driest starts in recent years. While heavy July rains have significantly narrowed the rainfall deficit and boosted hopes for the Kharif season, the recovery has been far from uniform. June ended with 40% rainfall deficit, but a sharp pickup in July has helped reduce all India shortfall to around 15% as of date. Even so, uneven rainfall and delayed sowing continues to weigh on to the agricultural outlook. The Kharif sowing is still about 5% below last year's level, with oilseeds, cotton, pulses and core cereals lagging behind. So has the monsoon recovery come in to protect crop output, or could the delayed sowing still impact yields and farm incomes? To discuss all of that, we are joined by Sohail Tanna, who's Director AgroCorp International. Sohail, hi, thank you so much for joining in. What is your sense when it comes to pulses? Despite July giving us stronger monsoon, we still are looking at lower sowing. Is it recoverable, or do you think we are beyond that right now?
Good evening, Manisha ji. See, actually, the rains have been recovered. The sowing window is still, as I said earlier, it is still till mid of August. The only concern is Karnataka at the moment, but we need to see more further 15 days how this will impact. Everywhere the rains are very good, and the sowing is not that much down, which is going in the propaganda. But otherwise, I don't think so. There will be a much problem apart from Karnataka. If the rains continue to be well in Karnataka also, there will be no issues. There will be a marginal downside. But otherwise, it's still very bit confusing, mainly in parts in terms of Tur. Otherwise, the sowing is good.
Mr. Tanna, so Tur is exactly what I was coming to next, because MP, Maharashtra, Karnataka, we are looking at lower than estimated rainfall. There's a big deficiency. The sowing seems to be trailing here as well. So when it comes to Tur, we've seen prices gain up in any case in the last 1 month or so. From here on, what is the kind of availability that we have? The private sector is known to be holding quite a bit right now. Do you think that would cover the cost?
See, first of all, we need to see 15 days more. Tur is a confusing crop at the moment. Okay. 15 days rainfall is very crucial. Second thing, the private players are, there is a good carry stock in India for the Tur, as well as the African crop is about to start. For any negativity of the Tur crop, at least 15 to 20 days is a wait and watch. At the moment, everybody has a stock, but the stock are of the higher prices. Everybody wants the exit. But for the same, the sowing has been continuously going on, and the prices which have come down, which has come up since last 15-20 days, it is all due to the sentiments and the rains which were delayed. But at the moment, the market is stabilized, and there is the upward movement will not be much, so there will be no downfall also, unless and until we see further 15 days rains, which is more important.
Sohail, what is your sense on the FY27 import outlook from here?
India will need around 6 million plus imports, that's for sure.
And how are you looking at the prices from here on? You said prices will not decline, will stay elevated, may not gain too much from here, especially for Tur, Urad. How are you looking at a couple of these crops?
Urad also, the prices have gone up very high. So now there should be some price correction seen in Urad as well, but not marginally. It will be in the range of 3 to 4% upside down, because it has already moved up a lot. In terms of Tur also, I feel the same, that it should not be more. The prices are already at the bottom level, but it should not go below 2 to 3% maximum, or on the higher side 3 to 4% max.
Would you say that we are well equipped, well stocked when it comes to festivals? Because that's exactly what we will be talking about in the next 15-20 days.
Yeah, so for that, if you see the overseas also, we have a good crop, and the main thing is rupee weakening. From last 1.5 days, the rupee is a little bit strong, but otherwise the rupee is also a main concern. The imports are getting costlier, but at the same time, the demand is not that great, which should be there. But in terms of Tur, I'm telling, but only for the desis, the demand for the Australian chana, the demand is good.
What's also your sense on the government buffer stocks right now? Do you think that's one of the reasons that the prices seem to be holding right now? And the other is the market kind of concerned or scared that if the prices do go higher more than from where they are, you could be looking at more government measures coming in?
See, the government has been doing very well from last 2 years or so. They are liquidating their stocks at the time of festival seasons, and they will be liquidating. And they look more and they look how the consumers are benefited more rather than the other things regarding the price and everything. But they will be taking a major steps if the prices don't be in control. Stock limit might come, or even they can reduce the duty. They have the module ready.
Sohail, a final question then. When would you think that the government will come in action on how much of a price rise from here is the government comfortable with?
See, maybe in desi chickpeas, they might see more 5 to 7% or 10% upside. Then they might take a call. And in tur as well, they will see another 15 days if the prices don't be under control and move above 85,000 or 90,000 per ton. Then they will come into the picture. Before that, I don't think so.
Point taken. Sohail Tanna, thank you so much for joining in. Well, that's the sense coming in for pulses. As Sohail tells us that the sowing window is still open until mid of August. And if even then the situation does not improve, then we perhaps could be looking at pulses prices going up and the government perhaps also getting into action. At this point in time, the pulses prices already have gained up by nearly 5 to 15% in the matter of last couple of months itself. Well, that's about pulses, but let's also talk about edible oils because these are two segments which have seen sowing lag on. Nirav Desai is managing partner at GGN Group and now joins in for that conversation. Nirav, hi, thank you. What is your sense as well? Do you also see a window which is still open in sense of sowing, and how are you reading the lag?
So as far as oilseed sowing is concerned, particularly, I think the window is nearly closing, but the area under oilseed is reasonably covered. As of today, we see about 2.5 to 3% lower acreages, about 3.6 lakh hectares lower than last year. I think this year the sowing has been delayed, so the government reporting can be little late on that. So maybe by first week of August we'll come to know. And broadly, there are major reports that the sowing is soybeans and groundnut. But the thing to see is that as on today, whatever the sowing numbers are coming, the soybean acreage, which is coming lower, the major part of that acreage is lower in Maharashtra. So as of today, 3.6 lakh hectares sowing is lower in soybeans, which is coming from Maharashtra. So maybe the area is going in some other crops. Similarly, on groundnut, it's surprising to see 60,000 hectares lower area, where Gujarat accounts for 3 lakh hectares lower area. And Rajasthan and UP are showing about 1 lakh plus 2 lakh, 3 lakh respectively total area increase. So again, groundnut, Gujarat is an important area to see.
Nirav, also when it comes to yields though, is that a concern for you, especially when it comes to Maharashtra, Gujarat, Rajasthan? Is yield a concern?
So as of now, see, I'll be honest, for Kharif crop, the monsoon set in late, so the crop sowing has been late. But there is no major yield issue. There was a gap of 10-12 days in July, mid of July for the monsoon. But there was a shower earlier and now there are showers. So for the Kharif, see, it is not that we get 40 inches or 50 inches of rainfall. It is the right distribution of rainfall. So as of now, the distribution has been good. And if it continues to do so in August and early September, the Kharif might come out. But the water tables might not be able to support a great Rabi crop.
That, of course, is a concern. But the surprise, Nirav, also comes in the figures when I look at sunflower and sesame. There's a surprise uptick into this one. Would you say that the farmers seem to be moving to safer bets, safer crops, less water-consuming crops?
No, I would say they are very minor crops if you look at the area that they are covered in, and they are very small in domestic production. So our major Kharif oilseed crop is soybean and groundnut for the direct oilseed, and otherwise cotton and rice bran, which internally give us a good oil supply. So cotton also, I think as of now, the area is slightly lower. Again, Maharashtra is lower. Gujarat and Rajasthan is also slightly lower, whereas Telangana and Andhra is good. So let's see, but I think cotton still has a window to have sowing.
Okay.
But overall, I think the Kharif crop will, the yield will depend on the August and the early September rain. So that's very important for us to see.
Nirav, I just want to get in a number here because the Solvent Extractor Association has talked about a higher import bill this time around. One, because of higher imports, and second, because the edible oil prices have been rising, and third, of course, because of the depreciating rupee. What is the number, figure in sense of imports and quantity that you are working with?
So see, honestly, the overall oilseed or oil availability is dwindling just now in India. So it is good that we have covered the imports well in time. And the July arrival totally is around 15 lakh tons, which is about 4.75 lakh tons of bean oil, 7.5 lakh tons of palm oil, and 2.75 lakh tons of sunflower oil. Similarly, August, the bean oil import is going to continue to be higher, around 5.5 lakh tons. The palm import could be ranging between 6.5 to 7.5, and sunflower might dip a little bit to 2.25. But net, I think the import would still stay around this 14-15 lakh tons. And yes, I agree, the import will be required, and the prices are at least $200 higher versus last year. And the rupee has been weakening. So the import bill is going to be good. But the good thing is that as of now, India is well stocked. There is a good lineup. And with this ongoing threat of El Nino and all that, I think just now the world edible oil markets are well supplied in Indonesia, Malaysia, and South America.
Nirav,
so India is using this opportunity to time buy whenever the market goes lower.
Nirav, do you see biodiesel as a concern as well going forward?
Yes, definitely. If this B50 implementation from Indonesia kicks in a very nice way, then palm oil availability might really go down, especially in Q4 26 and then going onwards 27 Q1 Q2. And the situation is such that overall crude oil prices somehow are managing to be higher. So if that goes, I think the Indonesian biodiesel policy would be very supportive overall.
Point taken. So finally, Nirav, you don't anticipate the edible oil prices to come down. You expect also that in this case as well, we would be looking at elevated prices.
Yeah, so I feel the prices will not come down. And on the contrary, India is buying it well on time with this kind of war situation ongoing. The crude oil prices always be keeping at a higher level. It is definitely food versus fuel. So food demand has to keep upbeat. If they miss that, then we will be, in a not a very good situation that ways.
Okay.
But on the other hand, I don't think the market is going to fly a lot because the origins also are well supplied and India has been buying very timely.
Point taken. Nirav Desai, thank you so much for joining in. So the prices are expected to remain elevated, not fly out. We understand that. The origins have enough supplies, but India, of course, could be looking at higher priced imports continuing from here on. With that, we'll go for a very short break. When we come back, we will be joined to talk about the delayed monsoon impact on maize as a segment. We will be joined by Brijesh Lahoti, Director at Green Lime Trades. Welcome back. Joining us on the show now is Brijesh Lahoti. He's director at Green Lime. Mr. Lahoti, thank you so much for joining in. Surprise really when you look at maize acreage going down as well. I was reading reports on how the short duration sweet corn seems to be doing better, but maize clearly is showing a lag here. How have you read this?
Definitely, as per El Nino conditions, it was expected to lag behind. And as the monsoon set in late after June, as far as we concern overall sowing numbers which are coming up, most of the southern states are showing lagging numbers as compared to central Indian states of Maharashtra, MP, and Rajasthan. And as far as we can see, maize is less than 10% sown as compared to last year.
How would you look at that? And as you mentioned, Bihar, Karnataka also have seen lower sowings here. Mr. Lahoti, every time that we have been speaking, the markets have been talking about more requirement of maize, especially when there's a tug of war between ethanol and poultry as a segment as well. With the kind of situation that we're standing at right now, with 10% sowing and perhaps an impact on yield, what is the kind of crop that you're estimating?
As far as demand is concerned, feed industry is the one which continues to grow in India, being the affluence as increases. But in ethanol, there is option of using rice of different varieties and including FCI rice. But for a feed industry, there is no choice because maize is the main crop which is required in cattle and poultry both.
So are you anticipating a concern going forward, and this whole conversation about perhaps we will need to import maize could grow stronger?
Yeah, in the future, maybe after 6 months, we might import from the countries from where there is parity. Right now, there is no available maize which is possible to be imported in India.
What's your sense on prices going forward? Because the last 3 or 4 years have seen very volatile prices for this one.
Yes, particularly in last year, we saw the bottom ranges of maize, and in last 3 months, as we can see, prices have recovered significantly, maybe around 25 to 30%. And currently, markets are stabilized, and there is not much movement except a little bit higher expectation for good quality maize. And if the prices go higher than this for the lower or middle quality, which is used in mainly ethanol and starch industry, ethanol industry would shift to broken rice. So we don't see much shift in medium quality rice or medium quality maize.
Mr. Lahoti, would you say that the decline in acreage is purely because of El Nino, or is it because also we saw such volatile prices in the matter of last 1 year?
Yes, a few other factors, including El Nino and a lower range of maize in last year and increased prices of oilseeds, to which the major land has been shifted according to the farmers.
Mr. Lahoti, what's your sense in the quantum of imports? If India does open imports in the next 6 months, as you said, what kind of import, the whole GM narrative that we also keep listening about, do you think all of that is going to get sorted?
That is purely diplomatic issue and decision, which no trader or industry can certainly define. And currently, we do allow non-GM maize, which is being imported from Ukraine, Myanmar, some other countries. But I don't really see, if I have to focus, that our country would be allowing GM maize anytime soon.
That point is well taken. Mr. Lahoti, also, how are you looking at the prices going forward from here? Lower crop, imports perhaps on horizon. How are you looking at maize prices from here on? As you said, the last 3 months have seen 25% of increase in prices already.
Yes. From here on, we can expect a certain little bit of upside in maize, but not much as far as we can estimate. And ultimately, markets are the king. You cannot predict it 100%.
Are you surprised that even with an increase in MSP, we are looking at this reaction coming from farmers?
Because MSP has increased for maize, but the prices they are getting for alternative crops are higher. And for maize, if you need timely sowing and water availability, which was lacking. And almost all of the sowing has been completed, as we can guess. In some parts of northern Rajasthan, some parts of Rajasthan, you can expect little bit of sowing pending. But in MP, Maharashtra, it has been already finished business. And only in Madhya Pradesh, you can expect at least 20% increase in crop. Some parts of Madhya Pradesh have reduced sowing, but other parts are more than compensating it.
Final question, Mr. Lahoti, then what kind of a price increase are you anticipating, or rather demand growth are you anticipating in case of maize going forward? As you said, feed industry, starch, ethanol, there have been various takers. Going forward, what is the demand growth that you're anticipating?
Demand growth in feed and starch industry, we may take to around 6 to 8% year on year. But ethanol industry may shift to other grain, broken rice and DFG, damaged food grains, which is being made available from FCI, which are in plenty of supply, and availability is enough with the government.
Point taken. Mr. Rajesh Lahoti, thank you so much for joining in. But that's the view coming in from maize, that the overall Kharif sowing is lagging. And as Mr. Lahoti tells us, may lag or may end season by nearly 10% of a decline in case of sowing. And that is what has led the prices higher, can take the prices higher further going forward from here. Well, that's about the major essential crops where there are concerns, inflation concerns, sowing concerns, and yield as well going forward. But August, of course, would be a deciding month on where we go from here on many of these. With that, that's all the time that we have on this episode of Commodity Champions. Thank you for watching.
Hello and welcome. I am Ashmit Kumar. Now, the Supreme Court today heard petitions alleging excessive use of force by police against student protesters. The court said that the allegations must be investigated by an independent high-powered committee. The top court observed that the probe must be thorough, independent and scientific. It also noted that the protest was initially completely peaceful and that the right to protest is a constitutionally guaranteed right. The court directed that no coercive action be taken against protesters. It first called for the release of protesters below the age of 18. That's, of course, an interim direction given by the top court as of this morning. The court later directed the release of arrested or detained students who are first-time offenders. It also said that digital data of protesters must be preserved and must not be released in the public domain. The Supreme Court will seek responses from the centre, the Delhi government and the states of Assam, Bihar, West Bengal, Uttar Pradesh, Madhya Pradesh, Maharashtra and Kerala. Meanwhile, Assam and Bihar said that they have released the protesters. The two states also said that cases registered against NEET protesters would be withdrawn. Bihar police had earlier said that nearly 700 protesters were detained. In Assam, 6 people were arrested and more than 20 were detained. Meanwhile, in Mumbai, around 400 people were also detained but were released over the weekend. It is estimated over thousands were detained during the peak of NEET protests across the country.
This bill can be described in a way as a milestone legislation in the history of Indian Parliament.
जिस मंत्री के तहत में 21 बच्चों ने अपनी जान गंवा दी, आत्महत्या की, जब उसने अपने मंत्री पद से इस्तीफा दिया, कल जब वो सदन में आए, आपने उनको ऐसा माला पहनाया ताकि जैसे वो पाकिस्तान से जंग लड़के आए हैं, ऐसा माला पहनाया, ऐसा उनका वजूद उनको बड़ा किया मानो कि वो पाकिस्तान से जाकर सीमा पे जाकर जंग लड़के आए हैं।
कांग्रेस शासित यूपीए ने पॉलिसी वैक्यूम करा, वहीं पर अगर मैं जेनजी की भाषा को बोरो करूं, then I will have to say मोदी जी clocked it and provided a legislative solution.
मैं इमरजेंसी को तो नहीं देखा हूं, लेकिन इमरजेंसी में क्या क्या हुआ है वो अभी दिल्ली की राजधानी में भी देखने को मिल गया। आंसू के गैस के गोले और लकड़ी में लगा हुआ कुछ कील का और कांटे की चीजें, उस समय करंट नहीं लगाया जाता था, इस बार करंट लगाया गया। तो ये इमरजेंसी के बराबर ही हुआ है हमला।
Well, joining us now to discuss this further is with us Vikas Singh, Senior Advocate and the President of the Supreme Court Bar Association. Mr. Singh, thank you so much for joining us. You in person went to the protest site in Jantar Mantar. The SCBA, the Supreme Court Bar Association, has come out with resolutions condemning these instances of violence that we've seen, that we all have been seeing on our social media feeds. What I want to ask you is that even while the Supreme Court says that, yes, there is a prima facie need for an investigation to take place, the concerns that many have, that the petitioners themselves have, that this will lead to some kind of departmental inquiry, that action will be taken against a constable level officer, and that there will be no accountability for those higher up the food chain. There will be no questions asked of the seniors as to who sanctioned, who green flagged the use of such force against protesters.
In my letter to the Prime Minister and to the Home Minister, I have asked an inquiry to be done by a credible judge. And when I say credible judge, we all know what it means, because there are a lot of judges, who are being used by the government now and then for an inquiry, where you always see the inquiry resulting in their favor. But there are a lot of people who have credibility in the system, and they can be the right people to look into this kind of a case. The case has some very, very, I tell you, telling features. Commissioner of Police is removed one day before Mr. Wangchuk is picked up at 4 o'clock in the morning by the new Commissioner of Police. Now, the Commissioner of Police, whose tenure was guaranteed by a Supreme Court order in the case of Prakash Singh, where every Commissioner and DG has to have a fixed tenure of 2 years, was removed before his tenure ended. In fact, even on his day of retirement, he would not have completed 2 years. So he had cleared 7-8 months remaining in his tenure. So that's the first violation. Then the second violation is that a person peacefully protesting against his will is picked up and taken to a hospital not of his choice. A very serious thing. Why should a person who's ill, if at all required to be taken up, it should be by a medical opinion, not by the police. And he should be taken to a hospital of his choice, that too if it is necessary. So not done, they just forcibly picked him up. Then the same new commissioner of police suddenly decides to lathi charge a peaceful mob. Now, why peaceful protest? Now, why I say peaceful? Because I went to the site when I went to meet Mr. Sonam Wangchuk. There were at least screening at least 7-8 places. No protester could have gone in either with a lathi or with anything which could be used to turn violent. Nothing at all. They only went with either the constitution or some books. So there was nothing at all in their hands which could at all be used at any point of time for becoming violent. There were some plainclothes people who were having lathis and who have till date not been apprehended. Obviously, they must have been gone at the instance of the police, because without the instance of the police, it was impossible for anyone to enter that area. And even when these people are hitting the protesters, the police are watching them hit the protesters. So obviously, they were people, either plainclothes policemen or people of somebody who wanted to disperse the protesting students. So this is again a direct admission. If the protesters had turned violent to start with, then every channel, because today most of the channels are pro-government, it is quite well known. Every channel after channel would be showing 24/7 the violence done by the protesters. So there is so far nothing has come in the public domain. I believe yesterday police has released some small clips, but obviously it has taken them a good 8 days to come up with something which the protesters have done, which I have not seen. It has not come in the public domain, but apparently they are trying to build something on that. Now, in a protest of this kind, there is a SOP in place. The SOP says that when the 163 is in place, which is equivalent to 144, they should have big placards showing that 163 in place. That was not done. You don't see any placards being carried by policemen showing that 163 is done. Then there has to be a mic informing the people that 163 is in place, please leave this area. That is also not done. And under section 149, as well as the Delhi Police SOP, if at all violence is to be used, minimum violence is to be used, and that too only hitting with lathis and the legs, not above the legs. That also not followed. In fact, they were hit not only by lathis, but with lathis having, iron spikes, and also with pellet guns and whatnot. So obviously, all the SOPs have been flouted. So somebody will have to do a proper inquiry. It's not just that they are not being arrested or not being harassed is good enough. The people have to go.
Proper inquiry is called for. Mr. Singh, if I may just interject, proper inquiry is called for. The Supreme Court itself observes that prima facie there is a compelling case for an investigation, but we've seen investigations in the past. You yourself are making references to past judgments that have been passed by the Supreme Court itself. What will be different this time? There is, of course, a sense of despondency that this will get reduced to another piece of high-level committee and then the recommendations being put forth with no implementation.
So the Supreme Court has not yet constituted the inquiry committee or nominated a judge. Let's see whom they nominate for this inquiry committee, whom they made part of the SIT. If they make credible people, I think we will get to the bottom of this, because ultimately the whole purpose is to find out how. And one thing very, very important, Supreme Court also has held that if a person is wanting to do a peaceful protest for a legal claim or a legitimate claim, that has to be permitted. Why was permission denied in this case? The angst of the students that there should be a fair exam. Nobody can deny that that's a valid claim of the students. If it was a valid claim and that was the only demand raised by them, and on that basis they were asking the resignation of the education minister, it's definitely a peaceful protest should be permitted for this, and the protesters should have been permitted to go to the parliament. So if they had been permitted to go to the parliament, all these questions would not have arisen at all. They would have simply marched peacefully towards the parliament, made their whatever representation there, and the matter would have ended. Why were they prohibited from leaving the place in the first place, when the law does not permit the government to stop such kind of peaceful march to proceed? So this is again a very, very serious infraction of the fundamental rights of the citizens of India who want to peacefully protest for a legitimate demand, and they are refused. They are not permitted to do so. So it's actually wrong in so many ways that unless a very high level inquiry is done, that too by a very credible judge, I don't think we will ever get to the bottom of this.
Right,
I only
Mr.
hope
Singh.
the Supreme Court nominate somebody very, very credible to do this immediately.
Right, Mr. Singh, we'd like to appreciate your time with us. Again, an important point being made there that a credible name needs to head this investigation. But let's proceed with this discussion. Also with us is author and educator, Mr. Shiv Khera, and former Indian police officer, Mr. S.P. Vaid. Gentlemen, thank you so much for joining us. Mr. Khera, let me get your thoughts on this. The Supreme Court for now has said that there is a need for an investigation and has granted interim protection in the sense that no coercive action, but has not asked for all protesters who have already been arrested to be released. There is no direction that the court has given.
Well, first of all, I want to mention what this gentleman, the advocate, Mr. Singh, has said. I think in his entire talk, he has repeated the word credible at least 10 times, 15 times. If credible judge is put in, credible judge is put in. So I really admire what he says, that the word is credible judge. Where is the credible judge? How many judges are credible? With the judiciary the way it is, that is one major thing. And he also made it very, very clear that peaceful protest is the right of any citizen in this country. It is a democratic right. And sadly today, the whole system has been corrupt. This paper leakage that has taken place, it is not new. For the past 7, 8, 10 years, paper has been leaking every year. 70 papers have been leaked in the last 20 years. And this was coming. I am so glad that people have taken onto the street to protest against outright total misgovernance and the way they are oppressing the students today, the way the government is oppressing the citizens today. This is called terrorizing your own citizens. I repeat the word. This is the way it is being governed today. This country is being governed. The honest people are suffering and the criminals are going free. This is called terrorizing your own citizens. No wonder they had to take to the street. And many, many things are cooked up, created, false evidences are created, and false charges are put. This is not new. All kinds of false charges are put on innocent people and then involved in wrong things, and they are stuck. I mean, we've had coups in Nepal, we have had coups in Bangladesh, we have had that. And in fact, at one time, people were saying to me, look what happened in Nepal. But that became violent and people pulled out politicians who were sitting there, they hit them, they burnt them and so on. And he says, oh, right, protest is good, but violence is not good. Now, important thing I want to mention here is, then Ram should have been put into jail. He took to violence. He did kill Ravan. Don't you understand English? Then Ram should have been put into jail. Now, my point I'm trying to make is, I am not advocating, but the bottom line, in Nepal itself, I gave an interview that people 10 years ago who were not even worth 10 rupees have become worth 10,000 crores today. And they pick up anybody and they put them into jail for 10 years.
Let me steer that conversation,
so people
Mr.
should
Khera, let me steer this conversation back to the issue of excess by police. That is what the subject matter has been in the parliament today as well as the Supreme Court. Mr. Vaid, speaking from your experience with the police forces, the use of force that we saw, there are SOPs in place which senior advocates like Mr. Singh were saying were clearly violated by the police. Can that be done by a constable level officer without the sanction of somebody higher up the food chain?
Good evening, Ashmit and Mr. Kheda and your viewers. See, when such a huge demonstration is there and so much of deployment is there, I'm sure there must be senior officers definitely commanding them. I don't think it can be left only to constable. The senior officers have to be on the spot. Obviously, the magistrates must have been there. Without their order, you can't use even minimum force. So I believe that because I don't stay in Delhi, so I was not on the spot, but I believe there must be a senior officer. The list I saw of injured people includes Special Commissioner of Delhi Police, Additional Commissioner, Deputy Commissioner, I think 2 or 3 of the Assistant Commissioners. So that shows they were on the spot. See.
Mr. Ved, we're not questioning whether the senior officials were on the spot. The question is one of accountability, that if the police is found to actually have crossed those limits, crossed those SOPs, in breach of those SOPs, where does the accountability lie? Is it enough to suspend a constable level officer, or is there need for accountability for those higher up the food chain, higher up the ladder as far as the police personnel are concerned?
Accountability should be at every level, even at the senior level. There's no question of only constable can't be made scapegoat. After all, the people who issue order for use of force, they are accountable to law. And now, since the Supreme Court has taken cognizance of this, Supreme Court has said no action against the minors and they should be released, and those who are genuine students. But Supreme Court has not stopped the action against those who have resorted to stone pelting, destruction of the public property, and causing injuries to roughly 150 policemen. After all, who injured the policemen? There must be somebody there. And as far as allegations of use of police, use of lathis with nails by police, I think that is a serious matter. Even at my level, I would not tolerate. How can you use a lathi with nails or other pointed things that can be very, very cause grievous injuries? Let the commission now, as the Bar Council President was mentioning, Mr. Vikas saying, now the Supreme Court has agreed to appoint an independent commission, and I think we all should welcome that. Let an inquiry be conducted by an independent commission headed by
We'll of course be watching the Supreme Court very closely. The Supreme Court saying that on Monday they'll take a call on what shape and form this independent committee will take. But Mr. Khera, let me come back to you. Another issue that has been repeatedly flagged by petitioners has been the collection of digital surveillance by police personnel, whether that's CCTV, drone footage, body camera footage, facial recognition systems being used. There are concerns that petitioners have raised that there is no framework for regulating how this data gets collected, gets used and then deployed for surveillance. Is that a concern that perhaps the Supreme Court also needs to come in on as far as facial recognition systems are concerned, digital data is concerned?
Well, they have to do surveillance anyway for multiple reasons to figure out so that unwanted people, an element does not come in and commit crime to begin with. That's one. But you didn't let me finish last time when I was talking of police atrocity. Just outside Vasant Vihar, only 3 months ago, a sitting brigadier was harassed and his son was beaten up by some people who were drinking on the street, and his wife came to protect, and the police van was right there. And they said, we will not do anything. We are waiting for our reinforcement to come. Is this the kind of a police that you are looking for? This is outright nothing else but terrorizing your own citizens. I am repeating a sentence. This is terrorizing your own citizens. And this happened with our sitting brigadier in Vasant Vihar, a posh colony. So yes, as far as surveillances are concerned, those things are concerned. And then police inquiry is going to be done. Inquiry is going to take another 25 years. Even the fast track court, Nirbhaya case, said it will be done immediately, has taken 10 years. What the hell is going on? Look, you people know answers. You want to hear from us. You already know. You are anchored. That's what the whole thing is all about. The bottom line is we have to figure out, is the government serious? Are they troubling their own citizens? Answer is yes. I can repeat 25 times. Nothing more is going to come out of it.
We're running out of time, Mr. Khera. Just one final word. Should there be any interim relief that should come the way of protesters who were picked up? There were examples of one protester by the name of Junaid who was distributing food. He was arrested and then he was let go in Dehradun. He's filed a petition also in the Supreme Court. Is there a need for some kind of interim relief for protesters rounded up as a part of these proceedings that we saw over the last week or so?
Answer is yes. Absolutely. Answer is yes. 5,000% interim relief ought to be given. You have pushed the whole citizen to the wall. And then when they come back to fight, you say you are taking the law in your own hands. Who is taking the law? You people are taking the law in their own hands. You are oppressing your own people. Answer is they should be given interim relief. Absolutely.
Clearly, all eyes now on the Supreme Court. They will be resuming hearing in this matter on 3rd of August, which is the coming Monday, and that's when we'll begin to get more color on who the credible name is who will be heading this independent investigation. With that, it's time now for slipping into a very short break. I'd like to thank both of our panelists for sharing their valuable insights. But time now for a short break. More news and updates will continue on the other side. Welcome back. Now, Samsung is betting big on its latest foldable series, the Galaxy Z Fold 8. The Fold 8 as well as Flip 8. These are devices launched recently just last week at Samsung Galaxy Unpacked in London. On the sidelines of that launch, I caught up with the president and the CEO of for Southwest Asia, Mr. J.V. Park, for Samsung. He spoke to me on a number of issues. He spoke to me, of course, on the launches of these new devices, on the focus on India market, but also dwelled on how there is an unprecedented spike when it comes to memory costs, how this situation with respect to price hikes for memory is likely to continue for at least the next 2 years. He also spoke to me about how India is being used as a hub for manufacturing as well, with 50% of phones being manufactured here, being exported by Samsung, and the role that India is playing in contributing towards the broader Samsung ecosystem. Let's take a look at JB Park, the President and CEO for Southwest Asia, Samsung, on the way forward in this special conversation right here on CNBC TV 18. Mind you, this is the first time ever he's speaking to an Indian broadcast network, and an exclusive conversation right here with CNBC TV 18.
Learning from this new form factor, we segregated the requirement based on productivity, or if entertainment, gaming, or mobility. So that's where we have put 3 different foldable types, first time ever, and it will be a very, very successful launch in India, and I hope all the support that we can get.
Any personal favorites that you have of the 3 devices?
It's more of not a form factor, but the software, the UI that is supporting the Galaxy AI features that works underneath the hardware to make the best performance, whether you're in productivity or entertainment.
One business reality that a lot of us financial journalists find ourselves talking about are increased memory costs, component costs. Tell us, with that new modern reality, it's been termed by some industry insiders as being an unprecedented hike. Tell us, what has been the first half of 2026 and what is your outlook for the second half of 2026?
Yes, it's a new norm that we see. The adaptation of AI is resulting in more computing power and thus making the memory shortages. As more industry and consumers are benefiting of using this AI features, the memory stack shortage will continue, I think, in second half. And as the industry is ramping up to increase their production, it will take a couple of years to really be sufficient on that. But until then, I think the memory crisis will continue.
When we speak of this memory crisis, it also falls in line with the premiumization trend that we're seeing. So tell us, from a Samsung perspective, how do we balance the increased input costs and the trend for premiumization with the need for affordability and democratization?
Yes, very good question, Mr. Kumar. I think that premiumization is where the consumer can benefit most on the AI features and the journey on using this AI capability. The premium phones are equipped with the best capability. However, if you look at the entry and mass, these are the area that also needs to have a waterfall effect on this new technology. I think the usage of smart devices that uses the AI capability will expand. More requirements on higher standards on the computing power on device will be required. So Samsung direction is to give the best consumer experience on AI. The costs, which are a burden to the consumer, we are providing different solution. First, we are trying to absorb as much as we can on the material cost. However, there are also other affordability platforms that we can provide, like EMI, and that will spread out the investment in the first place.
Sure. One final question for you, Mr. Park. Samsung, to many Indian households, is a name that they resonate with. Tell us, when you look at this journey ahead from an India perspective, how is India contributing to the Samsung journey?
Well, it's a good question. Well, there are 2 areas that I would say India contribution to the global smartphone expansion. First, we have R&D center and also a design center that contributes on designing and do the product planning. Then we have the R&D center develop a specific features that are domestic and also international that can be applied to a global market. So an R&D contribution, and also the factory that we run in Noida half of the volume are being exported. So made in India, made for world is the biggest takeaway of India's contribution.
And with that, it's a wrap on this special broadcast. More news and updates will continue right here.
I would have never written a book, but after this AI mumble jumble started coming in, and I said I need to throw my hat in the ring game.
And set the cat among the pigeons again.
Yes, so now I will be enemy number one for my industry once again. You're still paying that 25,000 rupees salary, which I used to pay 15 years ago. That has not changed.
Yeah.
Investment in people has not changed. Somebody has dropped this Coke bottle called AI or machines on us, and we consider it as God.
You do believe that there is a 33% chance that this is a bubble. You're very specific. Why?
No, it is a bubble. No, there's no 3% chance. It is a 100% chance. The reason Indian IT is as big as it is because FC Kohli and all these guys did stuff which nobody else imagined could do, despite the fact they had no money. Whether I'm pessimistic or optimistic depends on what Indian IT decides to do.
You're saying partner with startups?
I'm saying, why don't you invest 5% of your profit by incubating startups inside your organization? You're having your single malt sitting at home. That guy is sitting at 12 o'clock in the night and delivering that service. Motivate him and do, for God's sake, tell him I love you. Shireen, to what extent it is logical for you to send a 7 a.m. mail to 13,000 people and saying you don't have a job? You're dealing with humans. You're dealing with people with families.
Is regulation an answer?
No. I think the government should keep away. Imposing AI on our children in our schools, stop it, for God's sake. Teaching knowledge school is a waste of time. Knowledge skills is a waste of time because the ChatGPT or Claude can give you that knowledge in a jiffy. We created Sampark Didi, who teaches only through song and dance. People, instead of 9 o'clock, they are coming at 8 o'clock because they want to compete.
Because they want the Gana Bajan. From employees first, customers second to humans first, machines second. One of Indian IT's most unconventional leaders is flipping the much talked about jobs debate. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Now, long before AI became the boardroom obsession that it is today, my guest transformed HCL Technologies with a philosophy that challenged decades of conventional management thinking. His employee first, customer second approach became a Harvard Business School case study and helped redefine leadership for a new generation of businesses. Now, as businesses race to become AI first, Vineet Nair is making a different argument. In his new book, Humans First, Machines Second, he says the biggest challenge isn't smarter machines, it's humans losing confidence in what makes them uniquely human. He believes AI should amplify people, not replace them. So, will AI replace jobs or simply automate tasks? What happens to leadership in the age of AI, and how should businesses prepare for what is coming next? Joining me now is the former CEO of HCL Technologies and the author of Humans First, Machines Second, Vineet Nair. Vineet, it's great to have you back on Young Turks. Thanks so much for joining us, and it's good to see you.
Thank you. After decades, I was talking to you that one of my first interviews with you was Young Turks.
Exactly. So and here you are setting the cat among pigeons 15 years on. And that's what I want to address with you. When you wrote your first book, which again flipped the debate where in this notion of customer is king and customer comes first, you said employees come first. That's what you're attempting to do with this one as well. You're not saying the technology is not important or not transformative, but you're saying people will still matter.
I think the argument is about the same, right? In terms of if you increase the clock speed of your organization by having inspired, motivated employees, your revenues and profitability will go up. As you said, we saw that in HCL Technologies and many other companies are following the suit. Now we are in a position, I don't know whether you have seen this movie called Gods Must Be Crazy.
No.
The Gods Must Be Crazy is a movie where there is a plane which is going on and it drops a bottle of Coke on an African village which had never seen a Coke bottle. And they suddenly start worshipping the Coke bottle as God. The bottle becomes the devil. I think that's exactly what is happening to the humans today. That somebody has dropped this Coke bottle called AI or machines on us, and we consider it as God. We say it will replace us. We'll say it is more intelligent than us. We say it is, all that stuff may be true, but we are completely forgetting that God created the humans and humans created these machines. So instead of worshiping the humans, have some respect for yourself. And therefore, when I talk to young people, they're losing belief in themselves. They're getting pessimistic about the future. That is the time I said, hey, we should stop and re-energize human beings and tell them that everything new was created by them. Everything disruptive was created by them. All revolutions were headed by humans. Believe in the human. And then I gave 30 principles of how humans can rediscover themselves and use AI to create disruptive ideas in disruptive companies.
I'll come to the 30 sparks in a second, but you started work on this book 3 years ago. 3 years ago, AI was not the kind of global obsession that it is today, and there was certainly not this kind of fear factor involved. What made you want to write this book? Why did you think about writing this book 3 years ago?
I think I have been involved in advising a lot of companies on AI implementation, and AI has been there for many, many years. And as newer and newer companies started talking about technology, not necessarily AI, I could sense the direction in which is going, and I could sense that people are stopping to matter less and less, over a period of time. And that is the time I started working on this book.
Let's get into the nuts and bolts now. You know, from the business that you came from, the Indian IT services industry, and there is a big question mark yet again on what will happen to the Indian IT services industry. You believe that 50% of the tasks that the Indian IT services do today will be automated, will be done by machines, will be done by AI. What then happens to Indian IT services companies? Are you pessimistic? Are you optimistic?
I think we have to start with the fact that will the investment in technology go up or go down as a percentage of revenues? Throughout the world, it will go up. That means the opportunity side is only going to go up, which it has gone up like that for the last 30 years. So the only way Indian IT is going to continue to be relevant if they become relevant to that new spend. Now, on one side, your old spend of Indian IT services are going to be taken away by the technology, whether it is robotics or whether it is AI. Are you willing to kill your revenues faster than the market kills it and invest in opportunities of building AI capabilities, AI services, AI models, so that you can grab that opportunity? Or are you going to lie back and wait for the inevitable to happen? So let me remind you what happened. Indian IT got created because of the lethargy of global companies. EDS, Dell, HP, IBM were lethargic in responding to the fact that there is a new way of delivering services, and Indian IT jumped ahead with that relevance. So the point I'm making is the answer to that question, whether I'm pessimistic or optimistic, depends on what Indian IT decides to do. Individual companies decide to do. Take the risk, grab the opportunity, and kill your existing business to a certain extent. Go to 100 customers, say 30% off for the next 5 years, and this is the way we're going to execute it. Or focus on quarter-on-quarter results and wait it out. That will depend whether it is an opportunity or it is a disaster.
If you were in the CEO's position...
I'm glad I'm not in that.
You're glad that you're not, but if you were, would you be able to go to your customer and say, look, let's run down the current source of revenue and look at the opportunities for the future? Is it possible for us to make that significant pivot today?
I think, Shireen, the answer to that approach it from two angles. The first angle is strategic, right? In terms of the revenues are going to go down, that is inevitable, right? There is nothing you can do to prevent it. The customer is smart, and therefore, if you are, like in recession, what happened? The customer said that if you don't give me a discount of 30%, 40%,
I'm walking.
So what did all of us do? We gave 30 or 40% discount up front, but none of our revenues, none of our margins, none of our profitability went down because we were proactive about it. Why were we proactive? Because the environment forced us to do it. So in my mind, our response in recession was easy because the environment forced you to do that. Now it is difficult predominantly because the environment is not forcing, it is touching and feeling and saying, hey, behave properly, but it is not forcing you. So strategically, if something is inevitable, prepone it. Because if you prepone it, you win the relationship. You are with the customer, because in the end, it is a customer relationship. So strategically, this strategy is the only strategy which makes sense. Number two, this is an opportunity where your competition is sleeping because their boards are quarter after quarter. So if you go aggressively, which is what we did aggressively with no HCLite left behind, everybody was sacking people in recession. We said no HCLite left behind, because of which we gained market share. This is a mega opportunity for you to gain market share, while the other competition is sleeping. So from a strategic point of view, I would say this is a godsend opportunity for you to be counterintuitive, not saving today, but investing for tomorrow. But there is another point, Shireen, that this country has a contribution in building your company to whatever extent it is, multi-billion dollars, whatever it is. Do you owe something back to this country? Do you owe something back to the employees who work to make this country?
I mean, you're paying taxes, you're paying salaries. One would argue that you could do better on paying salaries, at least as far as the IT services companies are concerned. We haven't really seen any significant change as far as the entry-level salaries are concerned.
I don't want to go down to that socialist argument. I want to go down to the strategic argument. When we say India as a competitive country, who is India? India is Indian companies. So if Indian companies are going to put their shutter down and be protective about yesterday rather than in taking risk about investing tomorrow, then how can you call India competitive? So the point I'm saying to all these leaders is there is a responsibility for us to be competitive. There is a responsibility for us to take risk. There is a responsibility to put that $1 billion, multiple $1 billion at use. All these, the Premjis, the Nadards, the Murthis of the world actually took risk when there was no money. And the reason Indian IT is as big as it is because FC Kohli and all these guys did stuff which nobody else imagined could do, despite the fact they had no money. Now you have the money. Put your capital at risk because that is the only way India will be competitive. You are India. There is no India outside you. So please, focus on your responsibility and make us competitive.
Okay, so you're saying it is India Inc.'s responsibility to make India competitive.
Yes, 100%.
And you're also suggesting a third thing. You're saying partner with startups, nurture Indian startups, and that could be your way of paying it forward.
So, I'm going to get into trouble by saying what
Please
I'm going to
do.
say.
I want you to get into trouble.
So,
for all the right reasons.
Yeah. So what happened was we created these middle managers who were very good in managing people rather than inspiring and doing creatively completely new things. I'm not generalizing it, but I'm saying, let's say, an X percentage of people belong to that capability. Now, suddenly, the opportunity has changed. Managing is only going down. Creating new, reimagining a process, reimagining company success is coming in. That capability doesn't exist. So if that capability doesn't exist and you cannot teach people how to reimagine, you cannot teach people how to go into GE and tell them, hey, this is how AI can completely revolutionize the way you manufacture engines. If you don't have the capability, what is the next best thing? There is capability in young minds coming out of IITs and IIMs, right? So I'm saying, why don't you invest 5% of your profit by incubating 100, 200, 500 startups inside your organization, not outside your organization. Give them capital, but that capital is not too much. Give them customer access. Give them HR capability. Hire people for them. Give them facility to sit. Put 5% of our profit back into the startups. Give them access to everything. Keep the middle managers out and let them innovate and let them fire independent of your bureaucratic organization. So that they reimagine, they recreate, they create something which doesn't exist. And that is the only reason they're going to work in your company.
But will it also have to be in a new organization?
Yes.
Because, I mean, these are large legacy incumbents that have a certain culture, that have a certain style of functioning. Will this kind of incubation, this kind of sort of, breakout, moonshot culture be able to exist within those organizations, or will you need to look at a spin-off?
So we need to look at this. So what I'm saying is this is debatable, but I personally believe, having run an IT organization, that these organizations are damn good because they run like machines, right? They run on systems and processes. And the moment you start upsetting it, if the whole house of cards will fall, predominantly because there is a machine which is running it.
Yeah.
Now, those set of new innovative ideas, you can't bring into this machine. Neither you can change this machine to be innovative overnight. So it has to be through osmosis. So that is the reason I'm saying create a completely new company. Do it in a way, give them equity share, call them something else, don't call them your name, call them something else, take a risk, give them everything, and it's fine. It is fine. That is what. And over a period of time, through osmosis, the entire organization will change. And these guys will get an opportunity. These guys will say, I want to go there. You says, okay, if you want to go there, show me 1, 2, 3. And if you show me 1, 2, 3, you go there. So I think that is how we did in HCL also. Whenever a new technology come in, we will create a new business. That is the way you do it. If you try and build the new into the old, it will suffer. If you try and change the old into new, house of cards will collapse.
Reimagineers is what you're calling for. You believe that there needs to be a movement to create reimagineers instead of plain engineers within the education system that we currently live with. And this is an education system that has been built on decades and decades of ratta or rote. How do we, now that you've dirtied your hands, you've been in the trenches in the education system for the past 15 years, how do you create reimagineers?
Yeah. So I think let's break this into 3 parts. One is, what is the need of the hour? The need of the hour is that the knowledge assimilation through AI is going to be faster than anything we have seen. So therefore, teaching knowledge school is a waste of time. Knowledge skills is a waste of time. Teaching how to apply that knowledge and how to reimagine a process or reimagine a problem or reimagine a solution is going to be the skill which we need to teach. So point number 1. And if you don't teach that, our manpower is going to be obsolete. Once you understand that, now let's talk about whose responsibility is to create these reimagineers, right? I would say that the first set of people who are failing our children are the parents. The parents are the most people who are invested in their children. And I tell from parenting point of view, and I do these parenting workshops, you will laugh. And that is the reason I was telling I loved your recording the children storybooks, and more people should do it. In the parenting workshop, I ask parents in terms of what kind of conversations do you have at the dinner table. Does it create curiosity? Does it create experimentation? Does it create reimagining? And the answer to that is no, it is only instructive. My father did this and I had 100 rupees and, this is instructive and you're destroying the, and he's spending more time with you than he's spending with the children.
Yeah.
The first point, responsibility of creating reimagineers of the parents before you say government is bad, this is bad, that is bad. The second is the schooling system. Now, the unfortunate truth of the schooling system is exactly what I say about the IT services organization. It is wrong stepped. And therefore, the ability to change it, because our teachers are not capable of imparting outside knowledge. Technology is not going to help. AI is not a solution of school education or college education. It will take a decade of the relentless pursuit of creating reimaginers in an education system. That is the reason I'm saying let's go back home, right? In home, let's create reimaginers, and that is where the future of India will really belong.
But what has been the experience? And you're working with government schools across 8 states in India. 2 crore children have been part of Sampark Foundation's programs that you are running across the country. What do you take away as the big insights, as the big lessons? What are those schools telling you? What are those children in those schools telling you?
So first is, I think these children are brighter than I initially anticipated and anything I've seen in my schools, point 1. We came up with a very small experiment that we tell a story and we stop it midway and we don't complete the story. And we had massive resistance from the teacher, massive resistance. And now the teacher is saying we don't want full stories. So the moment the children are waiting for the half story.
So that they can write their own story.
They can write their own stories.
Yeah.
So that is changing. And I love the fact that the teachers are accepting and making that happen. If we intelligently leverage technology to reach the children, I think we're going to see a new India soon.
Well, I certainly hope that we do see a new India soon. But let's talk about the 30 sparks that you want to ignite in this AI era. And let me start by asking you, where would you make the beginnings within an organization? You need to acquire the skills to whitewater raft, and rapids are coming at us, and perhaps AI is one of the biggest rapids that we're going to have to deal with. Where do you make the start?
I think trust. The trust in our leadership is going down, predominantly because employees feel that the leadership interest and my interest are not aligned. And the moment that happens, then you get 50% of the employee or 30% of the employee. You don't get 100% of the employee. And the question I ask is, why does an employee spend his own money, go to a mandir, mosque or a church, feel excited about it, fulfilled about it, and then come on Monday to my office, get the salary and feel, pretty bad about it? And the reason is because there is lack of purpose and there is lack of trust. So the first step for you to create a competitive organization is to make sure that there is trust between you and the employee by being honest. Number two, create a sense of purpose. What is the purpose? What in the end are we attempting to do outside profits? Where is it going to go? Number three, create innovation through reimagining what is possible. Why restrict within? See, all magic happens outside the box of reason and logic, right? So expand the boundary of logic and reason by creating a culture where people reimagine and then amplify. Anything which is good is not your responsibility, right? Is the responsibility amplify wins, amplify employees, amplify. So the more you amplify, the behavior will become culture. So the 30 sparks are nothing but how potentially a mid-manager or a CEO can go about creating this culture in the age of AI, because AI is a mega opportunity to create magic.
Let me throw back to you that we're talking so much about how culture is going to be important and culture will drive the organization. But, people would argue that we're now talking about having billion-dollar companies with one employee. What culture do you need for that?
I think, pardon my saying it, but those guys should be sent into, the word I can't say. I somehow I truly believe we are obsessed with profits. Shireen, to what extent it is logical for you to send a 7 a.m. mail to 13,000 people and saying you don't have a job? You're not dealing with, you're dealing with humans. You're dealing with people with families. You're dealing with people with aspirations. You're dealing with people with emotions. Yeah, if you have to let 13,000 people go, but there can be a better way of doing it. They can be telling them that we are getting into trouble. There can be some roadshows about the fact
that most of these companies are not in trouble. They're
making billions of dollars. Yeah, but so somewhere, Shireen, I hope through this book and through my saying this, I'll be hated in the industry. I am raising my voice that there is a way of dealing with employees. And some of us have to raise the voice that you have to treat people as people. You made all the money because of people. So some responsibility. I'm not saying don't get rid of people. No, I'm not on the union camp. But I'm saying there has to be some amount of respect, some amount of thought, some amount of, even when you deal with a customer and the customer walks away from you, there is a roadmap. When you walk away from a customer, there is a roadmap. So why is there no roadmap with the employee? Why don't you make that attempt? And the point is, if you make that attempt and you have that culture, magic will happen, profit will happen. But if you do this, see, the point is, you fired 13,000 people at 7 o'clock. 13,000 people are gone, but all the people who stayed back, what are they thinking? Mera number aane wala hai. And do you think she's going to work hard for your success? The answer is no. It's completely illogical.
You do believe that there is a 33% chance that this is a bubble. You're very specific. Why a 33%?
No, it is a bubble. No, there's no 3% chance. It is a 100% chance. It is a bubble from a valuation point of view. Right.
But not from a technology point of view.
Technology, technology, AI will move into robotics. This is only accelerating. And it is good. It is good. And some regulations will come in, as we are already seeing coming in, to make sure that the bad elements of the AI is not used. But I'm less excited about AI, more excited about the robotics, which is coming just behind it. Use of that technology to create value. So what is Amazon, right? Use of technology. What is Facebook? Use of technology. What is Google? Use of technology. So the future belongs to creating value by the use of technology and not the technology alone.
So let me end by asking you, what is it that you would like to caution a CEO about today? I mean, of course, some of the risks are obvious, some of the risks we've chatted about, but something that is unknown, what is it that you would caution CEOs about?
I think if a CEO is listening to this, I would say that you are amongst the smartest of the lot. And the reason you are a CEO is because you're very smart. Now the question is, what is your responsibility of being smart? And responsibility one is the fact that you need to grow faster than when you came into the chair. And number two, you need to carry your people along. Now, how do you combine these two? By being counterintuitive, by doing something which is not traditional, by not being incremental, by being innovative, by thinking outside the box. And as long as your mission is to do something which nobody else could do, you will create magic. India will gain, India Inc. will gain, India employees will gain, the world will gain.
Vineet Nair, it's always a pleasure. Thank you so much for joining us here on Young Turks Reloaded. We look forward to the next book, but we look forward to more conversations. Is there another one coming?
No. I'm done.
You're done.
Thank you. This itself is a risk. I don't know how it will go. And
do you feel you have a target on your back?
No, I have a target on my back. I don't know why I'm doing it. Shirin, I really don't know why I'm doing it. It is, my family tells me you're being naive.
Well, I hope it sparks many conversations, important and relevant, timely conversations. Thank you so much for joining us here on Young Turks Reloaded. With that, it is time for us to wrap up this edition of Young Turks Reloaded. As always, do send us your feedback. We love to hear from you. We'll see you again next week. Till then, from all of us here, goodbye and thanks for watching. Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices ease as the pause in US-Iran hostilities raises hopes of a de-escalation. President Trump calls the talks with Iran friendly but rules out prolonged negotiations. Reuters reports Oman has presented Iran with a joint mechanism to manage the Strait of Hormuz, which includes voluntary fee. Sensex and Nifty end with March losses after a range-bound session. The rupee continues to regain lost ground against the dollar. Hindustan Unilever largely meets estimates in Q1. The stock slides 7% as volume growth disappoints. Tax expenses rise. Shares of D-Mart suffer the biggest single-day fall in nearly 2 years after the management expects no major revival in same-store sales growth and flags quick commerce as a structural threat. HDFC Bank's board views the 45 crore rupee payment to Maharashtra State Road Development Corporation as a procedural lapse and not misconduct. Sources say the matter is unlikely to hinder CEO Shashidhar Jagdishan's reappointment. The board decided to impose a 1 lakh rupee penalty and issue a warning to the CEO, CFO and head of retail assets. Tata Sons chairman N. Chandrasekaran extends the timeline to revive Air India, says the transformation will take 5 to 10 years in the latest annual report. Cites supply chain disruptions, fleet renewal, legacy system overhaul, among others. Swiggy ropes in former Myntra CEO Nandita Sinha to head Instamart. She will succeed Amitesh Jha, who announced his resignation after a stint of less than 2 years. The Supreme Court moots an independent probe into excessive use of force by the police to clamp down on student protests, directs all states to release detained protesters who have no criminal record, orders no coercive action should be taken against protesters. Union Minister Jitendra Singh tables the new exam fraud bill that imposes harsher punishments on offenders. The proposed legislation also introduces a 2-month deadline to complete investigations and empowers states to establish fast-track courts for speedy prosecution. IT Ministry summons Meta officials after Prime Minister Modi's video promising strict action on paper leaks was briefly removed and later restored. Meta says the content was removed in error. Parliamentary panel on communications summons executives from Google, Meta, Snapchat, X and other platforms to discuss social media regulations. Massive wildfire tears through France and Spain. Over 3 lakh people forced to evacuate their homes. Bordeaux in southwest France is the worst affected. The fires in Spain affected an area nearly the size of New York City. Well, straight to the top story this evening. The pause in US-Iran hostilities is raising hopes of a possible de-escalation. President Trump has called the talks with Iran quote-unquote friendly. Now, here's a look at the latest developments overnight. Despite saying that the talks were progressing well, President Trump said that the US would resume strikes if, and I quote, something good doesn't happen. He also claimed that Iran asked Washington to stop the strikes, adding that the Strait of Hormuz is, and I quote again, in very good shape. Meanwhile, Tehran denied reports that it initiated the talks. Addressing a press conference overnight, Iranian Foreign Ministry spokesperson said that no direct negotiations are taking place currently. This as Gulf nations continue to face the heat of the conflict. Now, Saudi Arabia says it intercepted several drones coming in from Iraqi territory. Separately, a plume of smoke was seen in the city where the Aramco oil facility is located. The Iran-backed Yemeni militant group of Houthis claimed responsibility of the attack. However, Saudi Arabia has not confirmed nor denied any damage to the Saudi Aramco refinery yet. This as Israeli Prime Minister Netanyahu arrived in US to meet President Trump for their first in-person talk since the start of the conflict. Netanyahu said that Iran will be at the forefront of the agenda for discussions. In the oil market, Brent crude price is easing to $86 a barrel. Reuters reports that Oman has presented Iran with a joint mechanism to manage the Strait of Hormuz, which includes voluntary fee. According to ship tracker Kepler, traffic fell to 29% verified crossings between the 24th of July to the 26th.
And we're talking right now. You know, they wanted to talk. Their people said, please don't shoot last night, the night before, 2 nights. Don't do it. You know, we're having good talks. So we'll see what happens. I think there's a good chance that something could happen. And if it does, good. If it doesn't, we go back to doing what we were doing 2 days ago.
Well, that's President Trump. Asian equity is down sharply as fresh concerns over artificial intelligence investments has sparked another wave of selling in global chip makers. South Korean indices led the losses, down 10%, the lowest level that we've seen since April. This as Nvidia's latest $750 billion investment has fueled worries about demand for AI infrastructure, keeping pace with the unprecedented investments. Now, reports also suggest that a Chinese company has begun mass-producing immersion deep ultraviolet lithography machines. That also weighed on shares of semiconductor equipment makers. The Kospi closing about 11% lower, the Shanghai down 1% and the Nikkei down by about 4%. Back home, the Lal Street ending the day flat today. The Nifty closed above the 23,900 mark, led higher by IT stocks today. Mid-caps outperformed the benchmark indices, also closing in the green. However, the Nifty Bank Index was down today, down by about 0.5% or so. Flat but in positive territory, the mid-cap index, and a flat close for both the Sensex and the Nifty. Now, shares of HUL declined over 7% despite largely meeting estimates in Q1. This as weak volume growth disappointed the street. Meanwhile, Avenue Supermarts has seen its biggest single-day fall in nearly 2 years after the management flagged that quick commerce is a structural challenge and expected no major revival in same-store sales growth. Mangalam is standing by with the details. Mangalam, HUL and Avenue Supermarts both taking a big knock in the markets today. What seems to be worrying investors?
Well, for both HUL and DMart, the thing was that the street was expecting a little more than what these companies could deliver. Not that these companies didn't deliver, it's just that the expectations of the street ran a little ahead of what the actuality was. So let's start with HUL. The revenues grew in near double digit, which is the fastest that we've seen in the last 13 quarters. The underlying consumer sentiment, the company said, stays fairly stable with an element of price growth coming in as well. So 5% price growth, 5% underlying sales growth. And at the same time, we saw, the margins stay sustained. The management said despite the volatility in the raw material inflation environment, they hold on to the margin guidance of 22.5% to 23.5% as well. On the bottom line, yes, on a reported basis, there was a decline of 2%, but that was on account of a tax credit in the base quarter. Just for that, there too, the revenues were higher than, what the company has reported same time last year by almost 8 to 10% and pretty much in line with street expectations if you take the tax, impact off. More importantly, the internals of the company, the premium portfolio doing extremely well, and the management guiding for stable demand ahead of the festive season for both rural as well as domestic urban consumption, with the premium parts of the portfolio growing in double digits. So the stock actually fell because the street was expecting a little more. The expectations were that of 6 to 7% volume growth, with a far more aggressive commentary when it comes to growth.
So firstly, we see rural demand continuing to be stable and robust in the quarter. So in the quarter that's gone by, June quarter, we see both urban and rural demand continuing to be stable in the quarter. So that's really our outlook going in. We have to keep watching, like I said, in terms of the monsoon and in terms of geopolitical impact on inflation. But given all the measures that have happened in the country, both in terms of the monetary measures, fiscal measures, the demand in the country remains consistent, remains stable.
Similar is the case with DMart. It held its analyst meet today, and more importantly, the management signified no real change from the previously guided strategy of the CEO. So as a result of which, the stock sold off because they thought that maybe Anshul Asawa, who's the new CEO of DMart, will come out with a more aggressive store expansion plan. They said they'll continue that 80 to 100 store addition every year, with more number of stores being added on the lease front. The threat of quick commerce always looms, and the valuations of DMart notwithstanding saw the stock end lower today.
Yes, down by almost 5%. Many thanks, Mangalam, for joining us. Indigo has announced a change in its top management. The budget airline has appointed Kiran Thadimari as its new chief financial officer. The airline redesignated its current CFO, Gaurav Negi, as advisor to the managing director, Rahul Bhatia. These changes are part of a larger reshuffle that's been taking place since Bhatia took over in March following the exit of former CEO Peter Elbers. This comes after Indigo appointed Willie Walsh as the new CEO of the airline. Walsh is expected to take charge in August. Swiggy Instamart CEO Amitesh Kumar Jha has stepped down from his role with immediate effect. The company has named former Myntra chief Nandita Sinha as his successor. She will take charge on the 3rd of August. Jha's exit marks the end of a relatively short stint at the helm. He joined Swiggy in September 2024 after spending nearly 14 years at Flipkart. HDFC Bank's board views the 45 crore rupee payment to the Maharashtra State Road Development Corporation as a procedural lapse and not misconduct. Now, sources say the matter is unlikely to hinder CEO Sashidhar Jagdishan's reappointment. The board decided to impose a 1 lakh rupee penalty and issue a warning to the CEO, CFO and the head of retail assets. But it is still a question mark on whether Sashidhar Jagdishan will be reappointed. Our sources tell us that it may not be a no-go as far as the RBI's fit and proper criteria is concerned. We'll head into a break, but up next, the Supreme Court moots an independent probe into excessive use of force by the police to clamp down on student protests, directs all states to release detained protesters who are minors. That and more when we return. Tata Sons reported a profit of nearly 32,000 crore rupees in FY26. This is 22% higher compared with last year. The conglomerate's annual report shows that group companies have posted a combined annual profit of 1.7 lakh crore rupees. It also says that Tata Electronics has emerged as the major job creator in the group and that Air India's revival is going to take longer. To discuss all of this and more, we're now joined by Madhiya Mujawar and Ratcha Dhanrajani. Madhiya, first to you. Chairman N. Chandrasekaran expects the airline to transform, but now only after the next 5 to 10 years. Take us through the reasons behind this.
Well, there is a significant reset coming in from Tata Sons on Air India's turnaround. For the first time, Tata Sons chairman N. Chandrasekaran has said that rebuilding Air India could take 5 to 10 years. In his letter to shareholders, he explains why the transformation is taking longer than originally envisaged. Let's first look at the numbers. Air India reported a revenue of 71,870 crore in FY26, down from 78,600 crore a year earlier. Losses more than doubled to 22,200 crore from 10,800 crore in FY25. And perhaps that's why Tata Sons is now resetting expectations. Remember, Air India unveiled Vihan.ai in September 2022 as a 5-year transformation roadmap. So we should have ideally seen a transformed Air India in 2027. But now Chandrasekaran says that the airline's transformation will take longer. In his words, he said, and I quote, Air India's transformation must be seen as a 5 to 10-year journey. Every great airline in history was built over decades and not quarters. He says rebuilding Air India has taken longer because of supply chain disruptions, fleet renewal, legacy systems overhaul, cultural transformation, and the need to build technical talent. Now, this doesn't mean that the transformation has stalled completely. Air India has upgraded its IT systems with $200 million investment. The most criticism for Air India comes on the old interiors of the aircraft. So the airline has retrofitted 27 narrow-body aircraft. So the narrow-body retrofitting is done, and only 2 wide-body 787s have been retrofitted due to supply chain issues. It also brought 30 grounded aircraft back in service. The airline had ordered, when it took over Air India, the Tata Sons had ordered about 600 Boeing and Airbus planes. So far, it has received 6 Airbus A350s, 3 Boeing 787-9s, and over 50 Boeing 737s, which are the narrow-body planes. So over 500 new planes are still to be delivered, and the airline expects bulk inductions in 2027 and 2028. So while the transformation is underway, the wait for passengers for the fully rebuilt Air India will be longer than what they had expected.
Yes, that certainly seems to be the case now. N. Chandrasekaran talking about the next 5 to 10 years before things can turn around at Air India. But Rachna, coming to you now, Tata Electronics is now the 4th largest company within the Tata Group. It's also a major job creator with more than 86,000 employees. Take us through what the annual report says about Tata Electronics as well as its growth trajectory.
Absolutely. Tata Electronics was set up in 2020, and by 2026, it is now the 4th largest business in the Tata Group by revenue. Tata Electronics has reported revenue of 1,31,000 crore rupees for FY26. That's up nearly 97%, double of almost what it was the previous year. Only Tata Motors passenger vehicle arm, TCS, and Tata Steel are bigger than Tata Electronics now, because the company now out-earns Titan, Air India, and even Tata Power. But the profit line here tells a very different story. The net loss widened to 1,611 crore rupees from just 70 crore rupees a year ago. 23 times worse it has become. But the chairman's letter says operating profits have reached break-even, and that is true. But everything below the operating line, the depreciation, the interest on a very large bill, is now landing on the books. So where's the revenue actually coming from is the question. Well, almost all of it, roughly 97%, is one thing: making phones. The annual report does not name the client it makes phones for, but it says Tata Electronics made 12% of the total volume of phones produced by, quote, the global leader in 2025. But the 2 subsidiaries doing the work are named. One is the former Wistron India and the other is former Pegatron India. Both were Apple's contract manufacturers before Tata bought them. So it is the manufacturing of iPhones. The former Pegatron business, 60% of which Tata bought for 1,650 crore rupees, is losing 858 crore rupees on nearly 60,000 crore rupees of revenue. Now the semiconductors, and this is what the chairman is really trying to sell in this letter, because in his letter, N. Chandrasekaran writes, quote, chips are the new steel. A nation that cannot make its own semiconductors will always depend on others for the most fundamental input of the modern economy, end quote. Now, here's what the accounts really show. The two chip entities brought in about 214 crore rupees between them and lost about 777 crore rupees. The fab company, which is in Dholera, reported zero revenue. And in the entire 338-page long report, they give no capex figure for that fab nor a timeline to the first silicon that we'll see being manufactured here. Then there's the head count, 86,466 people, up almost 32%. Tata Electronics is now the second largest employer in the entire Tata Group, behind only TCS. Nearly two-thirds of that workforce is women. And here's the context that matters. Over the same 12 months, TCS shed about 23,460 people. Tata Electronics added 20,819. The group's total headcount moved less than 1%, and the Tata Group did not grow its workforce this year. It just changed its shape. Roughly 20,000 jobs moved from software to the factory floor. And Tata Sons put another 3,000 crore rupees into the business last year. So chips may well be the new steel, as N. Chandra says, but for now, it's the phones and the manufacturing of these phones is what is paying for them.
It certainly is. Many thanks for joining us, Rachna and Madiha. Now, the Supreme Court heard a clutch of petitions alleging police brutality during the crackdown on student protests across the country. The Supreme Court issued notices to Delhi, Maharashtra, Bihar, West Bengal, Madhya Pradesh and other states over the handling of the protests. The court also mooted the idea of an independent investigation into police excess and ordered the release of protesters who are minors. Meanwhile, the Rapid Action Force has identified serious operational deficiencies during the crackdown on protesters. Police records reveal an officer at the rank of Assistant Commissioner approved the use of pellet guns. The police also used electric shock weapons, including batons and shields. The state governments of Bihar and Assam have withdrawn all cases against the protesters. Both states have also promised not to take any fresh action. More than a dozen cases were registered against protesters in both states. The Lok Sabha took up the Public Examination Amendment Bill. The proposed legislation also introduces a 2-month deadline to complete investigations and empowers states to establish fast-track courts for speedy prosecution. Meanwhile, the IT Ministry has summoned Meta's global head of public policy after the platform removed and restored a video posted by Prime Minister Modi promising strict action on paper leaks. Meta says the content was removed in error. The Parliamentary Panel on Communications summons executives from Google, Meta, Snapchat, X and other platforms to discuss social media regulations. Here's all the action from Parliament.
This bill can be described in a way as a milestone legislation in the history of Indian Parliament.
जिस मंत्री के तहत में 21 बच्चों ने अपनी जान गंवा दी, आत्महत्या की, जब उसने अपने मंत्री पद से इस्तीफा दिया, कल जब वो सदन में आए आपने उनको ऐसा माला पहनाया ताकि जैसे वो पाकिस्तान से जंग लड़के आए हैं, ऐसा माला पहनाया, ऐसा उनका वजूद उनको बड़ा किया मानो कि वो पाकिस्तान से जाकर सीमा पे जाकर जंग लड़के आए हैं।
कांग्रेस शासित यूपीए ने पॉलिसी वैक्यूम करा, वहीं पर अगर मैं जेनजी की भाषा को बोरो करूं, then I will have to say मोदी जी clocked it and provided a legislative solution.
मैं इमरजेंसी को तो नहीं देखा हूं, लेकिन इमरजेंसी में क्या क्या हुआ है वो अभी दिल्ली की राजधानी में भी देखने को मिल गया। आंसू के गैस के गोले और लकड़ी में लगा हुआ कुछ कील का और कांटे की चीजें, उस समय करंट नहीं लगाया जाता था, इस बार करंट लगाया गया, तो ये इमरजेंसी के बराबर ही हुआ है हमला।
Well, the amendments to the examination bill being tabled in Parliament today, the discussion underway. Ashmi joins us now for what transpired in the Supreme Court. Ashmi, the court signalling the need for an independent probe into allegations of police brutality, police excess, providing a shield for protesters by blocking coercive action by the police as well. Take us through what the court said and where we are now heading.
Well, we saw a large bunch of petitioners raising concerns with respect to some of these incidents that we have seen over the last few days. Instances of lathi charge, use of pellets, use of electrified batons, use of even sticks which had nails in them. All of these instances had been flagged before the apex court. In fact, the petitioners went a step further. They also flagged the issue of police personnel in civilian clothes beating up protesters. They also, importantly, flagged the issue of facial recognition systems and digital data that has been collected as a means of surveillance insofar as the protesters are concerned. Now, on the back of all of these instances, the Supreme Court did observe, in fact, the bench headed by the CJI himself observed that there is a compelling case for a thorough investigation. In fact, went a step further and said that any investigation will be meaningless until accountability is fixed as far as these instances are concerned. But in the same breath, also important to mention that the Solicitor General was also there in court in these proceedings, representing the Delhi government as well as the centre. He made a couple of submissions. Number one, he said that the centre is not opposed to any investigation being instituted by the apex court, but in the same breath also said that police personnel have also been hurt, over 250 of them, and also importantly said that there were miscreants who had found their way into the protests, that there were people who had criminal antecedents, whether it's murder charges, rape charges, drug charges, and that is something that in fact should also be a part of these investigations. Nonetheless, the court saying that prima facie this is a fit case, at least compelling case being made for a thorough investigation. What shape and form that will take has been deferred to the next hearing, but until then, what the court has said is that all the digital evidence that has been collected, whether that's CCTV footage, body camera footage, facial recognition systems, all that digital data, number one, needs to be preserved, and number two, importantly, the safeguard cannot be made public by the police personnel at this stage. Also, secondly, the direction that the court has given is that all minors that were rounded up as a part of these protests, they are to be released. And importantly, while the investigations can continue, no coercive action against the protesters. So clearly, the big question now is what shape and form will a court-appointed investigation take? Who will be heading it? The protesters are pushing for a former CJI. The centre is essentially saying that the recommendation should not be taken from the parties, that the court should take its own decision. So clearly, the shape and form of this investigation agency, the contours of the investigation, as well as who will be heading it, these are questions we'll hopefully get answers to in the next hearing, which will be on Monday, the 3rd of August.
All right, Ashmit, many thanks for joining us. A quick check of some of the global headlines we're tracking. U.S. pharma giant Johnson & Johnson has proposed a $5.5 billion settlement to resolve thousands of lawsuits alleging that its talcum-based products caused ovarian cancer. The company said the settlement would cover around 76,000 remaining claims. It says it needs sign-offs from law firms representing at least 95% of those claims to be finalized. The company continues to deny that its talc products cause cancer, but stopped selling it in the US and Canada in 2020 and worldwide in 2023. It has since changed the formulation of the product. Anthropic CEO Dario Amodei says his company has never advocated for a ban on open-weight models. In a blog posted by Amodei, he says that tech companies must instead focus on keeping powerful chips out of the authoritarian hands. This statement has come after a coalition of tech companies, including NVIDIA and Microsoft, released a letter late night urging policymakers to avoid premature restrictions on open-weight models. These models allow users to download, modify, and run on their own infrastructure. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.